Yeah, let's go, guys. So, come on, guys, can you please confirm if the audio and video is clear to all of you? Can you please confirm if the audio and video is clear to all of you? Amazing, guys, amazing. So, come on, guys, tell me how's the Joes? Come on, guys, tell me how's the Joes? Everyone, how's the Joes? Are we high on energy? Because this session is going to be a very long session and an interesting session as well. Come on, guys, tell me. I need to see the comment. I need to see the chat box. Come on, each one of you. Yes, that's the energy I want in the session. Throughout the session, I want the energy. Okay, now, sir, what exactly are you going to cover in this session? Is it an FR session or an SBR session? So let me tell you guys, let me tell you very upfrontly, okay? Now, I believe all of you already know that SBR and FR, the topics are more or less 60% same, okay? And my intent here is to give you the conceptual revision of the standards. So basically today I will be covering the entire FR topics, okay? So shall an SBR student attend today's session? Yes, you should attend, because in SBR also there are topics from FR and they 60% overlap. Okay, now tomorrow, that is day 2, I will be covering the additional SBR topics. So the crux of it is, if you are an FR student, you should attend only today's session. If you are an SBR student, you should attend today plus tomorrow's session, both. Is that clear to all of you? Come on, guys, please tell me. Is that clear to all of you? Is that clear to all of you? Okay, now, so before we proceed further, let me tell you few important points. Of this session. Now, point number 1. In this session, I will be covering all the standards. Okay, I will be covering all the standards, IFRS standards. Point number 1. Point number 2. Okay, in this session, I will be covering the conceptual revision. Plus additionally, I have brought some master examples for you guys, which I will be solving with you. Plus, for few chapters, I will be showing a quick comparison. So 3 things is what we are going to discuss in this session. 3 things. Point number 1, we are going to discuss the conceptual revision. Point number 2, we are going to solve the master examples. Point number 3, we are going to study the quick comparison of few topics. These are the 3 things which we are going to cover in this session. Are you excited for that? Come on, guys, now tell me. Are you excited for that? Let me tell you very honestly, from my side, I am going to give my 200% in this session. Are you with me in this? I will give you myself 200% myself. Are you with me in this? Okay, now one request, guys. This session will be of somewhere in the range of 6 to 8 hours. This session will be somewhere in the range of 6 to 8 hours. Okay, now even if it is today in India, we are having 5 p.m. India time. Now whether if we add 8 hours, it goes to 1 a.m. in the night. Now it is 1 a.m. in the night or 2 a.m. in the night or 3 a.m. in the night. I don't bother about it. My intent here is, I have come here and I will help you revise all the standards. That is what is my intent. Okay, so now you have to be with me till the end. And let me tell you guys, when you will start to revise on your own, if you, let's suppose you think, no, I'll not watch this session, I will revise on my own. You will spend 3 days revising the entire standards, and then also you will not get that level of confidence. But just give me this 8 hours. Trust me, for these 8 hours, I will inbuilt confidence in you. I will inbuild a confidence in you, and then to after this session, just go through the notes I will share. Just go through the notes which I will share with you. Okay, and just solve questions. Just practice questions. Trust me, you are good to go with FR and SBR both. Tell me, is that clear, everyone? Is that clear, everyone? Come on, guys. Come on, guys. Tell me. Let me just give you a quick overview. Just give you a quick overview how our concept revision will go ahead today. So what I have done, please see here, guys. The concept revision. I have made the concept summary notes for all the chapters. For all the chapters. For additionally, for few chapters, wherever it is possible, I have made few mind maps. I have made few mind maps for you guys, and now these mind map, trust me, it is going to help you a lot. These mind maps, trust me, it is going to help you a lot. Okay, now not only mind maps, I have drafted master examples which also I'm going to discuss with you. Okay, now how will you discuss the master examples? Let me show it to you. Just give me a minute, guys. So can you see these are the master examples for non-current asset, might be for impairment, then cash generating unit, then IFRS 5, lease liability arrears, lease liability advance, okay, sale and lease back. So all these are master examples. All these are master examples. See how many examples I have taken up for you guys. These many, right? So I will be discussing each of these. I will be solving each of these in front of you today in this session. Now, this is not the end. We have something else for you as well. This is a quick comparison chart for this one is for non-current assets, wherein we'll understand PPE, IP and intangible assets at a glance. Then we'll understand group accounting, difference in the accounting treatment of a subsidiary and an associate. How will things move? Then quick comparison of IAS 36 impairment and IFRS 5 impairment. Okay, and quick comparison of financial instrument, that is financial assets, financial liability, equity, and then compound financial instruments. We'll do a quick comparison of these topics as well. Wherever it was possible for a quick comparison thing, I will be doing it with you guys. I'll be doing it with you guys. Okay, now I believe this session is going to help you a lot, in my opinion. What do you say? Come on, guys, please tell me. What do you say? Okay, so now if you are watching the session, getting the help from it, tell me, is it justified you are not liking the session? Can I request all of you? Can I request all of you to please like the session? Can I request all of you to please like the session? Hit the like button. Come on, all of you. Come on, please hit the like button, guys. Come on. Will you cover tax chapter? Yes, I do. I will cover tax chapter. I will cover tax chapter. Come on, guys, please hit the like button. Please hit the like button, all of you. Come on. So one note for the today's rough note. So now students are saying, will I get the notes? Yes, buddy, you will get the notes. Need not worry at all. You will get the notes. Sir, where will I get the notes? Where will I get the notes? You will get the notes in my Telegram group. The link of the Telegram group is given in the description box. You can join the Telegram group. You will get the notes. You will get the notes after the session. You will get the notes after the session. Okay. Shall I start now? Come on, guys, without wasting even a single minute now. Can we start? Can we start? Come on. Shall we start now? Chalo, let's start. So now we are starting with non-current assets. Just give me a minute, please. So now we are starting first of all with non-current assets. Now when you prepare a statement of financial position, when you prepare a statement of financial position, can you please tell me what is the structure of statement of financial position? First of all, it is an asset here, and then it is a equity here. You see equity here, and then you see liability here. Okay, let's not talk about equity and let's not talk about liability now. I am talking about asset now. In the asset, we see there are two type of assets. One is non-current asset and another is current asset. Right now, we are not talking about current asset also now. Equity no, liability no. We are talking about non-current asset. Now, non-current asset, guys, are of two types. One is tangible and another is intangible. Another is intangible non-current asset, right? Now, tangible non-current asset again are of two types. One is property, plant, equipment. Another is investment property. Another is investment property. Now, property, plant, equipment is covered under IAS 16. Investment property is covered under IAS 40 and intangible asset is covered under IAS 38. Okay, now come see. So there are three different standards for non-current asset. For non-current asset, there are three different standards. One is property, plant, equipment, investment property, and then intangible assets. So what we will do is, we will first of all study property, plant, equipment. Then I will quickly move to the comparative analysis of property, plant, equipment, investment property and IAS 38, so that you understand what exactly is the accounting treatment of all three. What exactly is the accounting treatment of all three? Can you guys, come on guys, tell me, is it clear everyone? Okay, now coming to property, plant and equipment. Now tell me, what is the meaning of property, plant, equipment? What is the meaning of property, plant and equipment? So property, plant and equipment is first of all, as we saw, it is a tangible asset, right? Now it is held for three purposes. You can use it for any three purposes. What are the three purposes? Point number one, held for production of goods or supply of services. Like for example, this laptop I am using for supplying the services, that is teaching services. So this laptop is my property, plant and equipment. Okay, and the life should be more than one period. Why? Because it's a non-current asset. For non-current, the life should be more than one period. Okay, now again I'm saying, what is the meaning of property, plant, equipment? So property, plant and equipment is a tangible asset. Point number one now, held for either production of goods or supply of services. Second, administrative purposes. Like for example, my admin team is using a laptop, right? That is administrative purposes. Third is rental to others. If I have given a laptop on rental to others, now if you are using that property for any of the three purposes, if you are using the laptop for any of the three purposes, it is called as property, plant and equipment. Just one point you should note here. When we say rental to others, and here it is property, plant, equipment. So please understand, I'll explain what is the meaning of property, plant and equipment. So understand, property here means land and building or both. Plant and equipment here means machineries, laptop, plants, all those things. So now if you give plant and equipment on rental, it is well covered under IAS 16. But if you give property on rental, it is covered under investment property. Okay, that's why I have written here rental to others excludes property. Why? Because if you give property on rental, it is investment property. Okay, now if you can see here, IAS 16 includes all plants and equipment. Now for property, if it is given on production or supply of goods, services, administrative purpose, but not rental. Why? Because if property is given on rental, it is investment property. Bearer plants are also included. What is excluded? Property on rental, property held for sale under IFRS 5, property held for sale in the ordinary course of business. My business itself is to sell properties, right? IAS 2. Then biological assets under IAS 41. So this is the meaning of property, plant and equipment. Now tell me, okay, we understood what is property, plant, equipment. Now comes the question, how shall we account for property, plant and equipment? So we should initially, tell me guys, come on, actively participate in the class, actively participate in the class. If any student is watching the recording, if there is any student who is watching the recording, please do not make it 2x or 1.5x. Why? Because I am myself saying at 2x speed. Okay, I am myself saying at 2x speed, so need not worry at all about that. Okay, so now tell me, what is the initial measurement of property, plant and equipment? It is measured at cost. It is measured at cost. Now comes the question, what is the meaning of cost? Come on guys, please tell me, what is the meaning of cost? Okay, so cost means, point number one, purchase price. Purchase price. Now understand guys, few students are saying in the chat box cost model. Nobody. Cost and cost model, there are two different things. Cost and cost model, there are two different things. I am talking initial measurement at cost. Subsequent measurement can be done at cost model or revaluation model. Okay, initially it has to be measured at cost only. Now comes the question, what is the meaning of cost? Cost includes purchase price, the amount that you pay to purchase, plus any non-refundable taxes, okay, plus any non-refundable upfront, you can say import duties, plus, tell me what else, any other directly attributable costs incurred to bring the asset in the intended location and condition. For example, I have purchased a air conditioner for my classes. Okay, now I have to pay a transportation cost to bring the air conditioner from the seller's premises to my premises, right? I will have to pay installation cost. So all those will be capitalized to the cost of the asset. Now, first point. Second point, about discounts. So if we have received trade discount, we will adjust this trade discount from the cost of the asset. But if we have received any cash discount, that will go to P&L. Now a student is asking, sir, can you give an example of non-refundable tax? Definitely, yes, I will give it. Let's suppose I am VJ Limited. Okay, now there are two students, one is VJ Limited and one is you can say AA Limited. Now I purchase a laptop for teaching in the class. Okay, so now let's suppose the MRP, understand, the cost of the laptop was dollar, you can say 10,000, plus I have to pay 18% GST on that. I have to pay 18% GST on that. That is 1800, and I paid 11,800 to purchase the laptop. I am paying 11,800. Okay, now AA Limited is also paying the same amount. But now, since I am using this laptop for my business purposes, the government will give me a refund of this by the name input tax credit. Okay, a refund of 1800 is given. So what is my cost? So in that case, my cost is 10,000. But now AA Limited is not getting a refund. Why? Because let's suppose AA Limited is not using this asset for business purposes, or AA Limited is not GST registered, whatever reason. Okay, in that case, AA Limited is not getting a refund. So in that case, this tax becomes the cost. Okay, because it is non-refundable, hence it becomes the cost. I believe it is very much clear. Okay, so what is the meaning of cost? Cost means purchase price minus add taxes, that is non-refundable taxes, then less any trade discounts or rebates. Cash discount will go to P&L. Add any borrowing cost on qualifying assets. Okay, if the borrowing cost has to be capitalized, then for the period of capitalization, add the borrowing cost to the cost of the asset. Any directly attributable costs to bring the asset to the location, that is installation cost. Condition, that is you can say transportation cost and installation cost. These will be capitalized to the cost of asset. Now there is one more thing, present value of dismantling or removing the item. Now tell me from the point of view of present value of dismantling cost, from the present value of dismantling cost, why are we taking these dismantling or removing the costs at present value? Why are we taking at its present value? Can anyone tell me why are we taking at its present value? Because it is paid. So understand here, it is to be paid, it is to be paid. See, we purchased the asset here, but these costs will be paid at the end of the useful life, right? Hence we have to pay, hence we have to compute the present value and capitalize to the cost of the asset, and capitalize to the cost of the asset. Very good guys, very good, amazing. Okay, so now what again, come on guys, tell me what is the meaning of cost? Purchase price, non-refundable taxes minus trade discounts plus borrowing cost plus any directly attributable cost incurred to bring the asset in the intended location and condition, and present value of decommissioning or removal costs. Now cash discount will go to P and L. Okay, capitalization will cease once the item is in the location and condition. Okay, whatever is the management's intention and condition, if the asset reaches there, you should stop capitalizing any further costs. Now understand, when we say directly attributable costs, standard gives a leeway. Okay, standard doesn't specify the meaning of directly attributable cost. Okay, but then what we have done is, the standard says directly attributable cost includes what? Wages or salaries to the construction employees, cost of site preparation, initial delivery or handling cost, installation cost, any professional fees paid, any testing cost paid. Okay, but it excludes cost of staff training, cost of opening a new facility, cost of relocating, introducing a new product, because these are advertising costs. Cost incurred after an item is capable of being operated, any initial operating losses, all these are not capitalized. All these are capitalized. Now one point which I want you to understand, if there is an overheads, now understand, if it is a directly attributable overheads, we will capitalize to cost. But if it is allocated overheads, it will go to P and L. I believe it is very much clear to all of you. Okay, now, so wages, construction site preparation, delivery cost, installation cost, professional fees, testing cost, directly attributable overheads will be capitalized. General overheads not capitalized. Is that clear, everyone? Is the meaning of cost clear to everyone? Come on guys, please tell me. Is the meaning of cost clear to everyone? Okay, now coming to, let's go into the further detail of provision for dismantling cost. Guys, please understand, we capitalize. Guys, provision for dismantling, I have taken an example to explain. Provision for dismantling, let's suppose we purchased an asset for $10 million, incurred installation cost of $2 million, and we will be incurring decommissioning cost of $6 million at the end of useful life of 3 years. Rate of interest is 10%. Suggest accounting treatment. So now tell me, what should be the cost of asset? So cost will include definitely this 10 million. Cost will include definitely this 2 million. Okay, so 10 plus 2, 12. But the cost will include the present value of this 6 million for 3 years at the rate of 10%. So total cost comes to 16.51. What is a journal entry to record these? Journal entry will be oil rig account debit. We have purchased an oil rig. Now how much do we pay? We paid how much? 10 plus 2, 12. 12 we paid immediately. Now the present value is 4.51. This 4.51 will be paying at the end of 3rd year. So this is our provision. Why? Because we have not yet paid the amount. Okay, we have not yet paid the amount. Now this is the treatment on initial. Can you please tell me what is the subsequent treatment? What is the subsequent treatment? The subsequent treatment is this oil rig will be depreciated over 3 years. Clear? This oil rig will be depreciated over 3 years. Clear? Now, this bank paid. Clear? Not out. Now, this provision for DRRC, we will unwind this over 3 years and we will pay it off here. Clear? Now, let me show the movement. Depreciation, we capitalized the oil rig at 16.51. We will depreciate over 3 years 5.5, 5.5, 5.5. Asset becomes 0 at year end 3. Now, unwinding the present value of decommissioning costs, 4.51 is the present value. We calculated this present value using the discount rate of 10%. So we will use the same discount rate to unwind. So 10% of 4.51 is 0.45 and your liability will become 4.51 plus 0.45 is 4.96. Are you understanding? 4.51 plus 0.45 is 4.96. Okay, now again 10% of 4.96 is 0.50. So liability at the end of year 2 is 4.96 plus 0.50 is 5.46. Again 10% of 5.46 is 0.54. So 5.46 plus 0.54 is 6. Now you will pay off 6. What is the journal entry to pay off 6? It is provision for DRRC, provision for decommissioning account debit to bank 6. Is that clear to everyone? Come on guys, please tell me. Is that clear to everyone? Okay, so how will the presentation look like in the SOFP? Asset will be there as part of non-current asset after depreciation. Provision for DRRC is a part of non-current liability. Okay, now in P&L, we will write finance cost on unwinding of provision and depreciation. Now guys, understand, I am talking one thing from an FR perspective. One thing from an FR perspective, please understand. If the question asks, what is the cost of, what is the total charge that will go to P&L? What is the total charge that will go to P&L? Then you will say both. If the question says what is the charge for this asset that will go to P&L, then you will send both. But if the question says only depreciation, then only depreciation. If the question says only finance cost, then only finance cost. If the question says what is the charge to P&L in respect of decommissioning liability, then only finance cost. I believe you are understanding how to present your answers in the exam. Okay, my intent is to help you from an exam point of view as well. Okay, now tell me, is the decommissioning clear? Is the decommissioning clear, everyone? Come on guys, please tell me, is the decommissioning clear, everyone? Is the decommissioning clear, everyone? Now moving on to the next point, subsequent measurement. So as I was mentioning guys, initial measurement has to be at cost, but subsequent measurement can be at cost model or at revaluation model. At cost model or at revaluation model, either of these, either. There is an option. You can apply cost model or you can apply revaluation model. Now, what is the meaning of cost model? If I have to explain what is cost model, let's suppose I have purchased an asset for 100, life is 10 years. I will simply depreciate 100 over 10 years. But if I have to explain revaluation model, what I will do here in the revaluation model is definitely I will depreciate 100 over 10 years. But whenever the entity believes that the carrying amount of the asset differs materially from the fair value, whenever the carrying amount of the asset differs materially from the fair value, then a revaluation is needed. Is that clear, everyone? Come on guys, please tell me, is that clear, everyone? Okay, now coming to here, revaluation model. But now understand, in the chapter of property, plant and equipment, it says the choice of cost model or revaluation model that has to be applied on an asset to asset basis. Again, I am repeating, on an asset to asset basis. Okay, let's understand please. Class of asset basis. So what does it say? Let's suppose for a property, plant and equipment, there are three class of assets. There are three class of assets. Let's suppose you can say machinery, building and land. Now the entity says, I will follow revaluation model for this one. I will follow a revaluation model for this one, but I will follow cost model for this one. Then in that case, all the machinery has to be kept at cost model only. All the building has to be kept at revaluation model only. All the land has to be kept at revaluation model only. Now, can there be a situation where I will say, no, this machinery I will keep at revaluation model? No, you can't do that. The choice of cost model or revaluation model is available on a class of asset basis. Okay, all the assets in the same class will follow the same model. Again, I'm repeating, all the assets in the same class will follow same model. Okay, now subsequent measurement of cost model or revaluation model. Cost model, as we know, cost minus depreciation. What is the meaning of revaluation model? What is the meaning of revaluation model? Okay, a student saying cherry picking is not allowed. Yes, very good, very well pointed out. Cherry picking is not allowed, meaning thereby if an entity says no, this asset, I want to measure this asset at revaluation model. No, then the entire class has to be a revaluation model. If the entire class is cost model, you can't cherry pick an asset and say, no, I will keep it at revaluation model. No, you can't do that. You can't do that. Now comes the revaluation. So if an entity selects a revaluation model, what should be the frequency? So now the standard says that if a revaluation model is opted for, then the revaluation has to be done when the carrying amount of the asset, differs materially from the fair value. Okay, if there is a material difference, in the carrying amount and fair value, we do a revaluation. Now there is one student in the chat box is saying revaluation has to be done at each reporting period. No. For property, plant and equipment, revaluation is not required at each reporting dates. Not required. Are you getting my point? Now, generally, we can revalue once in 3 to 5 years. If the fair value is highly volatile, then you can do annual revaluation. Okay. Now, whenever we do revaluation, okay, what is the treatment of revaluation gain loss? Now the student generally says, sir, if there is a gain, I will take it to OCI, but if there is a loss, I will take it to P&L. No, wrong. Please understand the detailed treatment. Understand, guys. When you do the first time revaluation, and you get a revaluation gain, it will go to other comprehensive income. And when you do a first time revaluation and you get a revaluation loss, it will go to P&L. Now, subsequently, if you are doing a revaluation, okay, you got a revaluation gain and subsequently you are doing a revaluation and you are again getting revaluation gain, it will go to OCI. But please understand, important point. Subsequently, if you get a revaluation loss, then what will happen? This loss should be adjusted with other comprehensive income. To the extent there is a balance in revaluation reserve, any excess will go to P&L. Let me show it with the help of an example. Please understand. We did the first time revaluation and we got a revaluation gain of 80. Where will we record this 80? OCI. We will accumulate this in revaluation reserve. This revaluation reserve will go to SOFP, Statement of Financial Position. Now, We again did revaluation and we got a revaluation gain of 30. Okay, so this 30 will go to other comprehensive income, right? And what will be the balance of revaluation reserve? 80 plus 30, 110. Again, we did a revaluation and we got a revaluation loss. Now, some students will say, sir, revaluation loss will go to P&L. No, my bacha party. No, no, no. This revaluation loss will be adjusted with P and L. Why? Because not P and L. This revaluation loss will be adjusted with other comprehensive income, right? Why? Because there is a balance in revaluation reserve. There is a balance in revaluation reserve, right? So now what will happen? See, revaluation loss of 50. Revaluation loss of 50. Guys, at times I will purposely make mistake so that I expect that you guys will rectify me. Okay, so please be attentive in the class. Please be attentive in the class, guys. In this session I am giving my 200% and I will be giving my 200% throughout the session. Okay, and I expect you guys to do the same. Tell me now, so far, is this session helping you? Is this session helping you revise the entire concept of FR? So far, whatever we have studied, is it giving you confidence? Come on, everyone. Come on, everyone. How's the Joes, everyone? Very good, very good. I need to see this energy throughout the session, guys. See, taking a session of 8 hours is at a stretch is not, you can say, humanly possible. Okay, but I am taking it just for you guys, okay? So please support me with your high energy till the end of the session. Okay, till the end of the session. Now, so this is a revaluation loss now. So what is happening now? Understand, please, guys. Come on. This revaluation loss will be adjusted from revaluation reserve to the extent there is a balance in revaluation reserve. Now tell me, what is the balance? 110. So can we take it to OCI? Yes. So I will take it to other comprehensive income. Now see, the revaluation reserve balance will reduce. 110 minus 50 is 60. Right? Now again I got a revaluation loss. Of 70. Now what will happen? This 70 will be adjusted from this revaluation again reserve. But loss is 70, but balance is only 60. So what will I do? To the extent of 60, I will take it to P&L and revaluation reserve becomes 0. Now the excess 10 will go to P&L. That's what I'm saying here. When you revalue for the first time, gain OCI, accumulate in revaluation reserve, again revaluation gain, record in other comprehensive income, accumulate in revaluation reserve, again revaluation loss, adjust with OCI. To the extent there is a balance in revaluation reserve, any excess will go to P&L. Now, you did a revaluation for the very first time and you got a revaluation loss. Okay, revaluation loss. Now, when you do a revaluation loss, subsequent revaluation, again you get a revaluation loss. So this revaluation loss will go to P&L. This revaluation loss will go to P&L. Okay, now revaluation gain. What will happen with this revaluation gain? So now the standard says, to the extent the revaluation loss has been recognized in P&L. To the extent the revaluation loss has been recognized in P&L, transfer the revaluation gain also to P&L. Any excess revaluation gain will be recognized in other comprehensive income. Let me explain. Revaluation loss 10, first time revaluation, P&L. Again revaluation, P&L. Now revaluation gain. Sorry. So what will happen? How much revaluation loss has been recognized in P&L? 60. So revaluation gain up to 60 will go to P&L. Excess 20 will go to other comprehensive income and accumulate in revaluation reserve. Guys, please understand. You must say that, sir, if the entity already has a balance of revalues, please, I'm telling some technical point. I'm telling a very important technical point. Listen to me. Now you must say, sir, the entity might already have revaluation reserve from some other asset. Can't we adjust the revaluation loss of one asset from the revaluation reserve of another asset? Are you getting my question? Can we adjust the revaluation loss of one asset from the revaluation reserve of another asset? No, you can't do that. You can't do that. You can't do that. Okay, you can't do that. Okay, why? Because it says the treatment of revaluation gain and loss of different assets entity cannot net off. Entity cannot net off. Okay, entity cannot net off even if they belong to same class of assets, then also no. So basically understand, guys, please understand one important point here. Please understand one important point here. The choice of cost model or revaluation model is available on class of assets. But if we have opted for revaluation model, then the treatment of revaluation gain or loss is asset by asset basis. I believe it is very much clear to everyone. No, same class also it cannot do the net off. Okay, now asset A and asset B, they both are of same class. Okay, asset A has a revaluation gain of 80, asset B has a revaluation loss of 30. Can we net off? No, we cannot. Revaluation gain will go to OCI and revaluation reserve. Revaluation loss will go to P&L. Is that clear, everyone? Is that clear, everyone? Okay, now, sir, what is what is journal entry to record revaluation gain or a loss? Okay, so if it's a revaluation gain, entry will be asset account debit to other comprehensive income. If it's a revaluation loss, the entry will be other comprehensive income account debit to to asset. It can be other comprehensive income or P&L if it's a revaluation loss. Okay, now a student is saying, sir, treatment of impairment loss is also same. Very well pointed out. The treatment of impairment loss for a revalued asset is also same. Yes, 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 very well pointed out. Okay, what about cost model? Can we net off? In Aditya, in cost model, do we have any revaluation gain loss? Ta-ta. Please check the validity of your question. Okay, now what is the treatment of revaluation reserve? So revaluation reserve has to be transferred to retained earnings. You can transfer at the time of derecognition of the asset, or you can transfer over the remaining useful life. So what is the meaning of these two? Understand. Let's suppose, please understand, I had an asset costing 900k, life was 10 years. Life was 10 years. Okay, so depreciation per year is 90k. 900 by 10 is 90k is a depreciation per year. Okay, now over 2 years, what is the depreciation? 90 into 2 is 180. So what is the carrying amount? 900 minus 180, 720. Here I did a revaluation. The fair value is 960 and the revaluation gain is 240, which is recognized in OCI and accumulated in revaluation reserve. Okay, so now what will happen is, if I have a policy to transfer the revaluation reserve to retained earnings, that is, the entry will be revaluation reserve account debit to retained earnings. To retained earnings. Okay, so now please understand. So when we opt the option number 1, that is transfer at derecognition, then what will we do? Okay, we revalued the asset here, and at the time of derecognition, that is at the end of the life, we will do the transfer. But if we follow transfer over the life of the asset, then what will happen? We will transfer over at year 3, year 4, year 5, year 6, year 7, year 8, year 9, year 10. Every year we will transfer revaluation reserve account debit to retained earnings. Revaluation reserve account debit to retained earnings. How much amount? What is the revaluation reserve? 240. What is the remaining life? 8 years. 240 by 8 is how much? 30. So 30 is the amount to be charged from revaluation reserve to retained earnings every year. Now the standard also says the amount of transfer should be equal to the excess depreciation due to revaluation. Now tell me, what is the amount of excess depreciation due to revaluation? Okay, so prior to revaluation, what is the depreciation per year? 90. Subsequent to revaluation, what is the depreciation? 960. 960 divided by 8 is 120. So what is the increase in depreciation? 30. Right? So 30 is the amount which you transfer every year from revaluation reserve to retained earnings. Now there is a misconception in the student's mind that, sir, this transfer will increase or decrease the amount of depreciation. No bacha, this transfer will not impact the depreciation. Prior to revaluation, you will record 90. Post revaluation, you will record in P&L 120. Okay. In P&L, there is no impact of this entry. In P&L, there is no impact. In depreciation, there is no impact. It is a transfer from revaluation reserve to retained earnings. P&L is not involved in this transfer. Okay. Prior to revaluation, depreciation was 90. Post revaluation, depreciation is 120. That is the amount which will be posted in P&L as well. Is that clear, everyone? Is that clear, everyone? Now, depreciation. So depreciation is the systematic allocation of depreciable amount. Now, what is the meaning of depreciable amount? So depreciable amount means cost minus residual value. Cost minus residual value over the useful life. Now the examiner can confuse you with the useful life and economic life. Please understand, useful life and economic life are two different things. We should depreciate the asset over useful life and not economic life. Okay, depreciation can be done as per straight line method, written down value method, or machine hour rate method. Okay, now depreciation, where do we recognize depreciation? Ideally in P&L operating category. Okay, the methods of depreciation, residual value, useful life are all estimates. Now tell me, whenever the estimates changes, we account for it retrospectively or prospectively? Come on guys, tell me. Whenever the estimates changes, we account for it retrospectively or prospectively? We account for it prospectively. Okay, so we'll say what is the carrying amount now, what is the remaining life, what is the revised residual value. Let's depreciate as per the revised values. That's all. Whatever has happened in the past, let it happen. Okay, now tell me, will we depreciate land? Land, ideally we do not depreciate. Why? Because the land has a indefinite life. Now depreciation ceases if the asset is classified as held for sale. Component accounting. Understand guys, if there is an asset for which, understand guys, if there is an asset for which there is a significant component which has a life different from the life of the main asset, then we depreciate that component separately. For example, the aircraft has a life of 20 years, but the aircraft has an engine which has a life of 5 years. So we'll depreciate engine over 5 years and rest of the aircraft over 20 years. Okay. Now there is a question coming in. If land has any life, yes, land can have a life if we have taken a land on lease. Okay, in that case we have to depreciate the land over that life. Okay, ideally in general cases land doesn't have a life. Okay, but if the question clearly says that the land is a leasehold land with a life of this much, depreciate the land over that period. Okay, now how do we depreciate the revalued asset? So revalued asset is depreciated fair value of the asset divided by remaining useful life on the date of fair valuation. Okay, now de-recognition of property, plant, equipment. Tell me guys, how do we de-recognize property, plant, equipment? Bank account debit to property, plant, equipment to P and L. Now tell me what amount will go here. In the bank, we will write sale proceeds. In PPE, we will de-recognize at carrying amount. P&L will be the balancing figure. Clear everyone? Clear everyone? Okay. Now, so whenever we de-recognize the property, plant, equipment, we de-recognize the property, plant, equipment at its carrying amount, recognize sale proceeds. Any difference is going to P and L. Now, whenever you de-recognize the asset, you have to do one thing. On de-recognition of a revalued asset, any balance in the revaluation reserve for the de-recognized asset is transferred to retained earnings. Tell me, is that clear everyone? Is that clear everyone? Come on guys, tell me. Now, moving on to the next topic, subsequent costs. What is the meaning of subsequent costs? Subsequent costs particularly mean from the date of purchase over the useful life, if we incur any cost on the asset, what is the treatment of it? Okay, so then the standard says if you incur any cost, okay, that cost will be capitalized if and only if it satisfies the recognition principle. What is the recognition principle? It is probable that the future economic benefits will flow to the entity and cost can be measured reliably. If these two conditions are satisfied, yes, we can recognize and capitalize this cost. In rest all the cases, these subsequent costs will go to P and L. Okay. Now, for example, repairs and maintenance. Okay, so they are day-to-day servicing cost. They just maintain the value of the asset. Hence, they are transferred to P and L, repairs and expense account debit to bank. But now, let's suppose we incur any inspection costs or we do any replacement of a component. Then in that case, we capitalize the cost of the asset with the asset and we de-recognize the old component at its carrying amount. How exactly? So let's suppose I purchased an asset of 100 million. It had two components, turbine and rest of the machine. Turbine was valued at $30 million, life was 4 years. Rest of the machine was valued at 70 million and the life was 10 years. So now tell me, at year end 3, you have to replace the turbine. So now tell me what will happen. At year end 3, what is the carrying amount? So turbine, you will depreciate 30 million over 4 years for 3 years. So depreciation is 22.5. So 30 minus 22.5 is 7.5. Rest of the machine 70 million, 10 years, depreciate over 3 years. So 70 by 10 into 3 is 21. So 70 minus 21 is 49. So this is the carrying amount at year end 3. But now understand, since we are replacing a component, so we'll de-recognize the old carrying amount at its carrying amount, recognize the cost of the new turbine. Okay, and this is the carrying amount of the new turbine, new asset. So what will happen? When we de-recognize the old component, we de-recognize at its carrying amount. When we recognize the new component, we recognize at its cost. What is the cost? The cost of the new turbine is 45 million. So we recognize it at its cost. So at year end 3, total carrying amount was 56.5. We de-recognize 7.5. We recognize 45. Hence, the revised carrying amount is 94. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Okay, now please understand. Please come on, guys, tell me. Give me a thumbs up. Is it clear to everyone till here? Is it clear to everyone till here? Amazing. Now understand, guys. Now please understand. Here, let's suppose there are different modes of acquisition. There are different modes of acquisition. Okay, now please understand. Self-constructed asset. Okay, self-constructed asset, meaning thereby I have got the asset constructed. So far we were assuming that we have purchased the asset. Now we are understanding what if we have constructed the asset. Now the standard is saying the rules are exactly the same whether you purchase or you self-construct. The rules are the same. But please understand, if you self-construct, you cannot capitalize these two items. Any internal profit, no, you cannot capitalize. Any abnormal loss, no, you cannot capitalize. If you incur any normal loss, yes, normal loss you can capitalize. How will we evaluate in the exam whether this is a normal loss or an abnormal loss? It will be given in the question. Okay, whether it is a normal loss or an abnormal loss, it will be given in the question. So if it's a normal loss, capitalize to the cost. If it's an abnormal loss, do not capitalize to cost, rather transfer to P and L. Now if you acquire PPE in exchange, meaning thereby I am acquiring this phone by giving this mouse. Okay, barter. Okay, exchange. So in that case it says you have acquired this asset by giving this one, so you have to record this asset at fair value of this one. Why? Because to purchase this one, you have to let go of this one. So this is your cost, okay. So whatever is the fair value of this one, what you gave is the cost of this one, okay. So now see here, if you acquired PPE in exchange, you recognize the asset at fair value of asset given up. Okay, now difference any is going to P and L. Now here I have identified the list of cost that has to be capitalized to the cost, or it will go to P and L. Okay, you can just simply go through it. Now few exam focus point mistakes which you could do in the exam. Tell me, cash discount, P and L. Overheads, if it is a allocated overheads, admin overheads, it will go to P and L. But if it is a directly attributable overheads, it will be capitalized to the cost of property, plant and equipment. Testing cost will be capitalized to the cost. But if you get any sale proceeds from the goods manufactured in the testing phase, that will be recognized in P and L. Okay, non-refundable taxes capitalized to the cost. Okay, revaluation reserve, you have to understand, revaluation reserve, there are two treatment. You can revaluation reserve to retained earnings, there are two treatments. You can transfer revaluation reserve to retained earnings at derecognition or over the useful life. But please understand guys, if the question is silent whether you transfer at derecognition or over the useful life, then always assume that you have to transfer at derecognition. But if the question specifically mentions the term annual transfer or transfer over the life, then only you have to give option number 2. See, I have written, if the question is silent, nothing is mentioned, use option number 1. If question specifically mentions, then only use option number 2, otherwise not. Tell me guys, is that clear everyone? Come on guys, please confirm. The simple point here is, if the question is silent, then you have to transfer revaluation reserve to retained earnings at the time of derecognition. Okay, but if the question specifically mentions that you have to do transfer annually, then you will do transfer from revaluation reserve to retained earnings over the remaining useful life of the asset. Okay, now let us do the comparative analysis now. Can we do this comparative analysis now? chalo, come on guys. So just by understanding PPE, you can capitalize this to understand investment property and intangible assets as well, because all three are of the same type. Please understand now. Definition. What is the definition of property, plant and equipment? So property, plant and equipment is a tangible asset held for, it is held for either of the three purposes. What is the purpose? Production or supply of goods or services, administrative purposes, or rental to others, and life is more than one period. Come on, done. Now, what is the initial treatment? Initially, we measure it at cost. I believe you know the meaning of cost. We are not required to write it further. Subsequently, you can measure the property, plant, equipment at cost model or revaluation model. Now, the choice of cost model or revaluation model is available on class of assets basis. Okay. Now, what is the meaning of cost model? Cost model means original cost. It means original cost minus accumulated depreciation. Okay. What is the meaning of revaluation model? So in the revaluation model, you revalue the asset, you revalue. But when the carrying amount and fair value differ materially, then in that case you have to revalue. Now when you revalue, where will you record the revaluation gain or loss? So revaluation gain is recognized in other comprehensive income. Revaluation gain is recognized in other comprehensive income and accumulated in revaluation reserve. Revaluation loss is ideally adjusted from OCI, but to the extent there is a balance in revaluation reserve. To the extent there is a balance. If there is no balance, meaning thereby any excess loss will go where? P and L. Now, if you get a loss for the first time, then again it will go to P and L. Tell me, clear everyone? Now, what is the treatment of revaluation reserve? It will be transferred to retained earnings. Now, how will you transfer to retained earnings? Option number 1, at derecognition. Option number 2, over remaining useful life by amount of excess depreciation. Right now, what is the depreciation or amortization? So depreciation or amortization is the systematic allocation of depreciable amount over its useful life. Now tell me, when do we start depreciating the asset? When the asset is available for use. Whether we are using it or not doesn't matter. Tell me, when we derecognize, what is the treatment? Bank account debit to asset to P and L. So in the bank, we will write what? In the bank, we write sale proceeds. In PPE, we derecognize that carrying amount. P&L is balancing figure. Tell me, is that clear? So now we summarize the entire PPE chapter quickly. Tell me, it's a revision of a revision, I can say. Tell me yes or no. Don't you think this is helpful? Come on, guys, tell me. Don't you think this is helpful? Come on, guys, quickly. Come on, tell me. Now, we will use this knowledge to understand investment property. Now, what is the meaning of investment property? Any land or building or both held for what purpose? Rental to others or capital appreciation. Okay. Now understand please. Initial treatment again at cost. Subsequent treatment again at cost model or fair value model or fair value model. But please understand here the choice is not on a class of assets. Why? Because if you have to apply cost model or fair value model, it will be applied to all to all to all investment property, meaning thereby either all the investment property will be at cost model, or either all the investment property will be at fair value model. Clear everyone? Now, cost model, if we follow, like I can write here same as IAS 16 on PPE. The cost model is same. The cost model is same. What is the revaluation model? Revaluation model. Now, here, see, understand, in property, plant, equipment, we used to revalue when the carrying amount and fair value differs materially. But here, we revalue annually. If we opted fair value model, we have to do the fair valuation annually. Now, whether there is a fair value gain or there is a fair value loss, irrespective of that, it will go to P and L only. Okay. Now, not applicable. Since it goes to P and L, is there any revaluation surplus? Nah. Depreciation. So if we follow cost model, I can write here the cost model is same as IAS 16 property, plant and equipment. Derecognition same as IAS 16 PPE. Tell me guys, so in a fraction of second we were able to complete IAS 40. Is that clear to everyone? Come on guys, please tell me. Is that clear to everyone? Come on guys, please tell me. Now you will say, sir, you said that you will be covering few master examples, but you have not covered so far. Master examples means coverage of multiple topics in one example, right? So I will be covering property, plant, equipment, investment property, intangible assets, and borrowing cost. And then will come our first example, master example. Okay. Don't worry. If I have promised, I will cover that. If I have promised, I will cover that. Okay. Now, tell me, is investment property clear? Now what will we do? We'll quickly run through the notes and complete investment property. Come here in the notes, investment property. Do we know the meaning of investment property? Yes. Okay, now understand guys, few important point here. Let's suppose is it helpful for both FR and SBR students? Tell me guys, is it helpful for both FR and SBR students? Yes, I think so. Okay, now let's suppose parent. Subsea. Parent gave a property on rent to subsidiary. Parent gave a property on rent to subsidiary. Okay. Now understand. So in the individual FS of parent, this is called as investment property. In the individual FS of parent, it is called as investment property. But now if we see from the group point of view, this is a property, plant, equipment. Is it clear everyone? Come on guys, tell me. Okay, now done. Measurement principle of cost, initial measurement same, subsequent measurement same. I have discussed the fair valuation model. I believe it is clear everyone. Now fair valuation is clear everyone. Now coming to disclosure. So standard says that you have to disclose, irrespective of whether you are opting cost model or fair value model, the disclosure of fair value is important and you have to disclose. You have to disclose the fair value of investment property. Always. Now comes an important point, that is transfers. Okay. Now one more point, guys, please understand. one more point. Let me just write here one more point. Let me just write that here. Just give me a minute. See, we have very well identified this comparison. In this comparison, just write one more thing. Depreciation is the same, right? If it is a cost model. But understand one more point. I'll write here. No depreciation. Okay, understand here. No depreciation if investment property is measured at fair value model. No depreciation. This is an important point which I believe you should never miss. I will highlight this point also. I will highlight this point. It is an important point. Okay, now further. Yes. Okay, Siddharth Jain has mentioned that also. Very good, very good. Now, coming to the most important topic of investment property, from where a question actually gets tested in the exam, is the transfers. The transfers. Okay, now understand, transfer can happen from investment property to PPE to investment property, or PPE to investment property. It can happen either ways. Let me just give you a quick overview of the things. Okay, now understand. This is your date of transfer. This is your date of transfer. Okay, so please understand. Please understand, if you were following cost here and you have to follow fair value here, then transfer your asset will be at carrying amount. Your asset will be at carrying amount. You will transfer at fair value. You will transfer at fair value, and there will come a revaluation gain. A fair value gain. Now comes the question, what is the treatment of this fair value gain or a revaluation gain? What is the treatment of this? So now we have to see. As per this treatment will be as per the old classification. If the old classification was property, plant, equipment. Now tell me, in property, plant, equipment, where do we recognize revaluation gain? Come on, tell me guys. In property, plant, equipment, where do we recognize revaluation gain? Other comprehensive income. But understand, if the previous classification was investment property, where do we recognize revaluation gain? P and L. P and L. Okay, so please understand. Now, if the transfer is happening from cost to cost, meaning IP at cost to PPE at cost, meaning thereby both are at cost, and the cost model of IP and PPE is same. So just the name will change. There is no change in the numbers. There is no change in the numbers. Now understand, if it is a fair value here and a cost model here, then in that case, fair value on this date will become the cost. Okay, so this is how you have to do the transfer accounting. But for transfer accounting, guys, you need to be very much mindful that you have to do transfer accounting only and only when there is a change in the definition and there is an evidence of change of use. Okay, just if the end management has thought, oh, I need to change the use, but there is no evidence, can we do the accounting of change in use? No, we can't do the accounting in that case. Okay, if there is a change in the use plus there is an evidence supporting the change of use, then only we can do the change of use accounting. Is that clear, everyone? Come on guys, please tell me. Now what I have done here is I have identified all the possible scenarios and I have made a note here. You can just give it a plain read and you will understand each and everything, because I have already discussed that with you now. Okay, so now let us take up one example for transfer case. One example which will give you better clarity on the transfer case. Okay, now On 1st Jan 20x1, Orion bought a building for head office purposes. Head office purpose means property, plant and equipment. Now students are saying break. So let me tell you guys, break will be given at every 1 hour 30 minutes. Okay. So basically at every 1.5 hours, we will have a break of 10 minutes. Every 1 hour 30 minutes, we will have a break of 10 minutes. Now, Orion bought a building for head office purpose, that is property, plant, equipment, for what value? 10 million. Useful life 20 years, zero residual value. Now, on 1st January 20x4, on 1st January 20x4, meaning thereby after x2, x3, x4, meaning after thereby after 3 years, after 3 years, after 3 years, the building is rented to third party, meaning thereby what? Come on guys, please tell me. Meaning thereby what? Investment property. Okay, the fair value on 1st January 2004 and 31st December 2004 is 13 million and 12 million respectively. Okay, VJ Limited has a policy to measure PPE at its cost model and investment property at fair value model. Suggest accounting treatment. So now what happens? We purchased the building here. It was a property, plant, equipment. We purchased for 10 million, life was 20 years. Okay, now what is okay? Now on 1st January 2004, we are transferring from property, plant, equipment to investment property. This is the question. This is the question basically. I believe you have understood the requirement of the question. Now, what happens now? Tell me, from 1st January 2004 to 1st January here, what is the number of years? X1, X2, X3, 3 years. So what is the carrying amount? 10 by 20 into 3 is 8.5 is the carrying amount. What is the fair value on this date? Fair value on this date is 13. So what is the revaluation gain on this date? 4.5. Now tell me, what is the previous classification? Property, plant, equipment. So this revaluation gain will go where? Other comprehensive income, and it will accumulate in revaluation reserve. Right? Now, the fair value here is 12 million. Now tell me, since the investment property is at fair value model, will we depreciate? No depreciation. Will we depreciate? No depreciation. No depreciation. Okay, there will be no depreciation. Now fair value here is 13 million, fair value here is 12 million. So there is a fair value loss of 1 million which will go to P and L. Now let's suppose if not 12 million, this value would have been 15 million. Then what will happen? We will get fair value gain of 2 million to P and L. So basically I want to say in investment property, the fair value gain and fair value loss both goes to P and L only. Is that clear everyone? Is that clear everyone? Now the mistakes. Transfer has to be done only if there is a change of use plus there is an evidence supporting the change of use. The transfer is a change of estimate. Okay, revaluation, or you can say you can say fair value gain or loss will go to P and L. Fair value gain or loss will go to P and L. Okay, now assumption. Okay, now assumption. If question is silent, always assume cost model for property, plant, equipment and fair value model for investment property. If question specifies, very good. If question doesn't specify, then this one. Now one student is saying it will get adjusted from P and OCI. Nobody, since it's an investment property. In investment property, the fair value gain or loss, whether it's a gain or a loss, doesn't matter. Both the gain and the loss of investment property will go to P and L only. Is that clear everyone? Is that clear everyone? Is investment property clear to all of you? Is investment property clear to all of you? Now, can we start a new standard? Intangible assets. Intangible assets. Okay. चलो let's move on to the comparison chart. Okay, what is the meaning of intangible assets? What is the meaning of intangible assets? Okay, these are, you can say, non-monetary assets having no physical substance, having no physical substance. Okay, now these are non-monetary and no physical substance, and now they should meet, you can say, satisfy below 3 criterions. Point number one is identifiability. Point number 2 is control, and point number 3 is benefits. Okay, so now we can say any non-monetary assets which doesn't have any physical substance. For example, WhatsApp, they are non-monetary, they don't have any physical substance. Can we recognize that as our intangible asset? No. Why? Because we do not have a control over it, because we don't have the control over it. Okay, so now these 3 conditions should be satisfied, then only we can say that these are intangible assets. Now, what is the meaning of identifiability? Now, if I separate it from myself, it still has a value. Okay, it is separable. I can separate it from myself and sell it to others, transfer it to others, exchange it to others. Tell me, let's suppose from this YouTube channel, if you separate Vishal Jain, some other person comes and start teaching, will you still watch it? Tell me, guys, come on. Some other random person comes and starts teaching, will you still watch it? No. So is this YouTube channel separable from me? Is it separable? No, it is not separable. Okay, now understand. So identifiability means it should be separable, or it should arise from a legal or a contractual right. For example, I have got the license from the government of India. That arises from a legal right. So it is identifiable. Okay, so identifiability means what? Let me write that here. Identifiability means what? It means it is either separable, or it should arise from legal or contractual rights. It should arise from legal or contractual rights. I am highlighting this point. It is either separable or it should arise from legal or contractual rights. Control means we do control the asset. What is the meaning of control? We have the right to direct how the asset will be used, and we can prevent others from using the asset. Okay, now benefits, we should it is probable that there should be a inflow of economic benefits from the intangibles. Okay, then only we can say it is an asset. Okay, now there is a question coming in from Aman Agarwal. What is the meaning of contractual right? Okay, there is a contract. Okay, and let's suppose I have acquired a tally software, accounting software. Now, there is a contract between me and the accounting software firm, Infosys. Let's suppose Infosys. There is a contract, and this intangible asset arises from this contractual right. Hence, we can say it is an intangible asset. Is that clear, everyone? Okay, chalo. Now, initial treatment is at cost. Just a minute. Initial treatment is at cost, and the meaning of cost remains the same for all three. The meaning of cost remains the same for all three. Now understand. I will say here, please understand. See here, please see here. Subsequent treatment is same as PPE, meaning thereby in case of intangible asset, we have cost model or revaluation model, and the choice of cost model or revaluation model is available on class of assets basis. Okay, now but there is a disclaimer, there is a point, note, there is a point which I can say here. Revaluation model is allowed for intangible assets only if okay it has an active market. Only if it has an active market. What is the meaning of active market? This is a sufficient volume and sufficient frequency for that product. Okay, now tell me, brand name, do we have a active market for brand name? Do we have an active market for brand name? No, we don't have active market. So for a brand name, can we value, brand name is an intangible asset, can we value this brand name at fair value model, revaluation model? No, we can't. Okay, now understand. One more note. One more note. Guys, tell me, is this comparative analysis helpful? Okay, now understand, guys. Note, for an asset, for a class of asset under revaluation model, okay, for a class of asset under revaluation model, if there is any asset, okay, for which active market does not exist, okay, then keep it at cost model. Meaning thereby the entire class is at revaluation model. But in that class there is one asset, there is one intangible asset for which there is no active market. So then the standard says that entire class of assets will be at revaluation model, but just that asset will be at cost model. Is that clear, everyone? Okay, how to know if there is an active market? Very good question, Siddharth. So for active market, we need to evaluate. What? Sufficient volume and frequency of trading. Okay. Is it clear? Now? Now, example of an active market exists. You can say accounting software. I have purchased an accounting software from the market. Okay, I have purchased any software from the market. Okay. Now, cost model, I will say same as PPE. Revaluation model, I will say same as PPE. Treatment of revaluation gain, I will say same as PPE. Treatment of revaluation reserve, I will say same as PPE. Depreciation, it says it is not depreciation here. No, it is not depreciation here. Just a minute. It is called as amortization here. Okay. Depreciation is for the tangible assets. It is called as amortization here, but the methods is same as PPE. Okay, derecognition again I can say same as PPE, same as PPE. Tell me, is it clear, everyone? Is it clear, everyone? Okay, now in intangible asset, I can just say other topics. So in investment property, other topics which we studied is classification of investment property and transfers. Okay, in intangible asset, we have to study few other topics which are as follows. We can say self-generated intangible assets, research and development costs. Okay, research and development cost. What else? Anything else? I think that's all, but still let me run through it. Yeah, that's all. So these two are the topics which we have to study separately for intangible assets. Okay, now there is one more topic for annual impairment. Okay, so these are the three topics which we have to study separately for intangible assets. Okay. Now, one query: if no active market, then the assets has to be at cost model. Yes, if there is no active market, we cannot go for revaluation model, but we can definitely keep it at cost model. We can definitely keep it at cost model. Okay, just let me see, since there's a doubt coming in from this one, but though not that great a topic, but still if there's a doubt coming in, let me take it up. See here, for an intangible asset, there are, let's suppose, 4 classes. There are 4 classes. 1, 2, 3, 4. Okay, now understand, this is brand name, active market doesn't exist, hence this is at cost model. Okay, now again, this is a software. Okay, for which active market exists, hence it is at revaluation model. This is patents, trademarks. Okay, now active market doesn't exist. Now, so since they are at cost model. Now, for these, since they are at cost model, all the intangible assets in this class of asset, will be at cost model. Now, for this software class, it is at revaluation model. Why? Because active market exists. Okay, and entity has chosen for revaluation model. Understand, guys? Just because active market exists doesn't mean it becomes necessary to measure it at revaluation model. No. If entity says, even if active market exists, I want to measure at cost, yes, entity can do that. Okay, but let's suppose entity has opted for revaluation model. Okay, now in this one, there are S1, S2, S3, S4, S5. It is at revaluation model. But for this software particularly, there is no active market. So then this one will be at cost model. This is what I am trying to say. I believe it is clear now. Moving on to my next topic, that is research and development and self-generated intangible assets. There is a query coming in the chat box again and again. Brand name should not be recognized in SOFP. Guys, understand, if you just try to mug up things, you will say, okay, please understand, if brand name is self-generated, yes, we will not recognize. But please understand, if brand name we have purchased in a business combination transaction, we can account for it. If brand name we have purchased it from the market, we can recognize it. Brand name which is self-generated is not recognized. Why? Because there is no cost that is there for that asset. Since there is no cost for self-generated brand name, hence we don't recognize. But if we have purchased a brand name from the market, we can recognize that. We can recognize that. Okay. Now, let me just complete 2 topics for this intangible asset. We will be done with this chapter and then we can have a break. Okay. Just give me 5 minutes. Just give me 5 minutes, please. Self-generated intangible assets, can we recognize it? No. Why? Because the cost cannot be measured reliably. Cost cannot be measured reliably because it is self-generated. We have not generated it. It automatically got generated. Like for example, I am helping you with the revisions. Let's be honest. Let's be honest. Why am I helping you with these revisions? Come on guys, tell me. Intent number one, I am helping you so that my students get the value of it. Now, if you are getting the value of it, you will recommend my name to upcoming students. Tell me yes or no. You will recommend my name to your juniors. That yes, I attended one revision marathon of Vishal sir and he explained everything in an amazing manner. So if you are considering for FR or SBR classes, you can consider Vishal sir. Right? Let's be honest. Let's be honest. Okay. So now, understand now when I'm working, is there any cost being incurred? Tell me, is there any cost being incurred? No. But my brand name is being developed. My brand name is being developed. Now tell me, can I recognize this brand name in my books of account? No, I cannot. Why? Because I have not incurred any cost for that. I have not incurred any cost for that. Okay. You got my point? Now, so self-generated intangible assets, clear everyone? Self-generated intangible assets, is it clear everyone? Now coming to internally generated intangible assets. Now internally generated intangible assets, guys, has 3 phases. Please understand. I have summarized here. Has 3 phases: research phase, development phase, developed phase. First of all, understand the treatment of each of the phases. Research phase means whatever cost you incur in the research phase will be recognized in P&L. Expense off. But in development phase, whatever cost you incur is capitalized. But tell me, will you amortize it? You will definitely capitalize all the costs that you incur, but will you amortize it? No, you will not amortize. Why? Because it is not yet available for use. Okay, it is not yet available for use, so you will not amortize. Now, since you are not amortizing it, you have to test it for impairment annually. At each, you can say annually, annually, you have to test it for impairment. Annually. Okay. Now comes the question, sir, how will we evaluate whether the phase has changed from research to development? Standard says that if the pie rate is satisfied, we understand that we have entered development phase. What is the meaning of pie rate? There is a probable economic benefits. There is an intention to complete, resources to complete, ability to complete. There is a technical feasibility and expenditure can be measured reliably. Okay, pie rate means P means probability of future economic benefits, I means intention to complete, R means resources to complete, A means ability to complete. Okay? T means technical feasibility and E means expenditure can be measured reliably. If all the conditions are satisfied, we can say that we have entered the development phase. Now understand, guys. Okay, now this holds good from an SBR point of view. So SBR students, if you have to write about which phase you are in, you can write about these pie rate. Now from an FR point of view, when you are solving section A or a section B question, okay, how will you identify in the question? The question will definitely not talk about the pie rate in depth. So you have to find few words. What? When does the director become confident of the success? Okay. So now the question will say, we started the project on this date. Here the technical feasibility is passed. Here the directors become confident of the success. Here we completed the development. Tell me, which cost will you capitalize? From here to here? No. This will not. Okay. This will not be capitalized. This will not be capitalized from here till here. From the date when the director became confident of the success till the time the project is completed, we capitalize all the costs. We capitalize all the costs. Okay. Now, how will you evaluate whether we have entered from development to developed when the asset becomes available for use? Okay. So now in the developed phase, we just amortize the asset and we test for impairment only if impairment indicators are triggered. Is it clear, everyone? Come on, guys, tell me, is it clear, everyone? Let us take up an example on this one. See, I have taken up an example. Please understand. This is your research phase. So the cost incurred is transferred to P&L. This is your development phase. Okay. Now in the development phase, the cost that is incurred 900 is capitalized and we test it for impairment. Carrying amount is 900, recoverable amount is 1000. So there is no impairment loss. Carrying amount remains at 900. We further incurred cost of 6000 and the carrying amount becomes 6900. Okay. Now it becomes available for use now. So it is entered developed phase now. In the developed phase, we have to amortize the asset. We have to amortize the asset. So we have amortized. The asset was under development phase. So did I amortize? No. So under development phase, there is no amortization. There is no amortization. Is that clear, everyone? Is that clear, everyone? Okay. Now, annual impairment review. Annual impairment review. Okay, there are 3 assets for which we do annual impairment review. Now tell me, guys, ideally the impairment has to be tested. Ideally the impairment has to be tested when the impairment indicators are triggered as per the provisions of IAS 36, impairment of assets. The impairment testing has to be done when the impairment indicators are triggered. When the impairment indicators are triggered. But now for these 3 assets, we have to do annual impairment testing irrespective of whether impairment indicator is triggered or not. What are these 3 assets? First one is goodwill. Second one, intangible assets with under development phase. Just now we studied under development phase. And intangible assets with infinite useful life. Okay, infinite useful life. In an intangible asset for which there is no useful life, for which useful life cannot be determined, okay, for these 3 assets we do not amortize. For these 3 intangible assets we do not amortize, rather we test them for impairment annually at the same time every year. I believe it is clear to all of you. Now there is one query coming in, a wonderful query. So student is saying, sir, let's suppose asset is developed, asset has completed development here. Development is done here. Let's suppose on 31st December 20x4. But the entity has started using the asset from you can say 1st of June 20x5. So from 31st December 20x4 till 1st June 20x5, will we amortize it? Is this your question, Nikhil? So now to answer this, I can say we will still amortize for this period. Why? Because the asset was available for use. Whether you have used it or not doesn't matter. Okay, the asset was available for use. You have to depreciate it. You have to amortize it. Is it clear? It will be amortized. It will be amortized. It will be amortized. Okay, because it was available for use. So this completes our intangible assets as well. This completes our intangible assets as well. And few students has been asking for break from a longer period of time, and considering their request, tell me how much time of break do you need? How much break do you need? Tell me guys, how much break do you need? Whatever you say, I will accept it. Come on, tell me. Chalo, a break of 15 minutes. Guys, don't go anywhere. Be here in the class. Tell me, are you enjoying the session? I need an feedback. Tell me, guys, are you enjoying the session? Are you enjoying the session? 15 minutes is an appropriate time, nothing more, nothing less. See you guys in 15 minutes, okay? Don't go anywhere, be in the class, and we will rock FR and SBR, guys. See you in 15 minutes. Come on, guys. Let's start. Let's start. Let's resume. Come on, guys. Just a minute. How is the juice, guys? Come on, come on, come on, everyone in the chat box. Come on, guys. Tell me in the chat box how the juice. Now, let's start the session now. Is everyone back from break? Is everyone back from break? Everyone, come on, guys. Tell me. Hello. Let's start. And the juice should be high. The juice should be high. Okay. Now, let's start. So now we are studying borrowing costs. Now what happens generally in the borrowing cost? Tell me what is the general treatment of borrowing cost? What is the general treatment of borrowing cost? Come on, guys, please tell me what is the general treatment of borrowing costs? So borrowing cost is recognized in P&L as an expense in the financing category, right? Borrowing cost is recognized as an expense in P&L, right? But now the standard is saying if the borrowing cost is incurred, if the borrowing cost is incurred on a loan, borrowings taken for the construction of a qualifying asset, okay, for to construct a qualifying asset, if you have taken any loan, then interest borrowing cost incurred on that is capitalized to that asset. Now there are few inclusions and exclusions of borrowing cost. So borrowing cost basically means it can be an just a minute. Borrowing cost is interest expense, interest for the lease liabilities, interest on bank overdraft, premium on redemption of share capital, discount on issue of convertible debts. All these are examples of interest costs. Okay, now these are not borrowing costs. Dividend paid on irredeemable preference shares. Borrowing cost incurred for the purpose other than construction, not eligible for capitalization. Okay, now what is a qualifying asset? Any asset which takes substantial period of time to develop is called as a qualifying asset. Now in this context, we have to study few things. When do we start capitalizing the borrowing cost? Okay, when do we cease the capitalization of borrowing cost? So please understand, commencement, cease, and in between we can suspend. Tell me, we can commence the capitalization when all the three conditions are satisfied. Can you please name all the three conditions? The company is incurring expenditure, the company is incurring borrowing costs, and the construction activities has started. The date when all the three is satisfied, we can start the capitalization from that date. When all the three conditions are satisfied, Now when I say construction activities, does it mean physical construction? Not necessarily. Even if we are planning the construction activities, that also means the construction activities has started. Okay, it need not necessarily be the physical construction. Okay, it need not necessarily be the physical construction. See, I have written here, please see. Activities necessary to prepare the asset for its intended use or sale. It includes technical and administrative work prior to physical construction. It need not be physical construction only. Okay, now let's suppose I'm giving an example. Let's suppose technical planning started here, physical construction started here. Tell me what will be the date of capitalization starting here. Another example, physical construction started before and then we started planning. Again, we'll start capitalizing it from here. Okay, start capitalizing it from here. I believe it is clear. When to commence. Now when to cease? When to cease? When the construction is completed. When the construction is completed, we cease the capitalization of borrowing cost. We cease the capitalization of borrowing cost. Okay. Now when do we suspend? When the work stops. So we have to see the work is stopping due to what reason. If the work stops due to normal reasons, we do not suspend. We do not suspend the capitalization. But if the work stops due to abnormal reasons, then we have to suspend the capitalization. We have to suspend the capitalization. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? The commencement, suspension, and the cessation. Now, one more concept, guys. One more concept for all of you. Please understand. Let's suppose this is the date of commencement of capitalization. This is the date of cessation of capitalization. So basically we call this period as period of capitalization. Now if we incur any borrowing cost here, let's suppose I have taken the loan here itself and we incur any borrowing cost here. Now whether it is a general borrowing or a specific borrowing, irrespective of the same, the borrowing cost will be recognized in P&L. Now similarly here, okay, if we incur any borrowing cost, irrespective of whether it is a specific borrowing or a general borrowing, it will be transferred to P&L. Is that clear, everyone? Is that clear, everyone? Now in this period, what will happen? Understand, guys, please. If it is a specific borrowing, for this period, we will capitalize whatever is the actual borrowing costs incurred. Whatever is the actual borrowing cost incurred, irrespective of how much funds and when we have utilized the funds, irrespective of date of utilization. Let's suppose we have taken a loan of 10 million. We utilize 7 million here. We utilize 3 million here. No, but if it is a specific borrowing, we take the interest of 10 million entirely for this period. Doesn't matter when and how much amount we have utilized. Okay. Now less any investment income. This is the amount to be capitalized. This is the amount to be capitalized. But if it is a general borrowing, we take borrowing costs on the basis of date of utilization of funds. Okay, and do we adjust investment income here? No. And this is the amount to be capitalized. Is that clear? The difference between general borrowing and specific borrowing, is that clear to all of you? Come on, guys, tell me the difference between general borrowing and specific borrowing. Is that clear to everyone? Okay, now let us come here. Please understand, in specific borrowing, what we take is actual borrowing cost incurred minus investment income on temporary investment of these borrowings. Now if it is a general borrowing, we take first of all, we have to calculate the capitalization rate. Why are we calculating the capitalization rate? Because there can be multiple general borrowings. Let me take up an example. Let's suppose I have a 10% borrowing one of $10,000. I have 12% borrowing two of $15,000. These two are the general borrowings. So I have to calculate capitalization rate. How will I calculate capitalization rate? It is the average interest rate, average borrowing rate. So basically tell me, what is the total borrowing cost incurred? 10,000, 10% is 1,000. Plus 15,000, 12%, it is 1800. divided by, this is the total borrowing cost incurred divided by total borrowing cost is 25,000. So what is the capitalization rate? 2800 divided by 25,000, it is 11.2% is the capitalization rate. 11.2% is the capitalization rate. Now again guys, please, again I'm explaining one point here, please try to understand. Please try to understand, this is the most important part of this chapter. In case of specific borrowing, we capitalize the actual borrowing cost during the period of capitalization less investment income. Okay, take total borrowing cost for the period of capitalization irrespective of whether the funds were utilized or not. Doesn't matter when and how much funds you have utilized. In case of specific borrowing, whatever is the actual borrowing cost incurred for the period of capitalization, you capitalize the whole of the amount less investment income. In case of general borrowing, what happens is, take borrowing cost for the period of capitalization considering the date of the funds when were they utilized. Now I have taken an example to explain this point. Okay, let's suppose I have taken a loan of 9% here. I started expenditure of 7 million here. So this is my period of capitalization. Please understand, this is my period of capitalization. So any borrowing cost incurred in this period is transferred to P&L. Any borrowing cost incurred in this period is transferred to P&L. So now I am considering only and only this period. Okay. Now please understand guys. Okay, now we have, if this was a specific borrowing case, then what will I say? Tell me how much loan I have taken. I have taken a loan of 10 million. I have taken a loan of 10 million. What is the period of capitalization from 1st May till 31st December? So May, June, July, August, September, October, November, December. How many months? 8 months. So actual borrowing cost is 10 million, 9%, 8 by 12. Actual, right? Now you can earn investment income on the temporary funds. So how much funds were temporary? So you have taken a loan of 10 million, but from this date till this date 3 million funds were idle funds, right? Because you utilized only 7 million, 3 million funds were unutilized. So from here till here, what is the period? May, June, July, 3 months, right? So 3 million, 3 by 12, investment will be at 5%. So 5% investment income. So this is the amount to be capitalized. But if this question we will solve as per general borrowing, then what will I say? 7 million for 8 months. 3 million for August, September, October, November, December, 5 months. 3 million for 5 months. 7 million for 8 months, 3 million for 5 months. 9%, this is the amount to be capitalized. So basically, in case of specific borrowing, we do not consider when the funds were utilized, but in case of general borrowing, we do consider when the date when the funds were utilized. Is that clear, everyone? Come on guys, please tell me, is it clear, everyone? Now, having discussed this, now I think I can move on to a master example. Tell me guys, do you want to solve a master example now? How do we recognize if it is general borrowing or specific borrowing? Question will specify that. Question will say the loan has been taken specifically for this construction, specific borrowing. The loan, these were the general loans that the companies had. Okay. When to find capitalization rate? So capitalization rate has to be found only for general borrowings. Just a minute. Let me go to the master example. Non-current assets. So this is a master example. So let us read the question. And try to solve it. Let us try to read and solve it. Okay, draw. Now, on 1st October 2006, Omega began the construction of a new factory. The cost relating to the factory incurred in the year ended 30th September 2007 are as follows. So these were the cost incurred: purchase of land, the cost of dismantling existing structures, purchase of material, employment cost, production overheads, allocated admin overheads. Now tell me guys, which cost we have to capitalize? Can we capitalize purchase of land? Yes. Can we capitalize cost of dismantling? Yes. Can we capitalize purchase of material? Yes. Can we capitalize employment cost? Yes. Can we capitalize production overheads? Yes. Can we capitalize allocated overheads? No. Can we capitalize architect cost? Yes. Can we capitalize cost of relocating? No. Can we capitalize formal opening? No. Can we capitalize interest on loan? Yes. Okay, now let us read the notes. There were certain notes for employment, there are certain notes for production overheads, there are certain notes for interest on loan. So there are 3 notes. So let us read that. Okay, and then I will write. So let me write that. First of all, whatever data we have: purchase of land, can we capitalize it? Yes. Cost of dismantling? Yes. Purchase of material 6,000? Yes. Employment cost 1,800? Yes. Production overheads 1,200? Yes. Allocated overheads? No. Then architect fees 400? Yes. Then relocating 300? No. Formal opening? No. Interest on loan 1,200? Yes. Let's read the question further. Now, the factory was constructed in 8 months ended 31st May 2007. It was brought into use on 30th June 2007. The employment costs are for 9 months. Now tell me, the construction period is for 8 months. So can we capitalize the employment cost for 9 months? No. We have to do for 8 months only. So these employment costs are for 9 months. So how to do it off? So what I say is, this is for 9 months. Let us take for 8 months. So divide by 9, multiplied by 8. Done. Now the extra for 200 will go to P and L. Will go to P and L. It will go to P and L as salary, employee benefit expense. Okay. Now the production overheads were incurred in the 8 months ended 31st May 2007. They included abnormal cost. Tell me, can we capitalize abnormal cost? Can we capitalize abnormal cost? No, we can't. No, we can't. So production overhead has 200 as abnormal cost. So minus 200. Abnormal cost. So this 200 will also go to P and L. Okay. Now Omega received a loan of 12 million on 1st October 2006. Now this loan was received on 1st October 2006, 12 million, right? The interest rate on the loan was 10%. So this interest of 1200, don't you think it is for the entire year? It is for the entire year. 12 million multiplied by 10% is 1200. But we have to capitalize only for the period of capitalization. This is a specific borrowing. This is a specific borrowing, right? So we have to take only for the period of capitalization, right? So what will I say? So this amount is for the entire 12 months, but we have to take only for the period of capitalization, that is 8 months. So into 800. Okay. Now, so this is also done. Point number 4, the factory has a useful life of 20 years, after which it will be demolished and the site returned to its original condition. This legal obligation arose on signing of the contract to purchase the land. The expected cost of fulfilling this obligation are $2 million, and appropriate annual discount rate is 8%. The present value of 20 years is 21.5 cents. So basically it will be present value of decommissioning costs. Decommissioning cost. What is the decommissioning cost? 2 million. So amounts are in thousand. So I can say 2000. What is the present value? Present value is 21.5 cents. So you can write 0.215. Okay. So it is 430. So this is the cost of the factory. This is the cost of the factory. Now all the general overheads, it will go to P and L. It will go to P and L. These two will go to P and L. Tell me, is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Tell me, guys, is it clear? So now tell me, master questions like this, you can you have revised borrowing cost and property, plant, equipment, both using this question. Tell me, did it help you? It helped you or not? Tell me, guys. Come on. Tell me, please. Was it helpful? Was this question helpful? Why is relocating cost not included? It is not included because it is not a cost to bring the asset in the intended location. Okay. It is incurred after the asset is capitalized. It is incurred after the asset is capitalized. Balance month's interest. Balance month's interest 400 will go to P&L. Okay, chalo. Now let us come to the next chapter. Da, 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 da. We are studying now impairment of assets. Now we are starting impairment of assets. I mentioned interest on loan balance months will go to P&L. Guys, can I request you one thing? Tell me. I am giving this gold mine for free to all of you. Can I request something in back, something in return from you guys? Tell me, guys. Can I request something in return from you guys? Not money, not money, not money. Definitely. Can I request something in return from you guys? Can I ask something? Tell me. Can I ask something? Only if you guys allow me, I will include something. I will ask something from you guys. Okay. So I want this session to reach maximum number of ACCA students. My intention is this session should reach maximum number of ACCA students. Okay. So can you guys, once the session ends, can you guys share a feedback of this session on your LinkedIn or Instagram, wherever you can, wherever possible. Okay. The LinkedIn ID, my LinkedIn ID, my Instagram ID is given in the description box of this session. Can you please share a feedback, an honest feedback? Okay. Even if it is a negative feedback, share a negative feedback, but share an honest feedback of yours. Okay. Whatever you felt, if it helped you, Instagram story or a LinkedIn feedback, whatever helps. Okay. My Instagram and LinkedIn both are in the description box. Can you do that? Not now, definitely not now, after the session. चलो ठीक है. Now we are starting a new topic. Okay. Impairment of assets. Tell me, when do we impair the asset? So when the asset is not fully recoverable. When the asset is not fully recoverable, we impair the asset. Okay. Now please understand. So meaning thereby, when the recoverable amount of the asset is lower than the carrying amount. See, carrying amount is here. Recoverable amount is here. See, I am in between. Carrying amount is here. Recoverable amount is here. Okay. So if this is the case, the carrying amount has to be reduced. The carrying amount has to be reduced down to its recoverable amount. And this process of reduction in the value of the asset is called as impairment of asset. This process of reduction in the value of the asset is called as impairment of asset. Okay, it's called as impairment of asset. Now, so what is the process of impairment? Please understand a very, very, very important thing. What is the process of impairment? So now understand, at each reporting date, do we need to test the asset for impairment? Do we need to test this asset for impairment? No. At each reporting date, entity shall assess if the impairment indicators are triggered or not. Okay, we just need to evaluate whether the impairment indicators are triggered or not. Okay, if the impairment indicators are triggered or not. If the impairment indicator is triggered, then you have to test for impairment. But if the impairment indicator is not triggered, nothing, story closes there. Okay, if the impairment indicator is triggered, you evaluate the recoverable amount, and if the recoverable amount is less than the carrying amount, okay, meaning thereby, let's suppose I purchased this calculator for $100, but now the value is only $20. It's a loss. 100 to 20, 80 is the impairment loss. 100 to 20, 80 is the impairment loss. Okay, now So what is the meaning of recoverable amount? What is the meaning of recoverable amount? Recoverable amount is the higher of fair value less cost of disposal and value in use. Sorry guys, just give me a minute please. Okay. Recoverable amount is higher of fair value less cost of disposal and value in use. Now understand, how do you compute fair value less cost of disposal? Okay, so the fair value as per IFRS 13 minus costs to dispose of the asset, minus cost to dispose of the asset is called as fair value less cost to dispose or cost to sell. What is the meaning of value in use? What is the meaning of value in use? So value in use is the present value of cash flows. Which cash flows? Which cash flows? Cash flows from use, cash flows generated from use of the asset, and residual value. These cash flows you have to compute the present value. These cash flows you have to compute the present value, and the present value is your value in use. Okay, the present value is your value in use. You have to compare both. The higher is your recoverable amount. The higher is your recoverable amount. Let me give you a quick understanding here. Value in use, fair value less cost to sell, higher is your recoverable amount. Compare this with the carrying amount. Okay, now in this comparison, if recoverable amount is more than carrying amount, nothing will happen. If recoverable amount is equals to carrying amount, nothing will happen. But if recoverable amount is less than carrying amount, the asset is not fully recoverable, then we impair the asset. And we recognize impairment loss. Now tell me, what is the accounting treatment of impairment loss? Come on guys, tell me, what is the accounting treatment of impairment loss? Can you please tell me what is the accounting treatment of impairment loss? So standard says, if the asset is under cost model, if the asset is under cost model, okay, then in that case, the journal entry will be P&L account debit to asset. P&L account debit to asset. P&L means impairment loss. I can say impairment loss. P&L debit to asset. But if the asset is under revaluation model, then in that case, journal entry will be impairment loss OCI to the extent there is a balance in revaluation reserve. I remember some student was saying, sir, the treatment of impairment loss, is it same as that of revaluation loss? Yes, beta, yes. Okay, now to the extent there is a balance in revaluation reserve, we adjust the impairment loss with OCI. Any excess impairment loss will go to P&L. Is the treatment of impairment loss clear to all of you? Is the treatment of impairment loss clear to all of you? Come on guys, please tell me, is the treatment is clear to all of you? Now on this treatment, I have a question for you guys. Let us solve that question first of all. Do you want to solve the question? Come on, tell me guys. Do you want to solve the question or shall I skip it? No, let us solve it, sir. Let us solve it. Okay, let us solve. Chalo. Now, so carrying amount, it's a very simple question. Carrying amount of the machine is 600. Recoverable amount of machine is 400. Okay, so right here, carrying amount 600. Recoverable amount is 400. So what is the impairment loss? Tell me. What is the impairment loss? Come on guys, tell me. What is the amount of impairment loss? 200. Okay, now suggest accounting treatment if the machine is under cost model. Okay, A. If the machine is under cost model, then what you will say? Then what you will say? The treatment will be, if the machine is under cost model, if the machine is under cost model, okay, it is impairment loss, P&L account debit to asset credit. How much? 200. Okay, now, but if the machine is under revaluation model, then what will happen? So let me write here B, revaluation model. Okay, then what will happen? Then first of all, we adjust with OCI to the extent there is a balance in revaluation reserve. What is the balance in revaluation reserve? 150. So what will I say here? So in OCI, come on guys, tell me, what is the loss that will go to OCI? What is the loss? 150. And what is the loss will go to P&L? The excess. What is the excess? 50. Done. Is it clear, everyone? Is it clear, everyone? Come on guys, tell me. Now, since we have studied this concept, now we can directly move to one more question. Do you want to solve one more question? Tell me, guys. Not today, you only tell me. If you will tell me, then only I will solve. Otherwise, I will not solve. Tell me, you want to solve one more question? Yes. Sir, CGU. What is the concept of CGU? Can anyone tell me what is the meaning of CGU? What is the meaning of CGU? Can you tell me, guys? Come on. What is the meaning of CGU? Cash generating unit. So cash generating unit is the smallest identifiable group of assets. Cash generating unit is the smallest identifiable group of assets capable of generating independent cash flows. Okay, now, so when we have to test the entire CGU for impairment, then how do we impair the CGU? So we have to say, so these are the assets in the cash generating unit. So what is the total carrying amount? Tell me, bacha party. What is the total carrying amount? Equals to sum. Why is my laptop not responding? One to 6.5. Okay. So what is the recoverable amount? Recoverable amount is given as 1130. See here. 1130. Now, please don't ask me, sir, from where you got this recoverable amount. Yes, I am Bacha Buddy, you guys are Bacha Party. Done? I am Bacha Buddy, you guys are Bacha Party. Okay, now what is the impairment loss? Tell me, what is the impairment loss? This carrying amount minus recoverable amount. See here. Carrying amount is more, recoverable amount is less. The asset is not fully recoverable. Hence, we have to impair the asset. Now, tell me where to recognize this impairment loss. First of all, where? Tell me where. Come on, tell me. Where? Tell me, come on. Where do we recognize? So now you will say goodwill, which is wrong. So first of all, to specifically impaired asset. If there is any specifically impaired asset, first of all to that. In this question, there is no specifically impaired asset. Second, to goodwill. Tell me, What is the amount of goodwill here? 90. 90. So how much to goodwill? How much will go to goodwill? 90. Now, then the remaining impairment loss. What is the remaining impairment loss? So total impairment loss was 135, out of which we have already transferred to goodwill 90. Remaining is 45. So this remaining impairment loss will be allocated to remaining applicable assets in the ratio of their carrying amount. In the ratio of their carrying amount. Now tell me, let us discuss which assets are applicable, which assets are not applicable. Do we impair building under IAS 36? Yes. Do we impair plant and equipment? Yes. Do we impair goodwill? Yes. But goodwill we have already impaired, right? Goodwill is already impaired. So let's remove goodwill. Let's remove goodwill. Okay. Now inventory is in the scope of IAS 36? Nah. No. Trade receivables? Nah. Biological assets? No. Deferred assets? No. Okay, so only building and plant and equipment. Building and plant and equipment. Only these two. Okay. So now what happens? Remaining impairment loss will be allocated to building and plant and equipment. Okay. In the ratio of their carrying amount. So how will you allocate? So 45 multiplied by 700 is the carrying amount of building divided by total 700 plus 200. Now plant and equipment is 45 multiplied by carrying amount is of plant and equipment is 200, right? So this is what. So now can you please tell me what is the allocation? What is the allocation? Just a minute. Let me copy it. Copy. Is equals to 35. Let me copy this also. Right? So now let us prepare the impairment schedule. Hey, what has happened? Let us prepare. Sorry. Yes, copy. Prepare the impairment schedule. So this was the carrying amount. Now the rest is the impairment loss. Now the revised carrying amount. Okay, so now what is the impairment loss allocated to building? 35. What is the impairment loss allocated to plant and equipment? 10. What is the impairment loss allocated to goodwill? Minus 90. Inventories 0. Trade receivable 0. Biological assets 0. Deferred tax assets 0, because the impairment of these assets are covered in their respective standard. Okay, because the impairment of these assets are covered in their respective standards. So what is the revised carrying amount? Is equal to this. Done. Is it clear, everyone? Tell me, guys, is it clear, everyone? Come on. Please tell me, is it clear, everyone? Is it clear, everyone? Right? Now there is a question. If it was a bearer plant, then yes. If it was a bearer plant, then it would have been an applicable asset to which we would have allocated the impairment loss. Okay. Chalo. Cool. Coming back to our notebook. Now there is one concept still remaining. There is one concept still remaining of the reversal. Just a minute. Let me come back to my notebook. Yes. Mera pen ye raha. Okay. Now there is one concept still remaining for the reversal of the impairment loss. Can you give an example of a specifically impaired asset? Yes, I can give you the example. So please, if the question says, let's suppose okay, let me go back to that screen. If the question says the building having a carrying amount of 700 has a amount of only 650 is recoverable from this building. So you know what will happen? Out of 135, first of all, transfer 50, allocate 50 to building, allocate 50 to building. Okay, then remaining 85 will be allocated to goodwill. Remaining 85 will be allocated to goodwill because building is now a specifically impaired asset, is now a specifically impaired asset. Okay. Now let's come to this question. Come on, guys. I think I am going in a much depth of it. Cost was 100 million, life was 10 years. At year end 2, what should be the carrying amount? Come on, tell me, guys. 800. Sorry, 80. Recoverable amount is 90. Is there any impairment loss? Is there any impairment loss? No impairment loss. No impairment loss. Okay, now year end 6, what should be the carrying amount? 40. The carrying amount is 40, but the recoverable amount is 30. Now, is there any impairment loss? Yes. How much? 10. How much impairment loss? 10. Okay, now, okay. So what is the revised carrying amount? 30. What is the remaining life? Remaining life is 4 years. So what is the depreciation per year? 7.5. Now, year end 8 means 7, 8, 2 years. So what is the depreciation? 7.5 into 2 is 15. So carrying amount is 30. Carrying amount here is 30. 30 minus 15. The carrying amount should be 15. But now here the impairment indicators have reversed and the recoverable amount has increased to 20. So now you have to reverse the impairment loss. But comes the question, how much? Now I teach which using a very simple logic. This was the lifespan of the asset. It was 100 here and the asset value becomes 0. Okay, asset value becomes 0. So when you purchase the asset is 100, then it becomes 90, 80, 70, 60, 50, 40, 30, 20, 80, 0. It becomes 0 till the end of the life of the asset. Right now, when we depreciate, when we impair, the value of the asset reduces. The value of the asset reduces. And now this is the life cycle of the asset. This line is now the life of the asset. Now let's suppose here at a point when you want to reverse your impairment loss, okay, and now, so let's suppose here carrying amount is 15. Okay, then tell me, can the reversal go beyond this line? Reversal means what? Going back to original. Original was this line. So can the reversal go beyond this line? No. So can you please tell me what would have been the carrying amount if the asset was not impaired originally? What would have been the carrying amount if the asset was not impaired originally? Tell me, guys. Okay, at year end 8, what should have been the carrying amount? It would have been 100 minus 100 by 10 multiplied by 8. It should have been 20. Just a minute. You make recoverable amount is 25. Okay, the carrying amount would have been 20. The carrying amount would have been 20, but the recoverable amount is 25. Tell me, can I reverse from 15 to 25? Tell me, guys, come on. Can I reverse from 15 to 25? Can I reverse from 15 to 25? No. The maximum limit is 20. So the maximum reversal allowed is till this one. So reversal is only 5. This reversal is not allowed. So now if you see here the text of the standard, it says for the reversal of impairment loss, maximum reversal is restricted to lower of the following: recoverable amount or the carrying amount of the asset had there been no impairment originally. Now in our case, the recoverable amount was 25. The carrying amount had there been no impairment earlier was 20. So lower is 20. So maximum we can reverse till 20. Our carrying amount was 15. So what is the reversal? What is the gain? Reversal gain 5. Reversal gain 5. Now let us take one more example. Okay, let us take one more example. had there been a scenario wherein, see, this will remain 20 only, this will not change. Let's suppose the recoverable amount is 18, then the lower is 18, meaning thereby in this chart, please understand, in this chart, okay, your recoverable amount is here. Will you still see your recoverable amount is here? So will you still reverse this much? No, no, this is the maximum limit. You will reverse only till here. You will reverse only till here, right? So if the recoverable amount is 18, then you will reverse only till 18. Your carrying amount was 15. So the reversal gain will be 3. Is that clear, everyone? Is that clear, everyone? Okay. Now, very good. Very good. Okay. Now, I think we have covered each and every point for impairment as well. Moving on to the another standard. Come on, guys, tell me, is it clear, everyone? Then the rest 5 would be fair value gain. See, the rest 5 is not called as reversal. If the asset is under revaluation model, entity opts for, then they can record a revaluation gain as per IAS 16 or IAS 38 of intangible assets. Okay, they can do that, but it is not a reversal. It is not a reversal, is what I want to say. It is not a reversal. It is not a reversal. Okay, now coming on to the next standard, that is IFRS 5, non-current asset held for sale and discontinued operations. Okay, this is only one example I got for reversal. Okay. Oh, you can do one thing. I have made a detailed video in my channel. It is there for reversal of impairment loss. I have taken up a question also in that. Okay, you can watch that. Okay, ideally I have covered whatever was required from an exam perspective, but if you want to watch more, you can do that. Okay, in this session I can cover only what I have got for myself. Okay, these notes and everything was pre-prepared. Okay, now IFRS 5 is non-current assets held for sale. Now guys, just one point. In impairment there are two other things as well: impairment of a subsidiary, impairment of goodwill. Okay, there are two other things from an SBR point of view. Okay, and two-step approach. All these three things I will be discussing in the tomorrow's session. Okay, so SBR perspective of impairment will be discussed in the tomorrow's session. I will be discussing it. Okay, need not worry at all from that point. Okay, so SBR students, be assured that I will be coming tomorrow to cover the impairment, SBR perspective of impairment. Now, non-current asset held for sale. Now, what is the meaning of non-current asset held for sale? Let's suppose I have this laptop. I was using this laptop as a non-current asset for the supply of services. Now, after using it for 3 years, now I think like, okay, I don't want to use it any further. Let's sell this laptop and purchase a new laptop for myself. Okay, that is called as non-current asset held for sale. To classify any asset as held for sale, two conditions has to be satisfied. Tell me what two conditions has to be satisfied. One, the asset should be available for immediate sale in its present condition. Whatever condition it is in, you can sell the asset like this itself and immediately now. Second condition, sale must be highly probable. Okay, now understand guys, for the sale to be highly probable, there are further 5 conditions. For the sale to be highly probable, there are further 5 conditions. What are those? Management must be committed to a plan to sell the asset. Guys, these questions comes up, FR, SBR, both, very important. Okay, must be committed to a plan to sell the asset, an active program to trace a buyer, price should be reasonable, asset must be, the sale must be completed. The sale, okay, understand, the sale is expected to be completed within 1 year from the date of classification. Okay, even if it is not sold within 1 year, fine, no issue. It is expected to be sold. Okay, and there is no significant changes to the plan. There is no significant changes to the plan. Again, I'm repeating, for an asset to be classified as non-current asset held for sale under IFRS 5, two conditions has to be satisfied. Condition number one, asset should be available for immediate sale in its present condition. The sale must be highly probable. For sale to be highly probable, 5 conditions has to be satisfied. Management must be committed, active program to trace a buyer, reasonable price, sale is expected within 12 months, and there is no changes in the plan that is expected. Okay. So these are the 5 conditions. If these are satisfied, we can say that the asset can be classified as held for sale. Is it clear, everyone? The classification, is it clear, everyone? Come on, guys, tell me, please. Is the classification clear to all of you? Now, overview of IFRS 5. Please, guys, understand. Please, guys, understand. When you purchase the PPE, it is a non-current asset. Okay. When you purchase the PPE, it is a non-current asset. Okay. Now, so you were depreciating the asset. You were recording revaluation gain or loss if entity adopts a revaluation model. You were doing impairment of IAS 36. Okay. On this date, you classified the asset as held for sale. Okay, meaning thereby the 2 conditions were met. So when you classify the asset as held for sale, please understand. Okay, take carrying amount. Now this carrying amount should be after depreciation, revaluation, and impairment. I'm writing here. This carrying amount should be after depreciation, revaluation, and impairment of IAS 36. Okay. Impairment of IAS 36. Whatever has to be done after everything, take this carrying amount. Now compare this with fair value less cost to sell. You have to record it at lower. Okay. Now let's suppose the carrying amount happens to be 10 and fair value less cost of sale happens to be 8. The lower is 8. Asset was recorded earlier at 10, but now you will record at 8. So there will be an impairment loss of 2. Where will you record this 2? Where will you record this 2? Come on, tell me, guys. Where will you record this 2 impairment loss? It will be recorded in P and L. It will be recorded in P and L. Now, once you classify the asset under held for sale, there is no depreciation, no revaluation, no impairment. Again, I'm repeating. If you classify the asset under IFRS 5, held for sale, no depreciation, no revaluation, no impairment. The one thing you have to do is at every reporting date, recognize the asset at lower of carrying amount or fair value less cost to sell. Recognize asset at lower of carrying amount or cost to sell. Is that clear, everyone? Come on, guys, please tell me. Is it clear, everyone? Come on, guys, please tell me. Is it clear to everyone? Now, there is one more point. Standard says if fair value less cost to sell is greater than carrying amount, then you have to recognize reversal of impairment loss. But the reversal of impairment loss should be up to a maximum of cumulative loss recognized in P&L. Sir, what is the meaning of this? I didn't understand. Don't worry, I am there to explain. Don't worry, I am there to explain. Let me explain this. Using the help of an example. I have taken up the example. So I know where actually we need to take the example. See, guys, this is a revision marathon and we need to value even a single second of our time. Okay. So I had know where and all we need example. So let me take up an example to help you explain this topic in depth. Let us understand. So the question says, on 1st January 20x4, ABC classified an asset as held for sale, which was purchased 3 years ago at a cost of 100,000 with a 10-year useful life. fair value less cost to sell of the above mentioned asset is as follows. Now understand, guys. On 1st January 20x4, what is the carrying amount? Can you please tell me? You purchase for 100,000, 10 years, depreciation per year is 10,000. You have to depreciate for 3 years. So what is the carrying amount? Come on, guys, tell me. I need your response, guys. Why are you so low on energy? Come on, guys, everyone, come on, guys. I need to see the energy, guys. I can't see energy. How's the Joes, guys? Come on, tell me. How's the Joes? How's the Joes? Everyone. I feel like you have gone dull. Yes, that's what I'm getting the response. Very good. So the carrying amount is 70,000. Carrying amount is 70,000. Okay, now what is the fair value less cost to sell? 65,000. So what is the impairment loss? Okay, see, now understand. We have to record the asset at lower of these two. We have to record the asset at lower of these two. Lower is 65,000. So, but the asset was recorded 70,000. So we have to record a loss of 5,000. Tell me, where will we record this loss? Come on, guys, tell me. Where will we record this loss? Where are we going to record this loss? Where? P and L. Now, on 31st December, now tell me, from 1st January till 31st December, will we depreciate? Will we depreciate? No. So the carrying amount will become 65,000. Carrying amount will become 65,000. Okay. Now, on 31st December, the fair value less cost to sell is 62,000. Oh. Now, the further loss of 3,000. Where? Again P&L, again P&L, again P&L. Tell me yes or no. Come on, guys, tell me yes or no. Again P&L. This impairment loss again will go to P&L. Tell me, guys, come on. This impairment loss again will go to P&L. Right? Now, what happens? So this from 31st December 2024 till 31st December 2025, any depreciation? No. Any revaluation? No. Any impairment? No. So what is the carrying amount? 62,000. 62,000. Now, but what is the fair value less cost to sell? 71,000. Tell me, guys, what is the gain? You have got a gain. You have got a gain of how much? 9,000. You have got a gain of 9,000. You have got a gain of 9,000. You have got a gain of 9,000. Okay. Now, where shall we record this gain? So now standard says that if there is a reversal, the reversal should be restricted to cumulative loss recognized in P&L. Tell me, guys, what is the cumulative loss recognized in P&L? Cumulative loss recognized in P&L is 8,000. So what you can do is you can recognize the gain. But up to 8,000 only. Up to 8,000 only. So a gain of 8,000 will go to P&L. Now many students are saying, sir, the sale should happen within 12 months. Sale is expected to happen within 12 months. There is no hard and fast rule that you must sell within 12 months. Okay. The entity is trying to sell, but the sale didn't happen. What to do? The entity has been trying to sell, but the entity was unable to sell it off. What to do? Okay. And also to explain my point, I had to take up 3-year example. Okay. To explain my point, I had to take up 3-year example. Tell me, is that clear, everyone? Is the reversal? This is called as reversal. Is the reversal point clear to all of you? Tell me, guys, come on. Is the reversal point clear to all of you? Why only 8,000? Krishna, please understand. Because of this statement. If the fair value less cost to sell is more than carrying amount, then recognize reversal of impairment loss up to a maximum of cumulative loss recognized in P&L. Now come to this question again. What is the cumulative loss recognized in P&L? Tell me, what is the cumulative loss recognized in P&L? 5,000, 3,000, 8,000. So the reversal is limited to 8,000. Clear everyone? Clear everyone? So journal entry you want? Okay, let me give you the journal entry. So it was P and L debit to asset, P and L to asset, copy, paste. So here it will be asset to P and L. Simple. I believe it is clear to all of you. So now, moving on to the next part of this chapter, discontinued operation. Discontinued operation. How that 70,000 came? It is a carrying amount. I told no, you have to be active in the class. What is the meaning of discontinued operation? So discontinued operation is a, you can say, a major line of a business or a geographical area of operations. You can say a significant segment of a company. You can say a significant segment of a company. Okay. A student is asking, is there anywhere we are recording the remaining 1000? No, we are not recording anywhere. We are not recording it anywhere. Okay. So just 1 minute, since a student is asking, ideally I told you guys to please be active in the class. Okay, so please, still I'm explaining it. Okay, in the P&L you will write 5,000, and after this impairment your revised carrying amount will become how much? 65,000. Okay, in the P&L you will record 3,000 and your revised carrying amount should become how much? 62,000. Now in the P&L you should record how much? 8,000, and the revised carrying amount should become 8,000. So not 8,000, the revised carrying amount should become 70,000. The intent is, why 70,000? Ideally it is 71,000, but 62 plus 870. The intent is this revised carrying amount cannot go beyond this carrying amount of 70,000. It cannot go beyond it. Okay, it cannot go beyond this one. Okay, that's why we are restricting it to this value. Okay, guys, we need to understand one point, that we can't go into the depth of every topic in depth. Okay, it's a revision session. We can't go, there is a limited availability on my part also, that I can't go into the depth of it, everything. Okay, though I'm trying to go, but still. Component of the, okay, now so understand, discontinued operation basically means it's a significant segment of the entity, okay, which we are not continuing. Sir, what is the treatment of a discontinued operation? So please understand, for a discontinued operation, the treatment in P&L and the treatment in SOFP. In the P&L, we will show a single line item. Of profit or loss post tax from discontinued operation. Will not say revenue minus cost minus expense minus tax is equals to profit. No, we'll just show a single line item showing post tax profit or loss of discontinued operations. Okay, now in statement of financial position, if the discontinued operation is disposed of, then we would have already de-recognized the assets or liabilities. But if it is not disposed of, then we still have the assets and liabilities. Then in that case, we recognize all the assets under other current assets and all the liabilities under other current liabilities. We cannot do the net off of assets and liabilities. No, net off is not allowed. Now, in the P&L, when we say single line item, what are the components? So gain or loss on classification as held for sale, gain or loss on disposal of operations if already disposed of. So understand, guys, Expected loss on disposal, can we write in P&L? Expected loss? No. Expected loss? No. If already disposed of the actual gain or loss, yes, you can write. But if you have not yet disposed, then you can write expected P&L. No, not that. Post tax trading profit or loss from discontinued operations, that also you have to write out of. Okay, now in the disclosure part, you should write what is the revenue, expense, profit before tax, tax expense, profit after tax, assets and liabilities, cash flows, and earning per share. Everything in the disclosure you have to give. In the disclosure, everything you have to give. Tell me, guys, is it clear, everyone? Is it clear, everyone? IFRS 5. Okay. Now, can we do a quick comparison? Let's do a quick comparison of IAS 36 and IFRS 5. When do we impair the asset under IAS 36? When the impairment indicators are triggered. When the impairment indicators are triggered. And when IFRS 5, when asset is available for immediate sale in present condition, and sale must be highly probable. For sale to be highly probable, management must be committed. Reasonable price, locate buyer. Okay, sale is expected within 12 months. No significant changes to plan. In that case, we can classify. What is the treatment? Impairment loss. Okay, for if the asset is under cost model, to P and L. If the asset is under revaluation model, we transfer to OCI. To the extent there is a balance, there is a balance in revaluation reserve. Okay, excess will go to P and L. Forgive me for the mistake in the spelling. I am not focusing on the spelling, I am focusing on the content. Okay, now treatment of IFRS 5, it will go to P and L irrespective of whether it is at cost model, asset at cost model, or revaluation model. Both, it will go to P and L. Okay, the treatment I have already explained, so recognition part is not required now here. Okay, recognition is happen with respect to recoverable amount, and the recoverable amount is higher of fair value less cost to sell or value in use. Now this happens with respect to fair value less cost to sell. Reversal up to a maximum of carrying amount had there been no impairment originally. Okay, maximum up to lower of or recoverable amount. Now in this case reversal is allowed up to a maximum of cumulative impairment loss recognized in P&L. So now tell me, is it clear, everyone? Guys, tell me, guys, is this comparison helpful? Come on, guys, tell me, everyone. Sir, gain or loss should be post-tax. For discontinued operation, the gain or loss should be post-tax. Single line item should be post-tax. Yes. I believe it is clear to all of you till here. Okay. So now we have completed the second part of our session. Okay. Now can we have a break? Can we have a break? And then we will start the next part of the session, that is leases and the financial instruments. Okay. So let's break for 10 minutes. 10 minutes. Come on, guys, tell me. Is 10 minutes sufficient? Is 10 minutes sufficient now? Chalo, let's have a break for 10 minutes. Before the break, okay, let me write one more point. Let me write one more point here. Before break, let me write one more point here. Okay, let me write one more in the recognition part. Okay, if impairment loss comes up if recoverable amount is less than carrying amount. Okay, one more point I'm writing here. Since a student was getting confused, so let me write one more point here. At lower of carrying amount or fair value, less cost to sell. Ideally, I thought you will understand, but still, if you're not understanding, let me write that point. Now clear? Now clear, everyone? Let's have a break of 10 minutes now. Guys, do you need some motivation? Come on, tell me. I listen songs. I listen to a lot of songs. I have a song. Do you want to listen, all of you? Come on, guys. In the break, we can enjoy. Come on, tell me. SBR part of technical articles we'll discuss tomorrow. Chalo, let us listen some songs. Time up, guys, and I am here in front of you in the screen. Ta -ta -ta -da. Can you guys see me? Can you please confirm if you can see me? Come on, guys. मैं परिंदा क्यों बनूं, मुझे आसमां बनना है. Right? So that's a motivation, guys. Come on. Can we start the most important chapter? So come on, guys. Come on, everyone. How's the Joes? Everyone. Are you feeling tired? Come on, guys. Tell me. Are you feeling tired? Anyone who is feeling tired? Anyone who is feeling tired? I am too supercharged for this session. I am supercharged up. And I'm telling you, guys, I'm telling you, whether it be 1 a.m. in the night, 2 a.m. in the night, 3 a.m. in the morning, doesn't matter. I have promised full syllabus. I will be doing full syllabus. Group accounting, I have already uploaded. Last week itself, I uploaded the group accounting. So that is chapter I'm not taking. Okay, if I have sufficient time, I might consider. But group accounting, since I have just uploaded last week itself, okay, of FR. So I'm not taking that topic. Otherwise, I'm talking the entire syllabus. That's what I promised, and that's what I will adhere to. Okay, for SBR students, tomorrow I will be taking group accounting as well. Because SBR group accounting I have not uploaded recently. So tell me, can we start with leases? Leases. I will share, don't worry. I will, whatever videos has to be referred, what I will do is I will give the link of each of the videos in the description box of this video. Like for example, you have to refer examiner report video. I will give the link in the description box. Like for example, you have to refer theory topics. I will give the link in the description box. Like for example, you have to refer interpretation. I will give the link in the description box. Like for example, you have to refer group accounting. I will give the link in the description box. So whatever thing is not in my plan for today, I will be giving the link in the description box. So it becomes quite very easy for you to find that chapter. So you are not required to struggle. Oh, where is this topic? Where is that topic? No. Okay. I will be covering everything end to end. Now, coming to leases. Come on, guys, tell me, shall we start leases? Shall we start leases? But before we start leases, again, I'm telling to the students who have again joined now, again, I'm telling a request, all of you, if you are watching this session and you are enjoying this session, is a request with you guys. I want this session to reach maximum number of students. I want this session to reach maximum number of students. So I request you, all of you, to please post a genuine feedback and honest feedback on your you can LinkedIn, or you can say Instagram story, whatever it is. Okay, you can just take a snap of it and tag on your LinkedIn. My Instagram ID is already LinkedIn ID, both is already there in the description box of this video. Okay, it will help me reach maximum number of students. And also you can comment down your feedback as well in the after the live session has ended. Come on, moving to the important chapter, leases. Come on, guys, can you tell me what is the meaning of lease? What is the meaning of lease? So lease is a contract. Lease is a contract that conveys what? Right of use. Right of use of what? Of an identified asset. Of an identified asset. Now tell me, when the lessee gets the right to use of an identified asset, is it for free? No. In exchange of a consideration. Is it for the entire useful life? No. It is for a specified period of time that is called as lease term. That is called as lease term. Okay. So what is a lease? Lease is made up of 5 components. What are those 5 components? Lease is a contract that conveys a right of use of an identified asset for a specified period of time in exchange of a consideration. In exchange of a consideration. So these are the 5 components of lease. These are the 5 components of lease. These are the 5 components of lease. Now, lease has 2 dates. Lease inception date and lease commencement date. Come on, guys, tell me what is the meaning of lease inception date and what is the meaning of lease commencement date. So lease inception date means the earlier of the date when the contract is signed or the terms or conditions are agreed to. What is the relevance of lease inception date? What is the relevance? To identify if this contract is a lease contract or not. Lease commencement date is a date when the asset, the identified asset, is made available to lessee. The accrual starts and the lease accounting starts on lease commencement date. The lease accounting starts on the lease commencement date. Okay. Now, what is the meaning of lease term? The lease term. See, again, for in this session, I am covering the FR perspective of lease. The SBR perspective of lease, will be covered in the tomorrow's session. Okay. I am covering FR perspective of lease, which is equally important for SBR students. Now, non-cancelable period. Okay. Lease term starts from lease commencement date. It is a non-cancelable period and it includes optional renewal periods if the lessee is reasonably certain to exercise the lease option, extension option, renewal option, or termination option. Okay. Now, what is the lease accounting? What is the lease accounting? Okay. Now, can I do one thing? Rather than referring to these notes, I want to give you a quick summary of things, of leases. I want to give you a quick summary of lease. I think that will be much more better and effective. Let me do that. Quick summary of lease. Oh, can you see my screen, guys? Just a minute. Quick summary of lease. I make things quite very easy for you. Don't worry at all. Lease. Tell me the initial accounting. Accounting of lease. Come on, guys, tell me. Initial lease liability is recognized at present value of future lease payments. Can you tell me what is the meaning of future lease payments? Can you please tell me what is the meaning of future lease payments? Future lease payment means fixed lease payments. In substance, fixed lease payments, variable lease payment linked to an index or a rate, linked to index or a rate. Then what? Then what? Guaranteed residual value, guaranteed portion of the residual value. Then what? Come on, guys, tell me. Purchase price. If there is a purchase option in the contract and the lessee is reasonably certain to exercise that purchase option, and the lessee is reasonably certain to exercise the purchase option. Okay. Now, penalties, if there is a termination option and lessee is reasonably certain to exercise the termination option, then the penalties will also form part of the future lease payments. So this is your lease liability. Now, what is the meaning of ROU asset? ROU asset is recognized at cost. Now, what is the meaning of cost? Cost means the amount that you have to pay to acquire. So what is the meaning of cost? So cost is lease liability plus upfront lease payments, upfront lease payments paid on or before lease commencement date. So now if there is a non-refundable deposit given, non-refundable deposit, so it is added to the ROU asset. Non-refundable deposit added to the ROU asset. ROU asset. Okay. Now upfront lease payments plus plus any initial direct costs, okay, it is capital plus present value of decommissioning costs. So I can say ROU asset gets its treatment from IAS 16, property plant and equipment, right? It's like this one, it's like that one. Okay. Now this is the value of ROU asset. So what is the journal entry? Now one student is asking, Mahima is asking, what if the deposit is refundable? If the deposit is refundable, it is not added to the ROU. It is not added to the ROU. It is treated as it is. See, when the lessee gives the deposit, which is refundable, it's a financial asset. Why? Because between the lessee and the lessor, there is a contract. Lessee has given the deposit, so lessee has the right to recover. So there is a contractual right to recover. So that becomes a financial asset. Though this thing is not in the FR syllabus, not in the SBR syllabus. So let's ignore that part. So journal entry will be equals to ROU asset account debit to lease liability to bank. Okay, is it clear, everyone? The initial accounting, is the initial accounting clear, everyone? Is the initial accounting clear, everyone? Now coming to the next part is subsequent accounting. The subsequent accounting. Now in the subsequent accounting of lease liability, So let me write here, subsequent accounting of lease liability. Subsequent accounting. So lease liability is amortized over lease term. Okay. Now what is the, how is the amortization looks like? How does the amortization looks like? Opening lease liability plus finance costs minus lease payments is equals to closing lease liability. But now tell me, what if lease payments are in advance? Then what will happen? What if lease payments are in advance? What will happen? Then in that case, if lease payments are in advance, then in that case, it will be opening lease liability. Now advance means beginning of the year. So first of all, we'll pay minus lease payments. So first of all, we have to pay minus lease payments plus finance costs. Now this finance cost will be on net lease liability, that is opening minus payments. Okay, is equals to closing lease liability. Is that clear, everyone? Come on, guys, please tell me. Is that clear? So now this treatment is there if the lease payment are in arrears. Now what is the meaning of arrear? At end of year. What is the meaning of advance? At beginning of year. I believe you do understand these terminologies. Is it clear, everyone? Now, subsequent accounting treatment of ROU asset. Subsequent accounting treatment of ROU asset. Okay. Now, so ROU asset is depreciated over lease term. Ideally, we depreciate it over lease term, but now there are few exceptions. And what are the exceptions? Let me tell you. Exceptions. Point number one. If the remaining useful life is less than lease term, then depreciate over remaining useful life. Meaning thereby, let's suppose I have taken an asset on lease for 10 years. Okay, so lease term is 10 years, but the remaining life is 8 years. So we have to depreciate over 8 years only, right? Now, or if the lease contract has purchase option, and lessee is reasonably certain to exercise that option, okay, then depreciate ROU over its remaining useful life. Okay. Now, third point. One more point. If the asset transfers to lessee at the end of lease term, if the asset transfers to lessee at the end of lease term, then again depreciate ROU over its remaining useful life. Is it clear, everyone? Come on, guys, tell me. Is it clear, everyone? Mr. Prajapati, what you are saying is partially correct. What I have said is 100% correct. Okay, so this is how we measure. Okay, just saying that lower of useful life or lease term is partially correct. Okay, chalo. Now, this is one thing. Now, we have one more point. You have one more point of current non-current classification. We have current non-current classification, but I am not taking current non-current classification now, because I will be taking current non-current classification along with my two examples. I have drafted two examples, master examples for you guys. One from a lease payment in arrears, one from a lease payment in advance perspective. I have drafted two examples. I will be discussing these two examples, and I will explain the current non-current for both there in that example itself. So now I am not discussing anything from that perspective. Okay. Now I have to discuss a few other points. Okay, there is one more sale and leaseback point also that I will discuss, but hold on. Few other points. Point number one, recognition exception. Now, what does it say? Okay, if the asset is taken on lease, is either a low value asset. If it is a low value asset, I am highlighting that, or red, low value asset, or lease term is up to 12 months. That is short term lease. then in that case, then do not recognize lease liability and ROU, rather expense of lease payments to P and L as rent expense in SLM basis. What is the meaning of SLM basis? Let's suppose we pay in year 1 we pay 5, in year 1 we pay 5, in year 2 we pay 10, in year 3 we pay 15. So what is the SLM? So SLM is 5 plus 10 plus 15, the average rent, that is 10. So in each year 1, 2 and 3 I will record rent expense of 10, 10, 10. Is that clear, everyone? So I will record rent expense of 10 in year 1, comma year 2, comma year 3. This is called as SLM basis. I believe you have understood that part. I believe you have understood this part. Okay, now this is a recognition exemption. Now second point, if you have any variable lease payments, that will be recognized, variable lease payments will be recognized in P and L as rent expense on actual basis. Whatever you have to pay, you transfer it to P and L as a rent expense. You transfer it to P and L as a rent expense. Clear, everyone? Tell me, guys, is it clear, everyone? I think I have covered fairly each and every point for lease. Now it's a time to take up examples. So I have, what is ROU? I am confused. Lease in arrears, lease in advance. ROU is right of use asset. So we have to take two examples. Let's read the example in a quick manner and try to solve it. Hick entered into a lease agreement on 1st January. So guys, please understand, this is a lease in arrears. Okay, lease term is 6 years. Contract requires 6 lease payments of 2,000 at the end of each year. Okay, $1,200 is incurred for lease brokerage. So this is an initial direct cost, has an option to buy at the end of year 6 for $500. So it's a purchase option which the lessee is reasonably certain to exercise. The rate of interest is 10 years. The remaining useful life of the machine on the lease commencement date is 8 years. Okay, now you have to measure the lease liability and ROU. So what is the present value? Okay, present value, annuity factor and interest factor is given. So what is the initial lease liability? Can you please tell me, guys, what is the initial lease liability? So understand, you have to pay at year end 1, year end 2, year end 3, year end 4, year end 5, year end 6. You have to pay lease payments of 2,000. Now year end 6, you additionally are required to pay 500 extra for purchase, right? So what is your lease liability? And here at lease commencement date, you have to pay 1,200 for brokerage. So is it your lease liability? No. Why? Because you have already paid it. Right? So now tell me, what is your lease liability? So your lease liability will be equal to 2,000 multiplied by annuity factor is 4.355 plus 500 multiplied by 0.564. I believe you understand this calculation. This is your lease liability. Now plus initial direct cost of 1,200. So what is your ROU asset? So ROU asset is 10192. Is the initial measurement of lease liability and ROU clear to all of you? Is the initial measurement of lease liability and ROU clear to all of you? Now tell me, for year 1, what is the depreciation? So now tell me, ideally we depreciate the ROU over the lease term, which is 6 years. But now, since there is a purchase option and the lessee is reasonably certain, so what have I said for that? if the contract has purchase option and the lessee is reasonably certain, depreciate ROU over the remaining useful life. So we have to depreciate over the remaining useful life, that is 8 years. So this divided by 8, so depreciation is 1274. So what is the closing ROU? 10192 minus 1274 is this much, 8918 is the closing ROU asset. Now finance cost. What is the finance cost? We have to use the same rate which we used to compute the present value. What was the rate? 10%. So what is the finance cost? 10% of this one, 0.1. This is your finance cost. So what is the closing lease liability? So lease liability is opening lease liability of 8992 plus, since the lease payment are in arrears, opening, then finance cost, then payment, then closing. Then finance cost is 899. Now minus payment is 2000. So this is your closing lease liability 7891. Now comes the question of current and non-current classification. Current and non-current classification. How to classify it as current and non-current? So for that, what will we do here? For that, what are we going to do here is, now since the lease payment are in arrears, what is the shortcut? So non-current portion is lease liability at end of next year. And what is current? Balancing figure. Okay. So what is the lease liability at the end of next year? Year end 1. This is the liability multiplied by 1.1 minus 2000. This is the non-current portion. The lease liability at the end of the next year. So what is the current portion? The balancing figure. Total liability minus non-current portion. This is how you classify. I believe it is clear to everyone. So we have done the initial treatment, we have done the subsequent treatment, we have done the current and non-current classification. Okay. Since the lease payment are in arrears, so how will you determine your lease liability? It is opening plus finance costs minus lease payment is equals to closing. So please keep this in mind. I am highlighting this here in red and I am highlighting this also in red. Very important. I believe it is very much clear to all of you. Now moving on to the another example, lease payment in advance. How are we going to account for lease payment in advance? Okay. Guys, why are you asking me again and again on the recording part? We are having a so much wonderful session. Please enjoy the session. Now, my account work is asking why multiply with 1.1 finance cost, buddy. Finance costs. Okay. You want to record it like this? Okay. So I can say this plus bracket. This multiply with 0.1. minus 2000, that is also fine. Opening plus finance cost minus lease payments, right? This is also same answer, right? Same answer. Now example number 2 is on lease payment in advance. Now how does the lease payment in advance things work? Tell me guys, come on, tell me please, come on. How does the lease payment in advance things work? First of all, lease commencement date. So let us understand the question first of all. It is a lease payment in advance thing. Lease is entered on 1st January. Okay. On the date when the contract was entered, 2000 was paid on the signing of the lease itself, plus a further 5 payments at the beginning of each year. Lease payment in advance. Right? So now tell me, is it a part of lease liability? The amount that is paid in advance, is it a part of lease liability? No. Okay. 1200 is the initial direct costs. Option to buy the contract for 500, which the lessee is reasonably certain to exercise. The interest is 10%. Remaining life is 8 years. Right? Same thing. Now, initial commencement. What is your lease liability? So the first payment of 2000 is not your lease liability. Further 5 payments are your lease liability, because the lease liability is the present value of the future lease payments. So it is 2000 multiplied by the present value. Annuity factor is 3.791. Okay. Now what is ROU? So ROU, we will add first of all the initial deposit, plus we'll add the initial direct costs. So this is your ROU 10782. Now year 1, what is a depreciation? Now since there is a purchase option which the lessee is reasonably certain to exercise, so we'll depreciate ROU over 8 years. So divided by 8. So what is the closing ROU? Opening minus depreciation is closing ROU. What is the finance costs? What is the finance costs? So understand, this 7582 is after payment of the first lease payments, right? So what is the finance cost? It is simply this one multiplied by 0.1, 758. So what is the lease liability total? It is 7582 plus finance cost. Now we have to find out what is the current and non-current portion. So let me again write off. If the lease payment are in advance, then current portion is equals to amount paid at the beginning of next year. In our classes, we explain the logic behind all of these things, but now since it's a revision session, I will not be able to go into the logic, but yes, telling you the quick shortcuts which you can apply in the exam and arrive at the correct answer. Okay, so non-current asset, non-current liability is the balancing figure. Now, so what is the current? Next year beginning will pay 2000. So 2000 is the current and non-current is this minus this. 6340. So is it clear? Now lease liability, how did we arrive? Opening minus payments plus finance costs, right? So now this 7582 is after payment. This 7582 is after payment. Okay, now yes, we have to include that 500 also na. So add 500 also. 500 multiplied by 0.564. Add that 500 also. Very good, very good, very good, very good. Sanya Bansal, appreciate you for that. Okay, I missed that. I have included 500 also. The present value of this 500 also I have included. Okay, I think yes, that rest everything is correct. Tell me, is that clear, everyone? So I believe for lease payment in advance, lease payment in arrears, I have discussed the P&L impact, the SOFP impact, the lease payment in advance, arrears, everything I have discussed. Tell me, is it clear, everyone? Guys, from an FR perspective, I am telling one thing, okay? If the lease payment are in advance, okay, and the question says present value of total lease payments, or if the question says present value of future lease payments, be mindful of it. There is a difference in this one. Total lease payments means this plus 2000. Future lease payments means only 7864. Please be mindful if the question says total lease payments or future lease payments. Sir, if it is in arrears, then what? So if in the case of arrears, question says total present value of total lease payments, then also it is 8992. If it says future lease payments, then also it is 8992, because all the lease payments are future lease payments only. Okay, so be mindful of what is the question asking. Be very much mindful of it. Clear, everyone? Is it clear, everyone? Okay, now moving on to the next concept of sale and leaseback. So sale and leaseback also I'll explain it here, simple. I'm getting a call from my home. Let me just complete this topic and then I'll attend that call. Okay, let me complete this topic first of all and then I'll attend that call. Okay, I think the call is urgent, might be. It's coming continuously. Give me, okay. Let me complete this topic first of all. Sale and leaseback. Now in the sale and leaseback, what happens? You recognize lease liability at present value of future lease payments. You recognize lease liability at present value of future lease payments. You recognize ROU asset. You recognize ROU asset at what value? Come on, guys, tell me. You recognize ROU asset at what? Let me complete leases and then I will give you dinner break. Okay, I will give you dinner break. Even I will have some dinner. Okay, now recognize ROU asset at what value? I will discuss this part. Now hold on. Further, in sale and leaseback, de-recognize the asset at carrying amount on date of sale. De-recognize. Now, tell me, at what value will you recognize ROU asset? At what value will you recognize ROU asset? So ROU asset has to be recognized at carrying amount multiplied by lease liability divided by fair value. Okay, you have to recognize ROU asset at this value. Okay, now then recognize sale proceeds. Recognize sale proceeds. Now, if I have to simplify, I will say a very simple thing. In my classes also I say thing, and I think I can say it right now also. Recognize sale proceeds, de-recognize asset at carrying amount on the date of sale, and you will come at gain or loss on sale. Tell me yes or no. Is this part clear? Now the next part, and so this is the entry for sale. Now entry for leaseback. Recognize lease liability at present value of lease payments. Recognize ROU asset at this value. There will be a difference, and this difference is called as loss, or you can say reversal of gain on lease back. Why reversal of gain? See, understand, when you sell the asset, you lose 100% control. Okay, hence you recognize gain on sale of 100%. But when you take the asset back on lease, you reobtain certain percentage control of the asset. Okay, so in that case you have to reverse gain to the extent control is acquired. Okay, so now the net gain, that is gain on sale minus reversal of gain on leaseback is recognized in P and L. Sir, why are you teaching us in this leaseback, this break? Why are you breaking it into two parts? Because there was a question. Okay, see here, sale and leaseback. See here, there was a question in your BPP kit, and the question is asking, see, from what perspective, what will be the adjustment required to account for the gain or gain on sale in P and L. Adjustment required to the gain on sale. Now, what is this adjustment called as? Can anyone tell me what is this adjustment called as? So this adjustment is called as, just a minute. This adjustment is called as reversal of gain on leaseback. Okay, so you have to understand from this perspective also, because the question has been asked in the exam. So now let us solve this question. And this question will be your assignment. Okay, will you solve the assignment question? Tell me, guys, will you solve assignment question? Will you solve it? Now let us solve this question. How company sold an asset to a finance company for 750,000. So now tell me, sold for 750,000. So selling price 750,000. Now the asset had a carrying amount of 640,000. So what is the gain on sale? What is the gain on sale? 110,000. 110,000. Okay. Now on lease, when you take the asset back on lease, I'm writing on sale. On lease, on the same date, Haw company intend to a leaseback arrangement with the same finance company. Agreed. Term was 5 years. The terms of the leaseback required to pay 120,000 per annum in 5 years. Okay, so okay, 120,000. So what is lease liability? So it is 120,000 multiplied by 4.580. This much is your lease liability. Now, how to find out the carrying amount, lease ROU asset? Carrying amount multiplied by lease liability by fair value. So it is carrying amount is this much multiplied by lease liability divided by fair value. What is fair value? See, oh, the sale has happened at fair value. So sale price is the fair value. So this is the ROU asset. So what is the difference? So difference is one. So this is the adjustment. This is called as this 80608 is the adjustment required to gain on sale. So you know what? What will you record in P&L? In P&L, you will record this minus this. Okay, in P&L, you will record this one. But sir, but you will say, sir, but we have not studied lease, sale and leaseback like this. I know how you have studied. Let me teach you from that perspective also. So you would have studied bank account debit, ROU debit to lease liability to asset to P&L. Guys, ideally you would have studied that this P&L is the balancing figure. Tell me, you would have studied like P&L is the balancing figure. You know what? Without even calculating, I can say the lease, this P&L will be this much. Not this one, sorry, not this much. It will be this minus this. It will be this much. If you want, I can prove it. Bank will be this much. ROU will be this much. ROU will be this much. Now, lease liability will be this much. Asset will be derived 640,000. So let's calculate the carrying difference. Let's calculate the balancing figure. See, without calculating the balancing figure, I am challenging that this should be the answer. Let us calculate. This plus this minus this minus this. Is it the same amount? Yay! Tell me, is it the same amount? Yes. So this is the level of clarity that we expect from you. This is the level of clarity the examiner expects from you. Tell me, is it clear, everyone? Is it clear, everyone? Come on, guys, tell me. How is the Joes, guys? Come on, tell me, please. How is the Joes? Is it clear to everyone? Is it clear to everyone? So now ideally students say, sir, sale and leaseback is a very difficult topic. Now tell me, do you find it difficult now? Do you find it difficult now? Tell me, guys, come on. Do you find it difficult now? Okay. So this is done from a sale and leaseback point of view. Now, one more small point which I think I should teach from my notes itself. Just a minute. Okay. Now, can you see my iPad screen? Can you see my iPad screen? How to identify whether the contract is a lease contract or not? So for that, there has to be 3 conditions that should be satisfied. If all the 3 conditions are satisfied, we can say that the contract is a lease contract. Okay. 1, the asset should be an identified asset. Second, there should the lessee should have the right to receive substantially all the economic benefits from use of the asset, and lessee should have the right to direct the use of the asset. Lessee should have the right to direct the use of the asset. Okay. Now, what is the meaning of identified asset? Asset should be explicitly or implicitly specified. Some supplier should not have substantive substitution rights. Substitution for repairs is allowed. The asset should be physically distinct. If all the three are satisfied, we can say the asset is an identified asset. Lessee should receive substantially all the economic benefits from using the asset, and lessee has the right to direct the use of the asset, meaning thereby how the asset will be used, for what purpose the asset will be used is determined by lessee. Okay, if all the three conditions are set, if all the three conditions are satisfied, we can say the asset, this contract is a lease contract. This contract is a lease contract. Okay, now protective rights. So protective rights do exist in a lease contract, and these rights are there to protect the lessor's interest in the asset. Let's suppose I have given you this mobile phone to use, okay, on lease. So definitely I will put some restrictions to safeguard my interest in the asset, to safeguard my interest in the asset. Okay, those are called as protective rights. And if there are protective rights, it doesn't impact the classification of the lease. It doesn't impact the classification of the lease. Okay, so with this we complete the lease chapter. Now see, all those things though I have discussed, for lease payment in advance, okay, lease liability plus this one, lease payment in arrears, depreciation of ROU asset, amortization of lease liability, lease incentives, everything I have discussed. Everything I have discussed, I believe lease topic is clear. Now leases from an SBR perspective will be discussed in the day 2, that is tomorrow. Leases from an SBR perspective will be discussed in the tomorrow's session. Okay, so in the tomorrow session, I'll not be discussing leases from an FR perspective, because FR perspective is already discussed today. Tomorrow I'll be discussing only from an SBR perspective. Is that clear, everyone? Okay, so let's take a break of 20 minutes. Let's take a break of 20 minutes for dinner. But be right back after the break. Okay, don't go anywhere, guys. Tell me, are you enjoying the session? Are you enjoying the session? We have to do dinner. We are not required to cook dinner. Okay, so guys, enjoy the session and be there in the session. I'll be back within 20 minutes. Okay, chalo, the timer starts now. So how's the Joes, guys? Come on, tell me now. I am back after a break. Come on, guys, everyone here. Come on, come on, come on. Okay. So ideally, okay, just a minute. Okay. So now, since I believe there are few students who are still on break, so what we'll do is financial instruments being an important chapter, let's shift it. Let's take up some easy chapters. Okay, and then we'll jump to financial instruments. Okay, okay. So let everyone join, and then we can start financial instruments. Till the time, we'll start some easy chapters like government grants, provision, events. Okay, grants, provision, and events. Let us do these three chapters now. Everyone, is the Joes? Hi, everyone. Come on, guys. Tell me how's the Joes? Everyone. In the chat box, come on. How's the Joes, guys? Ready? Chalo. So let's start with a very important chapter, but a very small chapter, that is provisions. Now this is from a perspective of IAS 37. Just a minute. Guys, can you see me and hear me? Is the audio video clear, everyone? Audio video. Is the audio and video clear to everyone? See, can you see me dancing? Chalo, theek hai. So let us start with provisions now. So this is covering from the point of view of IAS 37, and IAS 37 says three things. It says provisions, contingent liabilities, and contingent assets. Okay, contingent liabilities and contingent assets, three topics. Okay, now what is the meaning of provisions? So understand, guys, I'll simplify things for you. I will simplify things for you pretty much simple. Okay, now understand. If you have an obligation to pay, now this obligation can be contractual, that is it arises from a contract. It can be legal, that is it arises from law of the country, or it can be constructive. Constructive means on your own. Constructive obligation. Okay, now, so understand, there are three type of things that can happen. One is the liability, another is provision, and then comes contingent liability, and then comes contingent liability. Swaha. Now, what is the meaning of these three and how to account for these three? Now, understand, when there is a present obligation, and the amount and timing of settlement of the present obligation both are certain, we recognize that as a liability. Okay, now, then when do we recognize provision? When there is a present, don't disturb me. When there is a present obligation and amount and timing are not certain, are uncertain, but they can be estimated, then we recognize provision. But understand, if they cannot be estimated, if they can't be estimated, we recognize contingent liability for the same. Or if there is a possible obligation, possible obligation means probability of payment is less than 50%, Okay, then also we recognize contingent liability. Sir, can you please explain this with the help of a chart? Yes, Baba, I will explain. Don't worry. When I am here, why to worry? So understand, whenever there is an obligation to pay arising from past events, not future events, okay. Now understand, the obligation are of three types: present obligation, possible obligation, remote obligation. Remote obligation means probability that you have to pay is less than 5% or up to 5%. No treatment for this one. If the probability that you have to pay is less than 50%, it is called as possible obligation. You just disclose a contingent liability. For present obligation, when the probability is more than 50%, that is more likely than not, more likely to be paid than not. Okay, sir, how to identify in the exam whether it is a present obligation or not? Think, if the entity shuts down today, do we still need to pay? If yes, it is a present obligation. Now tell me, future operating loss. If I shut down my company today, will I still incur any future operating loss? No, I will not incur. So is that a present obligation? No, it is not a present obligation. Now I have an obligation to you can say, I have an asset. I have this laptop. Okay, I can use this laptop for my classes only if I get this laptop inspected every 4 years. From now, after 4 years, I have to get this laptop inspected, or I have to get my aircraft inspected. Then only I can operate the aircraft. Tell me, if I shut down the company today, do I still need to incur that inspection cost? No. So do I have to make a provision for that? No. Okay. You understood how to think on the present obligation? Now, if there is a present obligation, amount and timing is certain, liability. Amount, timing uncertain, but can be estimated, provision. Amount, timing uncertain, but cannot be estimated, also contingent liability. Possible obligation, contingent liability. Remote obligation, no treatment. Is the meaning of liability, provision and contingent liability. Is it clear, everyone? So liability and provision we recognize in the financial statements. Contingent liability we disclose in the financial statements. Is it clear to all of you? Come on guys, please tell me, is it clear to all of you? Wonderful. So what is the accounting treatment of provision? We recognize it as a liability and a corresponding expense in the P&L. Okay, now onerous contract. What is the meaning of onerous contract? A contract which we are bound to execute. Okay, now if there is a future operating loss in an onerous contract where we are bound to operate the contract. Okay, now if there is a future operating loss, can we shut down the company today without executing the contract? No, we cannot. Either we have to execute the entire contract, or we have to pay a penalty, right? So in that case, we will make a provision of the lower amount. Okay, so make a provision of onerous contract if it is bound to execute the contract and it is loss making. Okay, now if the entity has an alternative to cancel the contract by paying penalty, then provision should be made for the lower of future operating losses or penalties to settle the contract. Sir, why are we making the contract provision for future operating loss? Because you are bound to execute the contract. So you are bound to bear this loss. You cannot avoid this loss. Even if you shut down the company, you cannot avoid this loss. It is a binding contract. Okay, that's why you have to make a provision for the same. Provision for decommissioning, restoration, or other liabilities we have already discussed in property, plant and equipment chapter. Restructuring, we make a provision when these two conditions are satisfied. Okay, when the detailed formal plan exists, and it is communicated to the affected parties. Okay, now what are the costs for which we make a provision for restructuring? Future operating loss? No. Marketing cost? No. Gain on expected disposal? No. Now actual gain or loss? Yes. Cost of new manager, no. Relocation cost, no. Staff training cost, no. Recruitment cost, no. Payment to terminate employees, yes. Legal cost of restructuring, yes. Redundancy cost of employees, yes. Cost to terminate any lease contract, yes. All these we will make a provision. Now warranties. Let's suppose I have sold a laptop, and with the laptop comes a inbuilt warranty, a standard warranty, right? So standard says that if warranties okay are not distinct goods or service as per the provisions of IFRS 15 revenue, IFRS 15, okay, then in that case it is not a separate performance obligation. It is not a separate performance obligation. Since it is not a separate performance obligation, can we recognize revenue for the same? No. So in that case, we have to make a provision for the same. Why? Because see, understand, when we sell the goods, let's suppose we sold the goods. There comes an obligation that if the customer comes to me for repairs, I have to repair it at no cost. I have to repair that at zero cost, right? So there is an obligation arising out of past events, okay? And the amount and the timing can be estimated on the basis of past events, on the basis of past practice, and hence we have to make a provision. But if it is a separate performance obligation, we have to recognize that as a revenue over the warranty period. Sir, can you please take up an example on warranty? Yes, Baba, I will take it. Don't worry. Bacha party told to take an example, and I will take an example. Warranty. So let's read the question. Just a minute, guys. Let's read the question. Alpha sold goods with a warranty which covers customers for the cost of repairing any manufacturing defects discovered within first 12 months after the purchase. So this is the 12 months of warranty. Okay. If any minor defects are detected, repair cost of 100,000. So for minor defects, no defect, there is no cost. Minor defect, there is a cost of 100,000. If any major defects are detected, it will cost 400,000. So for major defects, it will cost 400,000. Okay. Now, on the basis of past practices, we estimate that 75% of the goods sold will have no defects. Okay. 75% will have no defects. 20% of the goods sold will have minor defects. 20% will have minor defects, and 5% will have major defects. So what is the provision? So this multiplied by this. Okay. So this is this multiplied by this. This is this multiplied by this. So total provision is this much. Sir, what is the journal entry to record this one? So journal entry will be warranty expense P&L debit to provision for warranty. To provision for warranty credit. What is the amount? The amount is 40,000. The amount is 40,000. This is the accounting journal entry for recording this transaction. Is it clear, everyone? Warranty. Is it clear, everyone? Warranty, guys. Come on, tell me, please. So we have discussed the warranty part. Now moving on to the next. Contingent liability. I have already discussed the meaning of contingent liability. Now contingent assets. What are contingent assets? So for contingent assets, what I have done is I have made a summary chart. Just have a look at the chart. I believe you will yourself understand. See, please understand, guys. Please understand. When there is an obligation, probability is more than 95%. Okay, or probability is more than 50%. Both are called as present obligation. Please understand. Both are called as present obligation. If I talk from the point of view of obligation, Now, if the amount and timing is certain, liability. If amount and timing is uncertain but can be estimated, is a provision. If it is uncertain but cannot be estimated, is a disclosed contingent liability. For both. Okay. Now, if the probability is more than 50, less than 50%, it is possible, disclose contingent liability. If probability is up to 5%, no treatment. For obligation. See, clear? Clear? Coming to right to receive. Right to receive. Now it says, whenever you have a right to receive, you can recognize that as an asset and corresponding income in P and L only if it is virtually certain. What is the meaning of virtually certain? Can you please tell me? What is the meaning of virtually certain? When the probability to receive, when the probability to receive is more than 95%. When the probability to receive is more than 95%, okay, it is certain that it will be received, okay, then only we recognize. Okay, if it is more than 95%, then recognize asset and income, since it is virtually certain. Now, if the probability is more than 50%, then we disclose contingent asset. The contingent asset are disclosed in the notes to accounts. They are not recognized. Okay, so please understand, guys, contingent assets. Okay, contingent assets where the probability is more than 50% but less than 95%. Okay, so they are just disclosed in the notes to accounts. Once they become virtually certain, we recognize the asset and the corresponding income in the P&L. So that's what I have written here. See, contingent assets are disclosed as part of notes to accounts. If it becomes virtually certain, recognized as an asset in SOFP and a corresponding income in P and L. Is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Okay, so this is all about provisions. Now moving on to next small chapter. Events. Events occurring after the reporting date. Let me quickly summarize what is events occurring after the reporting date. Let me quickly summarize it off. Please understand. This is the date, reporting date. This is the reporting date, and this is the date when the financial statements are approved or authorized. Now, any events that occur here between these two dates, okay, it can be favorable, it can be unfavorable. Okay, any events comes in the scope of IAS 10. Okay, that is events occurring after the reporting period. Okay, now these events can either be adjusting events, or it can be non-adjusting events. Now, what is the meaning of adjusting events and non-adjusting events? So let's suppose this reporting period is 2025. This reporting period is 2026. So this reporting date is 31st December 2025. Now, here the financial statements are approved for 2025. Okay, so when we say the events occurring here are adjusting events, we mean to say that these will be accounted for in 2025. It will be accounted for in 2025. When we say non-adjusting events, we mean to say if they are material, it will be disclosed in 2025, but it will be accounted for in 2026. Now, how to understand whether the event is an adjusting event or a non-adjusting event? Okay, now the standard says that the events occurring here, okay, for these events, okay, if the conditions existed on reporting date, that is 31st December 25, okay, if the conditions existed on the reporting date plus these events just provide confirmation, then they are called as adjusting events. Like for example, a case was already ongoing, a legal case was already ongoing, but the court of law gave a final verdict on this date. So conditions existed on reporting date, confirmation came on this date. It is an adjusting event. Okay, now if conditions didn't exist on reporting date. Okay, now for example, factory caught fire on this date. Tell me, on reporting date, were you aware of it? No. So is it an adjusting event? No, it is not an adjusting event. It is a non-adjusting event in that case. Now standard again goes on to state that if the non-adjusting events are that material that it impacts going concern, okay, it impacts going concern, then it will become adjusting event. Let me give an example. Here the factory caught fire, and the whole of the factory got burnt, and it was the only factory which we had from which we were operating. The whole factory, the entire office is burnt. Now we are not able to operate. We cannot operate now. Okay, so ideally the catching of fire here is a non-adjusting event, but since it impacts my going concern assumption, hence it becomes adjusting event. Hence it becomes an adjusting event. Is that clear, everyone? Come on guys, please tell me. What if there was a fire on 25th December? What if there is, okay, now if the fire is happening here, okay, understand, there is no question of adjusting or non-adjusting. We are not talking about, if the fire has caught here, definitely it will be accounted for in this period, right? When we say adjusting, non-adjusting, we are talking about events occurring after the end of financial statements. In this period, anything that happens here will be definitely accounted. We will definitely account for it here. It's deemed. Okay. Now, few specific cases. Now understand. Let's suppose we have a trade receivable. Okay. Now, after the reporting period, the trade receivable becomes insolvent. Okay, this insolvency is an adjusting event. And we have to record the provision for bad and doubtful debts. Okay, it is an adjusting event. Now understand, inventory. If on the reporting date we had inventory, and here the factory caught fire, the inventory destroyed due to fire, floods, earthquake. Tell me, were we aware on this date for this fire, floods, earthquake? Did any conditions exist on this date? No. So it is a non-adjusting event. Okay. Now, inventory. For this inventory, NRV reduces in this period. Is that an adjusting event? Yes, it is an adjusting event. Right? So I have discussed this part as well. Okay. Although I have given a lot of examples for adjusting events, a lot of examples for non-adjusting events, which I recommend you to go through it. Whatever was important from an exam perspective, I have discussed that. Is that clear, everyone? Tell me guys, come on. Adjusting, non-adjusting, is it clear to everyone? Adjusting and non-adjusting, is it clear to everyone? Now, no, it can't be the case. Depending on what is the reporting date. Okay, we have to check what is the reporting date. Okay, if the reporting date is, let's suppose, 30th of November. If the reporting date, let's suppose, is 30th of November, then catching of fire on 25th of December becomes non-adjusting event. Okay, depends on what is the reporting date. Now, so we have completed provisions and events. Whatever we are completing, I'm just ticking box here also. Let us complete a few more small topics. Agriculture and inventories. Few more small topics. Agriculture. Come on guys, tell me, are you enjoying the session? Come on, tell me guys. Come on. Are you enjoying the session? I need come on guys, I need to see the energy. Okay, before we proceed further, let me again make a quick announcement here. For the SBR students. Okay, all the topics I'm discussing from an FR perspective. Okay, from SBR perspective, I'll be discussing in the day 2. From an SBR perspective, I'll be discussing in the day 2. So please make a note, guys. SBR students, you have to join tomorrow's session at 5 p.m. India time to cover up the SBR topics, cover up the SBR part. Okay. Now, and one thing I'll request from all of you, those who are watching this session, after the session gets over, I request all of you that please help me in reaching out to each and every ACCA student. Okay, share this video with all of the ACCA students. I believe this will be a gold mine for students who are watching, who are appearing FR or SBR, whether in March or June or any attempt. Okay, now I will request all of you to, after the session gets over, share this post on Instagram stories, tag me. My Instagram handle is given in the description box. Okay, or you can also post on LinkedIn genuine feedback of these sessions. Okay, so that we can reach the maximum number of ACCA students, and all the ACCA students can take the maximum benefit from these sessions. Okay, now will you do that for me? Come on guys, tell me, will you do that for me? And those who are watching the session, please, all of you, come on guys, hit the like button. We have already reached 200 likes. Come on guys, hit the like button, everyone. Those who have not liked, please hit the like button. Okay, and also subscribe the channel. I am telling you guys, this is a gold mine, and we will be uploading more contents on FR and SBR before the exams. We will be uploading more content. Okay, so need not worry, I am there. FR and SBR is my responsibility. Okay, now coming on to the agriculture, biological assets. Okay, now let's suppose, first of all, understand the scope of this chapter. What exactly is covered in this chapter? Okay, now understand what is the meaning of biological assets. Biological assets mean, understand guys, biological assets mean all the living plants and living animals. Living plants and living animals are called as biological assets. But please understand, a bearer plant, though it is a biological asset, but it is covered in the scope of IAS 16, property, plant and equipment. Sir, what is a bearer plant? Can you please tell me? Any plant which gives us agricultural produce year on year. Okay, so our intent is to pluck the agricultural produce every year rather than selling the plant itself. Okay, for example, mango tree. Every year we take the mangoes from the mango tree. So it's a property, plant, equipment. It's a bearer plant, and hence it is classified as property, plant and equipment. Okay, rest everything, all the living plant and living animals except bearer plant are covered in the scope of IAS 41. Sorry guys, we have been taking the sessions from last 5 hours, and again I'm saying, I have come here today with the intent to complete the syllabus. I will make sure the entire revision is there on my YouTube channel. You guys just keep supporting me, and I am there for you guys. For FR SBR is my responsibility. Okay, now okay, so all the living plant and living animals, except for the bearer plant are covered in the scope of IAS 41. Okay, point number 1. Point number 2, all the agricultural produce All the agricultural produce from living plant and living animals, including bearer plant, are covered in the scope of IAS 41. For example, we get milk from cow in the scope of IAS 41. We get mangoes from mango tree, agricultural produce in the scope of IAS 41. In the scope of IAS 41. Okay. Now understand how to do the accounting of this. How to do the accounting of this. I'll explain in a very simple language. Standard says you record. So now tell me guys, come on, tell me. So far we studied that the assets are recognized initially at, come on, tell me please, come on. The assets are recognized initially at, tell me what? Assets are recognized initially at cost, right? That's not the case here. Initially you recognized it at fair value less cost to sell. Subsequently also you recognize it at fair value less cost to sell. Okay. Any gain or loss coming in will go to P&L. Is that clear, everyone? Any gain or loss coming in will go to P&L. Is that clear, everyone? Clear? Now, in the exam, the question will say this fair value gain or loss. Okay, you have to give a disclosure. How much of this gain or loss is attributable to physical change, and how much of this is attributable to price change. Comes the question, how will we find out this, how much of it is for price change and how much it is for physical change? How to find this one out? Can I take up an example to explain, guys? Come on, tell me. Can I take up an example to explain? Let me take up an example. Understand, please. Let's suppose I have a 2-year-old cow here. And the fair value less cost to sell is 100. Okay. Now, it is on 1st January 20x4 and on 31st December 20x4. Tell me the cow will be how many years old? The cow will be how many years old? It will be 3-year-old cow now. It will be a 3-year-old cow now. Now let's suppose the 3-year-old cow has a fair value less cost to sell of 150. So it is certain that you will recognize in your P&L, you will recognize a gain of 50. That is certain. But now please understand, we have to bifurcate between physical change and price change. So we have to find out what is the fair value less cost to sell of 2-year-old cow is 120. So now understand what we are saying. Age remaining constant. What is the change in the price? Age remaining constant. What is the change in the price? This is called as price change. Okay. So 20 is your price change. 2 years price change. Now, date remaining constant. What is the physical change? So this is your physical change. So what is attributable to physical change? 120 to 150, 30. So this is what you have to disclose in your notes to accounts. Is that clear to all of you? Come on, guys, please tell me. Is that clear to all of you? Guys, I am giving what I can. Okay. Focus on what you are getting. Okay. You are don't keep demanding. Focus on what I'm giving. Focus on that. If you focus on what I'm giving, I can guarantee if you have studied even your FR or SBR for one time also and you watch the session properly and practice questions, you can pass the exam without taking any classes. This I can guarantee. Though I can say that this is not a substitute for the classes, definitely this is not a substitute for the classes, Passing is one thing and understanding is of the concepts is another thing. Okay, so in the classes you get the understanding of the entire concepts in depth, but if you have studied properly and watched this session, I can give this in guarantee. I can give this in guarantee. If you would have studied or revised on your own, you would have spent 3 to 4 good number of days and still you would have not got the confidence. But after watching this lecture for straight for 10 or 12 hours, definitely you will get that level of confidence. I can give you a guarantee. Okay, so focus on what you're getting rather than just demanding again and again and again. Okay, now, so this is what is your agriculture chapter. Now moving on to the another chapter, inventories. Moving on to the another chapter, inventories. Okay, come on guys, tell me, what is the meaning of inventory? What is the meaning of inventory? So inventory includes raw material, inventory includes work in progress, inventory includes finished goods. Now raw material, finished goods, work in progress, what is the meaning of this? Understand please. Any raw material, understand guys, understand, any goods which is available for sale in the ordinary course of business, in the ordinary course of business is called as inventory. Is called as inventory. Any goods or services which is held for sale in the ordinary course of business is called as inventory. It can be raw material which has to be consumed in the production of finished goods. It can be work in progress. It can be finished goods. It can be stock in trade. What is stock in trade? We purchase, we sell. It's called as stock in trade. What is finished goods? We manufacture. What is raw material? The one which is an input for the finished goods. What is work in progress? Raw material is in the process of conversion to finished goods. Okay, now how is inventory accounted for? How is inventory accounted for? Please understand, I am giving you in a very simple terms. Inventory is initially accounted for at cost. What is the meaning of cost? What is the meaning of cost? Cost of raw material plus conversion costs, plus conversion costs. Okay, now is your cost. Okay, now subsequently at lower of cost or net realizable value. Now how will you measure this cost? How will you measure this cost? At FIFO, first in first out. I believe you know the meaning of FIFO. At weighted average or specific identification. Okay, now how do you measure NRV? How do you measure NRV? NRV is estimated selling price minus costs to sell minus costs to complete, minus costs to complete, minus cost to complete. Okay, cost to complete ideally comes for work in progress. If there is a work in inventory under work in progress, then if we have to measure that inventory, okay, if you have to value that inventory, okay, so we have to adjust the cost to completion as well in that case. Okay, now understand, if the raw material has to be valued, subsequently raw material, so raw material continues to be at cost, raw material continues to be cost, subsequent measurement of raw material, it continues to be at cost. But the standard goes on to say that if the finished goods in which this raw material is to be applied, okay, if the finished goods in which this raw material is to be applied is sold at or above cost, meaning thereby at no loss, at or above cost, okay, that is no loss, then measure raw material at cost. But if finished goods is to be sold at below cost, Then measure the measure the raw material at its replacement cost. Measure the raw material at its replacement cost. Okay. Now another thing, when you value the inventory at lower of cost or NRV. Let's suppose the cost was 100, NRV is 120. So you will continue to record it at cost. Is there any P&L impact? No. But let's suppose the NRV is not 120, it is 95. So you will record at 95, but you ideally initially recorded 100. But now you have to remeasure to 95. So there is a loss. There is a loss of 5. There is a loss of 5. What is the journal entry to record this loss? What is the journal entry to record this loss? So that this loss will be recognized at cost of sales account debit to inventory 5. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Come on, guys, tell me. Clear? Clear? Chalo. So this completes our inventory discussion as well. We have completed 2 small chapters further. Now, can we complete a few other small chapters as well, and then we'll have a break, and then we can go on important chapters. Let us discuss few more small chapters. For example, we can go to earning per shares and foreign currency transactions. Before starting earning per share, can we have 5 minutes break? Let's have a break of 5 minutes. Enjoy and listen to music. Okay, I will play the music for you guys. I will play the music for you guys. Okay. Do you want to listen the music? Do you want to listen the music? I believe first of all you should appreciate yourself. Tell me who among you guys who are there from the start till end. I believe there are 100 students now. There are concurrent viewers of 110. 110 students are watching it live. Okay, who all are there from the start till very end? Can you please tell me? Yes. If you are there from the start till now, you are watching it continuously from the last 5 hours 17 minutes. Please tell me. I believe all of you are watching from the last. I am here without break. That's a wonderful, guys. That's wonderful. I am. This is motivating for me. This is motivating for me. I think I can take the class fully and complete the entire syllabus. I will definitely do it for you guys. I will definitely do it for you guys. Okay. So let's break here for 5 minutes. Enjoy. Yes, definitely I'll not play the song here, otherwise copyright claim might come up. So I'll not play the song here, but please do listen songs and enjoy, and see you after break. 5 minutes, 5 minutes quick break, and then we'll start with for earning per share and foreign currency transactions. Okay, chalo, but be right back in time, be right back on time. Okay. Can you listen to me now? Can you listen to me now? Now, can you listen to me, guys? Come on, please confirm. So sorry, so sorry, so sorry. Can you listen to me now? Now you can. Okay. So class will continue till the time we complete the entire syllabus. Till the time we complete the entire syllabus from an FR perspective. Okay. Except for the group accounting chapter, we'll complete the entire standards. Okay. Group accounting, I'm not covering. Why? Because group accounting I have covered already. A week back, I uploaded a video of group accounting from an FR perspective. I have uploaded a week back itself. Do you want to see? I'll show it to you. Just a minute. See when I have uploaded. Just you yourself see. Group accounting, see, 2 weeks ago. You can see yourself. 2 weeks ago, I've uploaded group accounting 90 minutes. Detailed revision of group accounting is there already. Okay. So group accounting, I will not be covering. But if you don't worry. This group accounting link I will give in the description box of this video. So you need not worry at all. So FRA students, you watch this group accounting revision tomorrow. Okay. Now, starting with earnings per share. Tell me, can we start earnings per share? Can we start earnings per share? Okay, so earnings per share. Now, let me quickly summarize things. Earnings per share. So earnings per share, as you know, just a minute. Earnings per share, as you know, are of two types. It is basic earning per share and diluted earning per share. Okay, so first of all, I'm talking from a basic earning per share point of view. Tell me, how do we compute basic earning per share? It is profit attributable to ordinary shareholders. I call it as PATOS. I find that you guys are going low on energy. Is it the case? Come on, guys. How's the Josh, everyone? Come on, guys. Yeah, I am taking the class from the last around 6 hours and I am not feeling low on energy. Why are you feeling low on energy? Come on, guys, everyone. Yes, that should be the spirit, everyone. Very good. So now, basic earning per share is PATOS, that is profit available for to ordinary shareholders, divided by weighted average number of ordinary shares. Now let us talk about PATOS, profit available to ordinary shareholders. See, I have discussed here. What is the meaning of PATOS? Profit or loss after tax minus preference dividends less profits attributable to NCI. Okay, this is what is called as PATOS. Okay, profit or loss after tax less preference dividend less profit attributable to NCI. Less profit attributable to NCI is called as PATOS. Now, what about weighted average number of outstanding number of ordinary shares? Now, this we have to calculate considering what is the opening balance, if there is any issue at full market price, if there is any rights issue, or if there is any, you can say, bonus issue. Now tell me, rather than explaining the theoretical concept of this, can I take up one example covering all the 4 adjustments in one single example? Shall I take it up? Tell me, guys. If you will tell me to take up, I will take up. If you will say, no, sir, don't take, I will not take. Tell me, what do you want? Shall I take up one example which will have this also, this also, this also, this also? One example covering all four. Tell me, do you want me to take up? Do you want me to take up that example? I want to see the chat screen moving like shoo, then only I'll take up. Okay, everyone. Okay, chalo, let's take it up. Let's take it up. Just give me a minute. Yes, here is that example. How many of you have seen this question previously? Tell me. How many of you have seen this example previously? Bol, Munna, bol. Yes, of course. Okay, chalo, let's start. So this is the question, guys. This is an example from your BPP material. Okay, this is an example from BPP material, which has, please see, guys. It has opening balance. It has issue at full market price. It has right issue. It has bonus issue. All the four. So I consider it as master example. I consider this as master example. Tell me, don't you think this will help you understand the concept with more clarity? Come on, tell me, guys. Don't you think it will help us understand with more clarity? Okay, chalo, let us understand. On 1st January 20x1, on 1st January 20x1, okay, reporting date is 31st December. Okay, reporting date is 31st December. Okay, so now on 1st January 2000, Saunders company had 2 million ordinary shares in issue. So opening balance is how much? 2 million. Now it remained outstanding from 1st January till 30th of April. So Jan, Feb, March, April, 4 months, 4 months, 4 months. Okay, so what I will say, into 4 by 12. Is that clear, everyone? Is that clear, everyone? Okay, let me give some comma, okay, so that you understand things in a proper manner. Is that clear? Okay, now on 30th of April, we issued full market price. We issued at full market price 2,70,000 ordinary shares. So now tell me, on 30th of April, what is the total number of shares? 2 million plus 0.27 million, means 2.27 million. So I can say it is 2 lakh 27, sorry, 2 million 2,27,000. Yes. Now it remained outstanding from 30th of April till 30th of July, means May, June, July, 3 months, 3 months into 3 by 12. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Come on, guys, tell me. Okay, now after that, on 31st of July, we have done rights issue. It was an issue at full market price. Now it is a right issue. Let me change the color. Yes, rights issue. Rights issue. Okay, rights issue for 1:10 at the rate of 2 was made. Now, whenever there is a right issue, whenever there is a right issue, we calculate what? Tell me. We calculate theoretical X right price, which we call it as TERP. TERP, right? So now let us compute TERP. How do we compute TERP? How do we compute TERP? So we say for every 10 share, what is the ratio for 1 for every 10? So for every 10 shares, please understand, for every 10 shares, we are issuing 1 share. Okay. Now the 1 share which we are issuing at what price? 2. Now 10 shares was held at what price? The fair value on the last day before the rights were issued was 3.1. So 10 shares were held at 3.1. 3.1. So what is the TERP? This multiplied by this, similarly equals to this multiplied by this. So what is the total? What is the total number of shares? This. So what is the TERP? So TERP is equals to 33 by 11. That is equals to 33 by 11 is equals to 3. Is equals to 3. So now what is the bonus factor? In the case of right issue, what is the bonus factor? Fair value before right divided by TERP. Divided by TERP. So what is the bonus factor? Tell me. 3.1 divided by 3 is the bonus factor. 3.1 divided by 3 is the bonus factor. So we have to multiply the bonus factor to all the outstanding shares prior to right issue. So I will say multiplied by 3.1 by 3. Copy. Right now, after the right issue, what is the total number of shares? Please tell me. Understand. Pre-rights, we had 2,22,70,000 shares. Okay. Now, in the right issue, we issued how many? We issued 1:10. So for every 10 shares, we'll issue 1. 2,27,000. So what is the post-right issue? Post-rights, what is the total number of shares? It is 24,97,000. Okay, now, so this one, copy, yes, 24,97,000. Okay, now it remained outstanding from 31st July till 30th September, means August, September, 2 months. Clear, everyone? Is that clear, everyone? Is that clear, everyone? Is that clear, everyone? Okay, now then on 30th September 2021, we made bonus issue of 1:20. Bonus issue of 1:20. Understand, please. Bonus issue. What is the number of shares? Okay, first of all, bonus factor. What is the bonus factor? Can you please tell me? Bonus factor will be 21 by 20. Hey, don't disturb me. Don't disturb me. Yes. So bonus factor will be equals to 21 by 20. So we will multiply bonus factor to all the shares outstanding here. So multiplied by 21 by 20, multiplied by 21 by 20, multiplied by 21 by 20, 21 by 20. Now tell me, post bonus, what will be the number of shares? So let me tell, let's calculate. So pre-bonus, the total number of shares that we had was 24,97,000. Okay. Now in bonus issue, we issued 1 for every 20. So what is the total number of shares that we issued? Let us compute. 24,97,000 divided by 20. It is 124,850. 124,850. So what is the number of shares post bonus? It is equals to how much? 24,97,000 plus 124,850. It is equals to 262,1850. So let's write here 262,1850 multiplied by how many months? From 30th September till 31st December, means October, November, December, 3 into 3 by 12. Okay, done. So now tell just as a cross check, might add all the months and see if it is coming to 12 or not. 4 plus 3, 7, 7 plus 2, 9, 9 plus 3, 12. So yes, we have done our correct calculation. So now we can do the calculation part. Okay, so this is the total number of weighted average number of outstanding ordinary shares. This is the weighted number. Okay, SBR students, EPS is not that relevant, I can say. EPS is not that relevant, though in the syllabus, but not relevant. Okay, okay, now, so you can, if you want, you can skip it off. Okay, okay, but just we are completing EPS. After that, you can again, we'll come to the topic again. Okay, now, so this is the total number of shares. So first requirement was what is the total number of weighted average number of shares we have computed. Now, requirement number 2, what is the earning per share? Earning per share is equals to, what is the profit? 400,000. What is the number of shares? So I can say 400,000 divided by these into 100 is altogether 16.45, or you can say, just I'll say here 16.5 cents. 16.5 cents is the earning per share, okay. Profit by weighted average number of outstanding ordinary shares is the earning per share. It is a basic earning per share. It is not a diluted. It is not diluted. It is basic earning per share. So requirement number 1 and requirement number 2, we have well adhered to. We have computed it very well. Okay, I can do it here also, guys. Just a minute. $16.5 done. Requirement number 3 is what? What is requirement number 3? Restated earning per share for the previous year. Okay, so for the previous year, the earning per share is 18.6. So tell me, how do we compute restated? We just divide the earning per share with the bonus factor. We divide the earning per share of the previous year with the bonus factor. So it is 18.6 multiplied by bonus factor. There are two, 3.1 by 3 and 21 by 2. Since we have to divide, I will reverse. 3 by 3.1 multiplied by 20 divided by 21. Copy. 17.1 cents. Is that clear, everyone? Is basic earning per share clear to all of you? Is basic earning per share clear to all of you? Come on, guys, please tell me. Is basic earning per share clear to all of you? Done. Chalo. So this completes basic earning per share. Now moving on to the diluted earning per share. So for diluted earning per share, we have to understand the potentially ordinary shares. So there are two questions. Again, I will go from an example perspective here in this case. Okay. Now, one is the convertible instruments and another is the warrants. Okay. So let us understand, in the diluted earning per share, one thing which you need to be careful in the diluted earning per share is diluted earning per share, okay, will always be lower than or equals to basic earning per share. There is no scenario in the world which will be wherein diluted earning per share is more than basic earning per share. No, it is not possible. Diluted earning per share, it will be either less than basic earning per share or max to max equals to basic earning per share, but it cannot be more than basic earning per share. Okay. Now, so one is the convertible instruments. So now tell me, first of all, read the question and tell me what is the basic earning per share. How do you compute basic earning per share in the question? So what is the profit? 644. What is the total number of shares? 10 million shares. So these figures are in thousands. So 10 million in thousands is 10,000. Okay. So what is the basic earning per share? It is 644 divided by 10,000 is into 100. 6.44 cents. 6.44 cents. 6.44 cents. This is basic earning per share. Is the basic earning per share clear to all of you? Okay, now coming to diluted earning per share. Diluted earning per share basically means those instruments which are not ordinary shares now. They are not ordinary shares now, but they will be ordinary shares in the future. Okay. So now, on conversion, what is the impact on the profitability? What is the impact on the number of shares? Let's see. Vijay Limited had 10 million ordinary shares in issue on both 1st April and this one. Okay. On 1st April 2021, company issued 1.2 million 5% convertible loan note. Convertible loan note means it will be convertible to ordinary shares. Each loan note will be convertible into 4 ordinary shares. Okay. So now if I have to talk about diluted earning per share, I can simply say I have 1.2 million loan note units. One unit will be converted to 4 ordinary shares. So I will say it will convertible into 4,800 ordinary shares. 1.2 into 4 is 4.8 million. Thousands is 4,800, right? Now, what is the impact on the profitability? In profitability. So profit, see, when these loan notes will be convertible to ordinary shares, will there be any finance cost? Tell me. Will there be any finance costs? Will there be any finance cost? No, the finance cost will not be there. The finance cost will not be there. Okay. Now, so we have to reverse the finance cost. Finance cost being an expense, if we record an expense, our tax reduces. But if the finance cost will not be there, our tax will increase. So I will say into 70% post tax. I will take post tax. Okay, this is the benefit from the earning potentially ordinary shares. So what is the amount? 644 plus 42 divided by 14800. Okay, multiply 100. So now see here, if you can see, this diluted earning per share is less than basic earning per share in cents. Cents. Clear everyone? Is it clear everyone? Is it clear everyone? From a convertible loan note perspective. Now coming to warrants. Now tell me, warrants are, we have understand, warrants are basically what? We have collected money from the shareholders, but we will be issuing the equity shares in the future. So they are not ordinary shares now, but it will become ordinary shares in the future. So let us first of all compute the basic earning per share. Galaxy company has a profit of 3 million, means 3,000 is the profitability. What is the total number of shares? 1.4 million means 1,400. So what is the basic earning per share? It is 3,000 divided by 1,400. $2.14 is the basic earning per share. So now, first of all, let us copy this one here. Now, any impact on the profitability? No impact on the profitability. But what is the impact on the number of shares? So we have to see what is the potentially ordinary shares. So total warrants. What is the total warrants that we have? 250,000. 250,000. Okay. Less. What will be the paid warrants for which we will get the funds in the future? Okay, so how much funds we will get? 15. So we can say it is 250,000. 215,000 less 250,000 multiplied by 15. This many funds will get. If we issue at full market price, the fair value is 20. So this is the paid version. So what is the amount of potentially ordinary shares? Sorry. Just a minute. It is 62,500. But understand, these are in absolute figures, but these are not in absolute figures. So these are in thousands. So I can write plus 62.5 in thousand. Okay, I can write in thousands. So what is the amount of diluted earning per share? It is 3,000 divided by 1462.5. 2.05. Is that clear, everyone? Come on, guys, tell me, please. We have very well computed earning per share as well. Is that clear, everyone? Come on, guys, please tell me. Earning per share, is it clear to all of you? Earning per share, is it clear to all of you? Okay, we are completing small chapters first of all. Okay, now okay, let us move on to the next small chapter, that is foreign currency. Now, foreign currency, I'll quickly go through this one. Foreign currency, I'll use this one. I'll use this. Foreign currency. Okay, or just a minute. See here. Just a minute, guys. Come here. Can you see my screen? Can you see my screen? Now, foreign currency transactions, foreign exchange transactions, foreign currency transactions. Okay, now understand there are three types of currency. One is the foreign currency, one is the functional currency, one is the presentation currency. So, functional currency is the currency of the primary economic environment in which the entity operates. Okay, now any currency other than functional currency is called as foreign currency. Okay, now determination of functional currency happens using the primary factors or the secondary factors. Basically, we see what in which currency our major transaction happens. Okay, using that rule, we classify using the primary factors and the secondary factors. We classify whether which currency is our functional currency. Which currency is our functional currency? Okay, it can be the case I am operating in India, but my functional currency is dollars. It can be the case. It can be the case. Okay, now what is important from our exam perspective? Okay, in this chapter we have to study two things. In this chapter we have to study two things. One is the foreign exchange transactions and another is the foreign operations. When I say foreign operations, I mean to say foreign subsidiary and foreign associate. But please understand that this topic is from an SBR perspective, not from an FR perspective. So this topic I will be discussing tomorrow. Okay, this topic I'll be discussing tomorrow. Today I am discussing only foreign transactions. Now, foreign transactions is there in SBR also. This is there in FR plus SBR both. So I'm discussing foreign currency transactions now. I'm discussing foreign currency transactions now. Chalo. Foreign currency transactions. So please understand, whenever you do a transaction, you record at the spot rate. On the date of transaction, what is the exchange rate? Using that exchange rate, you record the transaction. Okay, but at every year end, we evaluate if we have any foreign currency monetary items. We restate to each reporting dates. We restate that to the closing exchange rate, and any exchange gain loss will go to P and L. Okay, if the asset is under cost model, do we need to restate? No. If the asset is under fair value model, we restate at the closing rate. We restate at the closing rate. Okay, now what is the meaning of foreign currency monetary items? Any receivable or payable in foreign currency for which the amount is fixed as per the contract. For which the amount is fixed as per the contract. Okay, now this we can understand better with the help of an example. Okay, let us take the help of example and try to understand this one. Foreign currency. Let us see here, please. On 25th October 2025, Ashton sold goods to Mexican customer for 2,86,000 pesos. Okay, now on 25th October 2025, please understand, guys, this Ashton company should record revenue. What is the amount of revenue that Ashton company should record? What is the amount of revenue that Ashton company should record? Come on, guys, tell me. It will be 2,86,000 divided by 11.16. That is the exchange rate on the date of transaction. Exchange rate on the date of transaction. Okay. What is the amount? What is the amount? 25627. 25627. Okay. Now, will this be restated? No. Revenue, once recognized, the amount is closed. We cannot change the amount of revenue for the change in the exchange rate. No. But understand, when we recognize revenue, have we received the trade receivables? No, we have not yet received. We have not yet received. Okay. So now what will happen? We will recognize a corresponding trade receivable of 25627. we will recognize a corresponding trade receivable of 2567. Now understand guys, this trade receivable is a foreign currency monetary item. Why? Because it is a receivable, it is a receivable, it is a receivable, right, in foreign currency. It is a receivable in foreign currency, right? It is a receivable in foreign currency. Now understand, please understand. So how will we record? So trade receivable will record at 25627 initially on the date, when we have recorded the trade receivable, we'll record at 25627. Now the question says, case A, Ashton receives the full payment on 16th November 20x5. On 16th November, if Ashton company receives the full payment, what is the treatment? So now tell me, on 16th November, what is the amount that Ashton company will receive? So Ashton company receives 286,000. But what is the exchange rate on 16th November? Tell me. 10.87. So in dollars, what is Ashton company going to receive? Divided by 10.87. 26311. So understand, Ashton company recorded a trade receivable of 25627 but received 26311. 26311. So there is an exchange gain of what amount? Exchange gain of what amount? 684. This is called as realized. This is called as realized exchange gain. And this will be recognized where? This will be recognized where? Tell me. This will be recognized in P and L. This will be recognized in P and L. Is that clear, everyone? Is that clear, everyone? It is not a fair value gain. Sania Bansal, it is not a fair value gain. It is a realized exchange gain. Okay, because on settlement we are getting a gain of $684. Now let's suppose the customer has not paid the amount by year end. The customer has not paid the amount by year end. So understand, on 25th of October, we would have recorded this at this divided by 11.16. Okay, now customer has not paid. So what I will do? I will restate, since it's a foreign currency monetary item, we will restate it at the reporting date. So what is the exchange rate on the reporting date? It is 11.02. So I will record the closing trade receivable at 11.02. That is 25953. 25953, right? So now it gives me a exchange gain of 326. But this one is an unrealized exchange gain. And it will also go to P and L. 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 So the realized gain or loss, realized or unrealized, everything will go to P and L. Everything will go to P and L. Now the amount of revenue will be 25627 and the revenue amount will not change with the change in the exchange rate. Is that clear? Is that clear, everyone? Wonderful. Wonderful. Now moving on to the, so foreign exchange also done. Chalo, I think we have done 2 more chapters. So can we take a break now? I think we should take breaks and study because we have to complete the entire syllabus. We have to cover the entire syllabus. Now after the break, I will be covering the important chapter. Financial instruments. Now after the break, I will be covering financial instruments. Okay, so let's take a break of 10 minutes now. Enjoy the break, and after the break we will be covering financial instruments. Okay, now understand. Okay, there is one question coming in from student. Sir, what if we have acquired PPE? Okay, let me tell you. Let's suppose if you have acquired PPE. So on the date of acquiring the PPE, okay, on the date of acquiring the PPE, let's suppose foreign currency multiply by exchange rate. Foreign currency multiply by exchange rate. We will record. Okay, now since PPE is at cost model, we continue the PPE at this value. Itself. Okay, but let's suppose if we have paid the amount using the same amount, but if we have not paid the amount, it's a trade payable. The same treatment will happen for that. The same treatment will happen for the trade payable. For the payable for the purchase of the PPE, it is also called as capital payables. Same treatment. Okay. Now, so let us have a break of 10 minutes now, and post break we will be covering financial instruments. So now we are left with financial instruments, revenue, grants, income taxes, 1, 2, 3, 4, IAS 8, IFRS 13, IFRS 18. I think majorly three chapters. We will need, I think, 2 more hours, and we will be done. 2 more hours and we will be done. Tell me, are you with me for the next 2 hours? Come on, guys, please tell me, are you with me for the next 2 hours? I promised 6 to 8 hours. 6 hours already done. 2 more hours and we will be done. 2 more hours and we will be done. Yes, cash flow also. Cash flow also. Let me write cash flow statements. Cash flows. Cash flows also. But yes, majorly financial instruments and revenue. These two chapters are pending in major. Okay, rest all are small chapters. Are you with me? Okay. Chalo, ठीक है, very good. So let's take a break of 10 minutes. Okay, and then we'll resume back and we'll study. Hopefully, yes. Okay. No worries. We'll be there. We'll be there. Okay. And we'll be covering financial instruments. Have a break of 10 minutes. Enjoy the break. 10 minutes. Chalo, I will give for you guys, I will give 12 minutes. Am I audible, guys? All of you, come on, tell me. Am I audible to all of you? Audio and video, is it clear, everyone? Come on, guys, please tell me. Shall we start the session? Shall we start the session? Come on, guys. So can we have this? How's the Joes, guys? How's the Joes? Come on, tell me. How's the Joes? I am super excited. So now we are starting one of the most important chapter. One of the most important chapter. Financial instruments. Are you ready for that? Come on, guys, tell me. Are you ready for that? Hi, sir. Very good. Come on. Let us start with the chapter of financial instruments. Financial instruments. What is the meaning of financial instruments? So, financial instruments is a contract. Just a minute. Financial instruments is a contract which gives rise to financial asset for one party and financial liability or equity instrument for another party. Okay, let me quickly jump to the word file and discuss there. Just a minute. Yeah, right here. Financial asset, financial instruments. Okay, now, so there are multiple types of financial instruments. I have already made the chart here. Come on. Meaning, come on, guys, tell me meaning of financial assets. So financial assets include what? Cash, investment in equity instruments of investments in equity instruments of another entity, and contractual right to receive cash or any other financial asset. FA means financial asset. I like that. I like that. Don't worry, guys. When I am here, why to worry? When I am here, why to worry? Okay. Ding, 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 ding. See here. Okay. Now, what is the meaning of financial liability? What is the meaning of financial liability? So, financial liability is a contractual obligation to deliver cash or any other. Yes, I realized that I was not visible. Then I made myself visible. It might be the case that my laptop is feeling tired, but I am not feeling tired at all. Might be the case that my laptop is feeling tired. Okay, now contractual obligation to deliver cash or any other financial assets. Okay, now what is equity? Equity is there is no contractual obligation. Okay, what is compound financial instruments? Instruments having feature of both equity and financial liability. Tell me, is the meaning clear for all? Now, classification. Now, financial, first of all, let us study financial liability end to end. We'll take an example. Let us study financial liability end to end. We'll take an example. And then, why are you crying? Who is crying? Why? Hey, I'm not crying. Financial liabilities FL. All good, guys? All good? All good? Come on, guys, in the chat box, everyone. हाँ ठीक है, then study. चलो, financial liability is a contractual obligation to deliver cash or any other financial assets. Okay, what is the classification? So initially financial liability has to be accounted for at net amount received. At net amount received. Okay, that is, I'll say here, net of any transaction cost, net of any transaction costs, if it is incurred. Okay, now subsequently we account for it as amortized cost method. Now what is the meaning of amortized cost method? It means we record finance costs at what method? At effective interest rate. We record finance cost at effective interest rate. Okay, now there is no such classification for financial liabilities. Initial treatment I have already discussed, at net amount received. Subsequent treatment also I have discussed here. Okay, fair value gain loss. For financial liability, there is no fair value gain or loss. There is no fair value gain or loss for a financial liability that comes up. Okay, this is the accounting treatment for financial liability. Let me take up an example and explain further. Okay, financial liability, I have two examples for you guys. Let's see. Jigon company issued 10 million loan notes, 10 million 5% loan notes, 10 million. Just a minute. 10 million 5% loan notes on 1st January 2001, incurring $200,000 issue costs. To tell me what value will we record at initial measurement. Okay, so it will be 5,000 minus 200 is 4,800 is the initial measurement. See, understand why I have reduced finance cost, because when we take loan notes we received 5,000, but transaction cost is my outflow. So what is the net amount that I have received? 4,800. Now finance cost will be recognized at effective interest rate method. Effective interest rate is how much? It is 8.85%. So what is the finance cost? This multiplied by 0.0885. This is your finance cost. Okay, now what is the contractual payment? What is the, okay, I have received 10 million loan notes, so it is 10,000. It is 10,000, sorry. Now okay, ठीक है, 10,000 minus 200, 9,800. Okay, now ठीक है. So finance cost is this multiplied by 8.85%. This multiplied by 8.85%. Now what is the contractual payment that I am making? Tell me guys, what is the payment that I am making? So the payment is equals to 10,000 multiplied by coupon rate of 5% into 0.05. 500 is the payment. So what is the closing financial liability? It is opening plus finance cost minus payment is your closing financial liability. This finance cost will go to P&L. This payment will go to cash flow outflow in financing activities. Right? This will go to SOFP. Is that clear, everyone? Come on guys, please tell me, is that clear, everyone? Now understand what is the meaning of effective interest rate. So understand, the question says that the finance cost is not only this 5%. The question says this finance cost is not only this 5%. No, finance cost means any cost incurred to take up this loan. Now it will include this 5%. It will include this issue cost, it will include this premium, all three. Okay, now all the three accumulative will be accounted for over the entire period of the loan using the effective interest rate. So effective interest rate is calculated considering the transaction cost, any discount on issue, any coupon payments, any premium on repayment, everything is considered. Now ideally in FR and SBR both, effective interest rate will be given in the exam. Now let us take up one more question. This question is primarily from an FR perspective. From an FR perspective, come on guys, please tell me now. Please tell me. The question is asking you that this company has issued $1 million 4% loan notes at a discount of 5%. The loan will be redeemable in 5 years at a premium of 10%. Now the question is not given you effective interest rate, but the question is asking you total finance cost. Tell me, what did I mention? Total finance cost charged to P and L over the entire 5-year period. So now tell me, if I say effective interest rate, using the effective interest rate, total finance cost will include discount, coupon, premium, all three. Okay, so even if effective interest rate is not given, we can compute like this also, right? So tell me, what is a discount? 1 million means 1000 multiplied by 5%, 0.05 is the discount on issue. Now what is the coupon payment? 1000 into 0.04, but for how many years? 5 years. So we'll pay this amount for 5 years, so multiplied by 5. Multiplied by 5. Now what is the premium? 10%. So 1000 multiplied by 0.1, right? So 350 is the total amount. Or if you want to write the figures in absolute figures, I can do that as well. I can do that in absolute figures also. I can make the figures in absolute figures. Absolute figures. 1 million. Yes. Absolute figures. 1 million. Yes. 350,000. So this is the answer. This is the answer. This is the answer. Is it clear, everyone? Is it clear, everyone? Are you understanding the meaning of financial liability? Are you understanding the meaning of financial liability, everyone? Come on, guys, please tell me. Now, moving on to the another topic, that is financial asset. Financial asset. So the financial asset. Come on, guys, can you see me? Financial asset. Classification. So financial assets can be classified at, understand, first of all, investment. What, there are different types of financials, right? If there is an investment in equity instruments, if there's an investment in equity instruments, it can be classified at by default, if the question is silent. If the question is silent, sorry, okay, it will be classified at FVTPL. Okay, but there is an option, there is an irrevocable option at initial recognition to measure it at FVTOCI. Right now, investment in any other financial assets. Okay, it can be measured at a amortized cost method, that is ACM. It can be measured at FVTOCI, or it can be measured at FVTPL. Tell me yes or no. Tell me yes or no. Okay, now how to classify? How to classify? If the business model is held for trade, held to maturity, plus held to maturity plus from that instrument, we will get only principal and interest on specified dates, and there are no other rights. Okay, no. Okay, CCFT, contractual cash flow test, passes. Then we measure it at amortized cost method. Okay, now just a minute. Further, just a minute. If the intention is to hold till maturity, or it can be sold if better returns are available, and again CCFT test passes, meaning thereby solely payments of principal and interest on specified dates, plus no other rights, then in that case it is FVT OCI. Rest in all other cases it is FVTPL. Okay, now how to do the accounting treatment? Let us discuss using the notes. The accounting treatment we can discuss using the notes. You know what I have done for you guys? Please see. Wonderful thing. Wonderful thing. Can you see this chart? Come on guys, tell me. This chart has everything that you can think of. Initial measurement, subsequent measurement, settlement date, everything. Understand? Initial measurement. For FA at amortized cost method, we record financial asset account debit to bank, financial asset account debit to bank, financial asset account debit to bank. Now, FA at ACM and FA at FBT OCI, we capitalize the transaction cost to the cost of the asset. Okay, but for FA at FBT P&L, transaction cost is transferred to P&L. Okay, now subsequent measurement. For FA at ACM, finance income is recognized at effective interest rate. Okay, the journal entry is financial asset account debit to finance income. We receive the contractual payments. Yes. Do we fair value FA at ACM? No, we don't fair value. We ignore fair value changes. FA at FBT OCI. First of all, we record finance income at effective interest rate, same like FA at ACM. But here we record the fair value changes in other comprehensive income. Now at FA at FVT P&L, we record the finance income at coupon rate and fair value changes goes to P&L. Fair value changes goes to P&L. On settlement date, any gain or loss is recognized in other comprehensive income. Any gain or loss is recognized in P&L. But now one important point. For FA at FVT OCI, come on guys, please understand. One important point, please understand here. For financial assets at FVT OCI on derecognition, of financial assets at FVT OCI, please understand, cumulative gain or cumulative fair value, gain or loss recognized in OCI, okay, is transferred to P&L on derecognition of FA. On derecognition of FA. Please keep this in mind. You might expect a question on this one. Okay, is that clear, everyone? Is that clear, everyone? Everyone, come on guys, tell me, is it clear, everyone? Wonderful, wonderful. Okay, so we have covered this part also. FA is done. Now coming to equity. Equity, there is no classification. Equity, there is no classification. Okay, now we have to come to compound financial instruments. Now, what is the meaning of compound financial instruments? Instruments which has the nature of equity and financial liability both. Okay, now let me come to the chart and explain here. Just give me a minute. See here for compound financial instruments. Now, what happens for compound financial instrument, guys? Okay, now these instruments, okay, these instruments has equity and liability both. So our responsibility is to break the instrument into two parts. Our responsibility is to break the instrument into two parts, equity and financial liability. But how? So there is a process called as split accounting. There is a process called as split accounting. Okay, now I will discuss this with the help of an example. But before that, let me give you a quick introduction of this topic, and then I will go to the example and discuss this topic. Okay, so let us come to the quick introduction of compound financial instruments. Compound financial instruments. Now, on initial date, what will you do? You recognize financial liability at present value of contractual cash flows. Okay, now equity is equals to issue proceeds minus financial liability. Now, how will you identify which component is financial liability? Understand, for that I have made a chart which can give you an easy understanding of it. See here, there are three components. There are three elements of any instrument. One is principal, one is interest, dividend, one is conversion right. Conversion right is always equity. Interest or dividend, don't go by the name, evaluate the substance. If it is mandatory, financial liability. If it is discretionary, equity. Now coming to principal, if it is compulsorily convertible to fixed number of equity shares, it is equity. Or if it is convertible to variable number of shares, it is financial liability. Optionally convertible, financial liability. Question is silent, financial liability. Okay, now if principal is redeemable, financial liability. If principal is irredeemable, equity. If there is an option to either redeem or convert to equity, it is financial liability. Why? Because it is optionally convertible. Okay, now once you identify financial liability and equity, then the things become quite very much easy. Why? Because subsequently equity will remain at its own value. Equity is not remeasured. Financial liability will be measuring at amortized cost method. On settlement date, if it is converted to equity, then we pass this entry. If it is redeemed in cash, then we pass this entry. Okay, let us discuss this with the help of the example that we have taken up. Compound financial instruments. See here. Now, convert company issues convertible debentures of $5 million that pays interest at the rate of 2% per annum in arrears. The loan of $5 million is prepayable in full after 3 years. Or, see, understand, it is repayable or convertible to fixed number of equity shares. Oh, ho, 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 ho. So what happens? Principal is optionally convertible. Principal is optionally convertible. So principal is financial liability. Now, coming to interest. Is it mandatorily payable or it is optionally payable? See here, that pays interest of 2% per annum in arrears. So interest is to be paid mandatorily. It is financial liability. Now conversion right is always equity. So now these two are the financial liability components. So we have to calculate the present value of the principal and the interest to compute the value of financial liability. So what is the value of principal? Total is 5 million. So 5,000 multiplied by 0.794 multiplied by 5. This was principal. Now it is interest. What is the value of interest? 2% multiplied by 0.02. Now we have to take the annuity factor for all three, because the interest has to be paid in all 3 years. 0.926 plus 0.857 plus 0.794. Okay, so this is the value of your financial liability. What is the issue proceeds? 5 billion, that is 5,000. So what is the value of equity? 772. So what is the journal entry which will pass? In the bank debit, we received how much? 5,000. But to classify, so we'll say to financial liability credit 4228, to equity credit 772. So this is what we will be recognizing it initially. Now subsequently what will happen? We will subsequently financial liability, we will be amortizing it. Okay, how? See, opening financial liability will be 4228, right? We will record finance cost using the same rate we used to compute the present value, that is 8%, right? So 8% will be used to compute the finance cost. Payment using the same contractual coupon rate of 2%. And closing financial liability. Payment amount, let me just rectify. Just a minute. Okay, so after payment, this is the liability remaining at year end 3. So now on settlement date, if you have to pay in cash, if the instrument holder asks for cash, I will say financial liability debit to bank, credit. Okay, how much? 5,000. 5,000. Liability settled, deal done. But if the instrument holder says no, I need equity, then what will happen? FL debit, we will debit FL. Now to equity share capital, how much? 1,000 shares has to be issued, right? 1,000 shares has to be issued. Now so 1,000, okay, now 1,000 to securities premium, to share premium. Okay, so equity credit, we don't have the face value available, so we will not be able to write, but fine, okay. So it is 5,000, 1,000 shares multiplied by one face value, it will be 1, because the figures are in thousands, so share premium will be 4,999. Okay, so equity share capital we will record at face value, and share premium, okay, over and above balancing figure. Is that clear, everyone? Come on guys, tell me, is that clear, everyone? Compound financial instruments also done. Now coming to one more point, that is investment in equity instruments of another entities. Investment in equity instruments. So as you guys already know, investment in equity instruments and other entities are initially measured by default. By default, they are measured at FVTPL. By default, they are measured at FVTPL. Okay, but subsequently, okay, also we have an option. The entity has an irrevocable option at initial recognition. What? To measure it at FVTOCI. But understand, if an entity opts for FVTOCI, can they go back to FVTPL? No. Reclassification right here. Reclassification, any subsequent reclassification to FVTPL is not allowed. Here. So now understand, what will be the treatment if it is at FVTPL and what will be the treatment if it is at FVTOCI. So let us find it. Investment in equity instruments on 15th March 2001 for 10,000. Transaction cost 500. If it is at FVTPL, transaction cost will go where? Transaction cost where? P&L. Transaction cost will go to P&L. Transaction cost will go to P&L, and the initial measurement will be at 10,000. That is the purchase amount. Okay. Now what is the year-end value? 11,200. See here. Year-end value is 11,200. So what is the fair value gain or loss? So year-end value, initial value is 1,200. 1,200 is the fair value gain or loss. This will also go to P&L. This will also go to P&L. Okay. Now what is the presentation in P&L? So in P&L, you will say fair value gain of 1,200 minus transaction cost of 500. Transaction cost of 500, which leads to 700 gain in PL. Okay. In OCI, nothing will go. In closing SOFP will be at 11,200. Okay, this is the treatment using FVT P&L. Now if you see requirement number 2, what if the entity opt for irrevocable option at initial recognition? Now if the entity opt for irrevocable option, then in that case transaction cost is capitalized to cost of asset, right? So the initial measurement will be at 10,500. It is at 10,500, right? Year-end value is 11,200. So fair value changes is this minus this 700. So will any amount go to P&L? No. OCI fair value gain of 700. Okay. In closing investment in equity instruments at SOFP will be at 11,200. Is that clear, everyone? Come on guys, tell me, is that clear everyone? Now, one more topic remaining in the financial instruments chapter. One more topic remaining. Let us cover that. De-recognition of financial assets. So understand, guys. Okay, if the factoring, just a simple understanding for this. If the transfer of FA happens using recourse arrangement or non recourse arrangement, what is the treatment? If it is under non recourse arrangement, de-recognize FA, recognize sale proceeds, difference is P and L. Now if it is under recourse arrangement, in that case, if it is in a recourse arrangement, then do not de-recognize financial assets. Sale proceeds, whatever you receive, is recognized as financial liability on which you record finance costs. Okay, on which you record finance cost. There is no gain or loss that is recognized on date of transfer. Subsequently, you just recognized finance costs in P and L. Is that clear to everyone? Okay, now what I have done is I have done one analysis. Whatever, see, in the chapter of financial instruments, there are a lot of discount rates that were used. So what I did for you guys is I have made a summary of all the discount rates to be used in the chapter of financial instruments. Now there is a question coming in from students, what is recourse and non-recourse arrangement? I'll come to it, don't worry. Okay, so these discount rates, I believe you should go through it and it will give you a fair understanding of which discount rate to be used on which perspective. Okay, now student is asking, what is the meaning of recourse and non-recourse arrangement? If a student has asked, I have to explain. So let me explain it, guys. Okay, now understand, this is Vishal Jain. I had a trade receivable of $1,000 from, tell me, whose name shall I take? I need one name. Hari. From Mr. Hari. Okay, now, but point is, this receivable is after 6 months. But I am in need of money now. Okay, I am in need of money now. So what happened is, what I went to bank. And I sold this trade receivable. And I received $800 from the bank. Okay, now there, at what terms and conditions I sold this trade receivable to the bank is what matters. Now, case 1. If, okay, now in case 1, I have told to the bank, see, I have sold this trade receivable to you. Now it's your responsibility to collect from Hari. I am not involved. It's bank responsibility to collect the money from Hari. If Hari pays, good for bank. If Hari doesn't pay, it's a loss of the bank. This is called as non-recourse arrangement. Meaning thereby, bank cannot come back to me. To for this loss. Bank cannot come back to me. Why? Because I have transferred the risk and rewards to the bank. So meaning thereby, non-recourse arrangement means what? Risk and rewards transferred. Okay, but if the bank can come to me for the loss, meaning thereby, if Hari is not paying, bank is asking me to pay. when bank can come to me. This is called as recourse arrangement. It means risk and rewards not transferred. Is it clear to all of you now? Okay, is it clear to all of you now? This arrangement is also called as factoring arrangement. Is it clear, everyone? Come on, guys, tell me, please. So with this, we complete the chapter of financial instruments. Come on, guys, tell me. Is it clear, everyone? Is it clear, everyone? How are you feeling, all of you? I believe we should appreciate that we are studying continuously from the last 7 hours. Okay. Financial instruments, one of the major chapters is done. So let's again take a break of 10 minutes. Okay, we'll take breaks and study. Okay, let's take a break of 10 minutes and then we'll cover up two important chapters. Two important chapters: revenue and tax. Revenue and tax. Okay, chalo. But everyone be back here after the break. Guys, I told whether it is 1 a.m. in the night, 2 a.m. in the night, doesn't matter. I have promised and I will fulfill that. I have promised and I will fulfill that. No, Ravdeep, no, Mr. Ravdeep Kaur, you are not allowed to get tired. It's the session of Mr. Vishal Jain and we should study till the very end, see the energy and be energetic in the class for the next part, and we will be covering. Just give me one to 1.5 hours more and I will cover the entire FR syllabus here today with you. Okay. I believe, see, what is pending? Grants, Chotu chapter, small chapter, grants, small chapter, tax, small chapter, IES 8, small chapter, IFRS 13, small chapter, revenue, little bit important chapter. Okay, important chapter from an exam perspective. Cash flows, again, a small chapter, right? So we will be done. We'll be done. Right, I need 1 to 1.5 hour. Just give me 1 to 1.5 hour and I will cover the every perspective. You need 15 minutes break, take 15 minutes break, but be back here after the break, all of you. Be back here after the break, all of you. Okay, let's take 15 minutes break, all of you. And there we go, guys. We are back after the break. How is the Joes, guys? Has the Joes gone down? With so many lovely comments from students attending from across the world, I am quite happy that I am able to give back to my ACCA community, my ACCA students, my loving ACCA students. Okay, now come on, guys. How's the Joes? Everyone, come on, guys. Tell me. Just give me 1 to 1.5 hours. Just give me 1 to 1.5 hours, and I promise I will cover the entire syllabus. Okay. Chalo, let us cover the rest part of the syllabus. The jaws should be high at its peak. Keep the energy high. Okay. Keep the energy high. And the target should be target 80 plus, whether you are appearing FR or SBR, target 80 plus, and post results. Come back to this video and comment, sir, I have achieved it. I have achieved it. Chalo. Hey, audio is working now. Guys, is audio working? Two audios. I don't think so. Is there any challenge in the audio that you are facing? Is everything okay? Is everything okay? Audio, video clear? Can you please confirm quickly, guys? Quickly. Can you please confirm quickly? Is the audio, video clear? Chalo, very good. Now let us start a very important chapter, revenue. Now, and I will take the approach of comparative approach. Revenue. IFRS 15, revenue. Now, tell me, point number 1. I believe you are aware of the 5-step approach. Come on, guys, tell me. I believe you are aware of the 5-step approach. Guys, you have to be very much energetic, very much active in the class. I believe you are aware of the 5-step approach of revenue. Okay, 5-step. Step 1, tell me what? Step 1, tell me what? Contract. Identify whether valid contract exists. Okay, step number 2. Tell me, step number 2 is what? Identify performance obligation. Now, what is the meaning of performance obligation? What is the meaning of performance obligation? A distinct promise to transfer goods or services. A distinct promise to transfer goods or services. Now, step number 3 is determine transaction price. Now, in step number 3, we have few things to be studied. Point number 1. What is the meaning of transaction price? Transaction price is the amount that we expect to receive from the customer. Transaction price, what is the meaning? So, transaction price is the amount that the entity expects to receive from the customer. Guys, please forgive me for the wrong spelling. Receive from the customer for transfer of goods or services. Excluding any amount payable to third parties. Okay, now adjustment number 1 is variable consideration. Now tell me, variable consideration. Do we recognize variable consideration as part of transaction price? Do we recognize variable consideration? Yes, it is a part of transaction price, but there is a condition. If it is highly probable that significant reversal will not occur when uncertainties attached are resolved. Okay, it is a part of transaction price, but if it is highly probable that significant reversal will not happen when the uncertain, I will write the word significant fully, significant reversal will not happen when the uncertainties attached are resolved. Okay, now second adjustment number two, significant financing component. Now tell me guys, in significant financing component, what is the meaning? So meaning is there is a difference between transfer of goods and receipt of consideration, and the gap is more than 12 months. It is more than 12 months. The gap is more than 12 months. Okay, now tell me, when will you recognize revenue? Come on guys, tell me, when do we need to recognize revenue? When do we recognize revenue? Come on guys, please tell me, when do we recognize revenue in case of significant financing component? So we recognize revenue on the date when control is transferred, irrespective of when we have received the transaction price. Irrespective of that, we record revenue on the date when the control is transferred. Okay, when the control is transferred. What amount at cash equivalent price? At, just a minute, cash equivalent price. Okay, if cash equivalent price is not available. Sir, can you give an example of significant financing component? Yes, when we purchase when we sell any asset or any goods at EAI model, when we transfer the goods today, but we receive the sale consideration across the future years. Okay, when the cash equivalent price is not available, then recognize revenue at the value of contractual consideration on the date when control is transferred. Just a minute, let me show something to you. Guys. See here. Please see. If we have transferred the control here, we recognize the revenue here. Okay, we transfer the control here, we receive the consideration after 2 years. Okay, so we record revenue here at what value? At present value. Okay, but we receive the consideration here, but we transfer the control here, then we recognize the revenue here, but what value? The future value. Is that clear, everyone? There is a misconception among students that we record revenue at present value. No, it's not present value. It can be present value, it can be future value. We recognize the revenue at the value of contractual consideration when the control is transferred. Is that clear, everyone? Come on guys, please tell me. Okay, now adjustment number 3, non-cash consideration. When there is a non-cash consideration, then in that case we recognize revenue at, now understand, just link this concept with IAS 16 exchange barter transaction. Understand, in barter transaction, I purchased this asset, right? So I used to recognize the asset purchased at cost Cost means what? What we gave. So I recognize this asset at the fair value of asset given up. Okay. Now here I am standing at the other side of the table. I have sold this mobile phone to you. And you have given me this. Now tell me, what is my revenue? What I have received. So I have received this one. So what is the fair value of this one? So my revenue will be fair value of asset received. I believe you are able to link. I believe you are able to link. Come on guys, tell me, is that clear everyone? Okay, now coming to the next step, step number 4. Allocate transaction. Can you give example of variable consideration? Yes, I can give example now. Okay, let's suppose I now let's suppose, please understand, when the amount is not certain. Let's suppose I am a contract. Okay, let me identify an example. Simple examples which you can relate to. Okay, now I am DLF. Okay, Okay, now my role is to construct properties. My business is to construct properties. Now Fortis, a hospital came to me that please construct hospital for me. I told yes, I will construct. How much money will you give me? So then Fortis hospital says that I will give you $2 million. DLF is like, deal done. But now DLF's Fortis says that if you give this property to me 1 year in advance, okay, 1 year early, then I will give you additional $0.5 million. Now tell me, as of today, DLF knows kya? As of today, does DLF know whether they will be able to deliver it early or not? No. It's a variable consideration. That 0.5 million is a variable consideration. Now, Fortis again goes to DLF and says, I will pay you $1 million extra. $1 million extra over and above the consideration if the property meets the quality and the safety check. Is met, then I will pay you $1 million extra. Tell me, as of today, do DLF know? Tell me, does DLF know will they receive that $1 million or not? No. It is variable upon future events. Okay, that is called as a variable consideration. Now, moving on to the next step. Step number 4, allocate transaction price. To each performance obligation. In what ratio? In the ratio of their stand-alone selling price. Sir, what if okay, just a minute. This is called as SSP, stand-alone selling price. What if stand-alone selling price is not available? Then in that case, we have 3 options. Option number 1, adjusted market price or cost plus margin. Okay, or residual. Okay, now this is step number 4. Now step number 5. Recognize revenue as and when the control is transferred. Very important step here. Let us discuss this part in depth. Now, understand, control can be transferred at a specific point in time, or over a period of time. right? Now, how to identify whether the control is transferred at a specific point of time or over a period of time? How to identify that? How to identify that? So standard gives you three conditions. If any of the below conditions are achieved, are satisfied, you can say, even if one is satisfied, then if any of the below conditions are satisfied, okay, then revenue, then you can say control is transferred at a control transferred over time. Control is transferred over time. And what are the conditions? What are the conditions? Let me show it to you. See here the conditions. The three conditions. The three conditions. Yes, here it is. Please see. Condition number 1. Customer simultaneously receives and consumes the benefit as the entity performs. Now, as and when I'm teaching you, you are receiving and consuming the benefit. Right? Tell me yes or no. As and when I'm teaching you, you are receiving and consuming the benefit. Condition number 2. Entity's performance creates and enhances an asset that the customer controls. And condition number 3, entity does not have any alternative use of the asset and entity has the enforceable right for the payment work till done. Okay, till date. Now in the exam, ideally you are not required to prove the three conditions. They will give you the conditions. And it is proved either it is over time or at a specific point of time. You just need to identify. If the revenue has to be recognized at a point in time, how to recognize revenue. If the revenue has to be recognized over a period of time, how to recognize revenue. Okay, so now understand. Coming back here. If it is a point of time, if we conclude it is to be point of time, okay, recognize revenue at a point when control is transferred. At the point when control is transferred. At the point when control is transferred, recognize revenue at that point when control is transferred. Recognize revenue at that point. But if it is over time, then in that case, you have to measure progress. You have to measure progress and recognize revenue at input method or output method. Now, what is the meaning of input method? Come on guys, tell me. What is the meaning of input method? Costs incurred till date divided by total estimated costs. This is called as input method. Then what is the output method? Work certified till date divided by total transaction price. Is that clear, everyone? Come on guys, please tell me. Is this part, because I have seen students struggling with these two topics. In these two topics. Is this point clear, everyone? Okay, now I have made a wonderful chart for you guys. For revenue to be recognized over a period of time, I have made a wonderful chart. Do you want to see that chart? Guys, please understand. If the revenue has to be recognized over a period of time, meaning thereby 2 years, 3 years, 4 years, then we should know now that at each reporting date, okay, this much percentage of work is done, so we can recognize this much revenue. right? This much percentage work done, we can recognize this much revenue, right? That is called as measure of progress. Now, how can we measure how much work is done? It can be measured at either input method or output method. Input method says that how much cost I have incurred till date, what is the total estimated cost. So this much percentage work is done till date. Output method says that what is the work certified till date divided by total transaction price, means this much percentage work is done till date. Now entity can use either input method or output method. Sir, which method to be used in the exam? Question will specify that. Question will specify that. You need not worry about it. Question will specify that. Is that clear, everyone? Is that clear, everyone? Now I have made some wonderful chart. Total TP means total transaction price. Bacha, total, you can say transaction price, or you can say contract price. If not, you can say contract price. Contract price. Okay? Is it clear? Now, can I move? Can I go to my chart? Can I go to my chart? Let's come to the chart and understand the revenue recognition. Now, whenever the revenue has to be recognized over time, please evaluate whether the contract is a profitable contract, loss-making contract, or an uncertain contract. If it is a profitable contract, then the standard says recognize revenue and cost of sales, recognize revenue and cost of sales as per input method or output method, whatever is specified in the question. Okay, question will specify, bacha. Question will specify whether it is input method or output method. Question will specify that. Okay, now if the question says input method, the measure percentage completion is cost incurred till date divided by total estimated cost. Now, what is the revenue that you will recognize? Transaction price multiplied by the percentage work done till date minus revenue already recognized. This is the revenue to be recognized for the current year. Cost of sales will be the total cost incurred in the current year. Now, in output method, you recognize revenue as work certified in the current year and cost is cost incurred in the current year. Is it clear, everyone? Under input method, how do we recognize revenue? And under output method, how do we recognize revenue and cost of sales? Is that clear, everyone? Now, coming to loss-making contract. So under loss-making contract, what you have to do is, first of all, recognize revenue and cost of sales as per input method or output method as specified in the question. Then calculate what is the total loss. Then calculate loss not yet recognized in P and L. Calculate loss not yet recognized in P and L. Okay, loss not yet recognized in P and L. Okay, now whatever loss is not yet recognized, recognize that loss by using this entry, cost of sales account debit, to provision for onerous contract. I knew that just by explaining the treatment, it might not be clear to you guys. So why not take up an example? Let's suppose the transaction price is 8,000, total estimated cost is 10,000, percentage complete is 6,000, cost incurred till date is 6,000. Okay, now understand please. So what is the revenue that you will record? 8,000 ka 60% is 4,800, right? What is the cost incurred till date? 6,000. So what is the loss you have recognized? 1,200. Now see here, what is the total loss? Transaction price this much, total cost this much. So your total loss is 2,000. You have recognized a loss of 1,200. So what is the loss not yet recognized? 800. So we will say we have to recognize this loss also today itself. Okay, being conservative, we will recognize this loss today itself. Okay, so overall loss 2,000, loss recognized in P&L 1,200, loss yet to be recognized 800. So we'll add this 800 to cost of sales and provision for onerous contract. So in the P&L, we will say my revenue is 4,800. My cost of sales is 6,000 plus 800 is 6,800, giving a loss of 2,000. In SOFP, I will record a provision for onerous contract of 800. Is this clear? Guys, loss-making contract is one of the favorite topic of the examiner. Loss-making contract is one of the favorite topic of the examiner. Okay, now, if it is uncertain whether the contract is loss-making or profit-making, in that case, you recognize revenue is equals to costs incurred. Revenue is equals to cost incurred. Whatever cost you have incurred and it is recoverable. Whatever cost you have incurred and it is recoverable, you recognize revenue for that amount. Is that clear, everyone? Come on, guys, tell me, please. Is that clear, everyone? Come on, guys, tell me, please. Now, under business model, I believe there are few important business model which you should definitely study. One is the rearrangements, repurchase arrangements. Please understand this one. Repurchase arrangements. When the repurchase means I have sold the asset and I have entered into a contract. Understand? Repurchase basically means what? Let me explain that. Today, I sold, but I have retained a right to repurchase in future. In the future, I might repurchase. Okay. So in that case, how to account for it? So now the treatment is very simple, guys. The treatment is very simple. Okay. If the repurchase price is greater than the original selling price, meaning thereby I am selling at 100, but I will repurchase at 121. I am giving 21 extra. Why? Because I am taking a loan of 100 which I am repaying 121. So it is a financing arrangement. Okay. So always understand, if the repurchase price is more than the original selling price and the customer cannot use the goods or services, it is like taking a loan by giving the product as a mortgage. So it's a financing arrangement. Now, but if the repurchase price is less than original selling price, okay, then it's a lease transaction under IFRS 16. Coming to contract costs. Contract costs are of two types. Contract acquisition costs. Acquisition cost, it's a marketing cost, advertisement cost. Contract execution costs means contract fulfillment costs. So now standard says that if the contract acquisition costs are the cost incurred to obtain the contract, that would not be incurred if contract not obtained, means this cost is incurred specifically to acquire this contract. And this cost would not be incurred if this contract was not acquired. Example, brokerage. Brokerage you pay only if the contract is executed, right? So now the standard says that if it is of this incremental nature, recognize as asset and amortize over the contract term. If it is not of incremental nature, P&L. Contract execution costs. Okay. So you have to account for that as per respective standard. If there is no respective standard for contract execution cost, recognize as asset and amortize over the contract term. One important thing that you have to study from in the revenue chapter is, which the standard examining team asks time and again, is contract asset and contract liability. Now, what is the meaning of contract asset and contract liability? Understand, please. What is the meaning of contract asset and contract liability? Understand. If cumulative revenue recognized means till date is greater than amounts invoiced and received from customer. Okay, this leads to contract asset. Sir, can you give an example? Yes, buddy, I will give an example. Let's suppose in year 1, year 2, I have recognized a revenue of 1000. I have recognized a revenue of 500. So what is the cumulative revenue recognized? 1500. But so far we have received only 1200 from the customer, invoiced and received from customer is 1200. So you will record a contract asset. Of $300. Now then, what is contract liability? What is contract liability? So for contract liability, it is very simple. Please understand contract liability. Contract liability. If you have received amount from customer, but not transferred goods or services to customer, that is advance consideration. If you have received any advance consideration from the customer, that is called as your contract liability. Is that clear, everyone? Come on guys, please tell me, is that clear, everyone? So with this we complete one of the major important chapters, revenue. Is that clear, everyone? Come on guys, please tell me. Quickly, let's complete. Give me 5 minutes. I will complete 2 more small chapters. What is the doubt, Hari? Tell me, can you please repost your doubt? Can you please repost your doubt? I have not seen that. Can you please repost your doubt? I have not received your doubt. Can you please repost it? Separate standalone price. What is the doubt in that? Tell me. Standalone selling price. At what price? Let's suppose generally I sell the bundle of these two goods. Okay, I sell the bundle of these two goods. So now if I have to sell only this, at what price I can sell this one is called as standalone selling price. In transaction price, how to allocate in one performance obligation. Let me explain this one. Let me explain. Since it's a query of Mr. Hari, I will definitely explain. I will not let even a single query go off till the time it is possible for me. Definitely I'll take it up. See here. Please see here. Please see here. This example will clear all your doubt. Okay. X Limited enter into contract with a customer for sale of software, 1 performance obligation and 3-year technical support. Performance obligation number 1, performance obligation number 2. Okay. Now for $30,000, this is transaction price. This is transaction price. Now understand. The software and the 3-year technical support can be sold separately for 20,000. This is standalone selling price for performance obligation number 1. And 15,000. This is the standalone selling price for performance obligation number 2. Okay. Now understand. So step 1, assume contract exists. Step 2, performance obligation, sale of software and sale of 3 years technical support services. Transaction price is 30,000. Transaction price is 30,000. Now if I sell the software only, I will sell at 20,000. If I sell the technical support services only, I will sell at 15,000. Okay. So now basically we are giving a discount of 5,000 to the customer. We are giving a discount of 5,000 to the customer. Now how will I understand? How will I allocate? How will I allocate? So allocation will done like this. Allocation will happen like this. Performance obligation number 1. Transaction price is 30,000 multiplied by standalone selling price for performance obligation number 1 is 20,000 divided by what is the total standalone selling price? 20,000 plus 15,000 is 35,000. So this is the transaction price allocated to performance obligation number 1. To performance obligation number 2, 30,000 multiplied by 15,000 divided by 35,000 is equals to how much? 17143, 30,000 into 15,000 divided by 35,000 is 12857. 12857. 12857, right? So this is the allocation of the transaction price. Now, since we have discussed this, let us discuss how will the revenue be recognized. Now tell me, performance obligation number one is sale of software. So sale of software happens on this particular date. We transfer the control of software on the date when we sell the software. So we'll recognize a revenue of 17143 here itself. Now, so the journal entry which I will pass here is will be bank account debit 30,000 to revenue for performance obligation number 1. Okay, how much? 17143 to contract liability, because we have received the money but not yet transferred the goods or services for 3-year technical support services, which will be transferred over the next 3 years, is 12857. Now this 12857 will be recognized as revenue at year end 1, at year end 2, at year end 3, equal amounts over the 3 years. Is that clear now, Mr. Hari? Is that clear now, Mr. Hari? Now moving on to the next chapters. IAS 8, accounting policies. So IAS 8 deals with accounting policies and accounting estimates. What are policies? Policies are the systems, processes, conventions. Okay, now systems, policies, conventions. Okay, now policies remain consistent year on year. If the policies change, if the policies change, we need to account for the change retrospectively. We need to account for the change retrospectively. Okay, we need to account for the change retrospectively. Now, estimates are the assumptions made by the management. Assumptions made by the management. Okay, now if the assumptions change, they has to be accounted for prospectively. They have to be accounted for prospectively. Is that clear, everyone? Okay, simple point. Okay, so if the accounting policies change, we have to do a retrospective effect. We have to give a retrospective effect, and we have to disclose why the change has happened. Now the change can happen in the policy due to a change required by the IFRS standard or a better presentation of the financial statements. And whenever we change the accounting policy, we have to give the reasons for change and what is the effect of the change on the earning per share. Okay, now whenever the accounting estimates changes, we have to account for it prospectively, and we have to disclose what is the nature of change and the amount of change. Simple. Moving on to another standard, fair value measurement. Fair value measurement. So from a fair value measurement, you just need to understand few things. Disclosure of level 1, level 2, level 3 inputs. From a fair value perspective, you need to understand two things. Disclosure of fair level 1, level 2, level 3. Please understand. What is level 1? Quoted price, unadjusted, active market exists of identical assets and liabilities. Let's suppose I have the equity shares of Reliance. Tell me, do I have a quoted price available in the active market? Do I have a quoted price available in the active market? Yes, I do have it. So it is a level 1 input. Now, quoted price is available in the active market, not of, see, understand, the difference between level 1 and level 2 is identical. Level 1 is identical assets and liabilities. Level 2 is similar assets and liabilities. Sir, can you explain the difference between identical and similar? Yes, but yes, I will explain. Just give me a minute. Let me find out something for you guys. Just a minute, guys. Yes, please see. These two are called as identical, exact same. Now, this is also a battery. This is also a battery, but they are not exact same. They cannot be called as identical, but they can be called as similar. Similar. Are you getting my point? You got the difference between identical and similar? Now, so quoted price available in the active market for similar. Now level 3 is quoted price is not available, no observable inputs. We calculate the values. Like for example, we calculate the fair value of financial liability. We calculate the value of financial liability at the present value, right? We calculate the value of financial liability at the present value of the contractual cash flows. That is level 3 input. That is level 3 input. Okay, now done. So this is also done. Now what else? Grants, tax, cash flows. Okay, now 3 chapters are remaining now. Grants, tax and cash flows. Let us cover grants. Grants. Grant. Guys, only 20 to 25 minutes. Only 20 to 25 minutes I need further and we will be done. We will be done. Come on, guys. How's the Joes, everyone? Come on, come on, come on. Tell me now. Show some energy in the class. We just need 25 more minutes. We have studied for 7 hours, 49 minutes so far. At a stretch, 7 hours, 49 minutes. We are completing the 8th hour. We are completing the 8th hour, right? We are completing the 8th hour. We are completing the 8th hour. Okay. Come on, guys. Tell me how the Joes. Everyone. Low now? Why? No. It can't be low. It can't be low, buddy. Government grant. Understand? Tell me. If it is an unconditional grant that we have received, we will recognize it as income upfrontly. If it is a grant related to income, we first of all recognize it as deferred grant and then recognize it over the grant period in the ratio of the costs incurred. Okay. Now, if it is a grant related to asset, if it is a grant related to, just a minute. If it is a grant related to asset, then we have two approach. Net method or gross method. See here. Many students are asking, sir, what about group accounting? I already mentioned, guys. Group accounting, I uploaded 2 weeks ago the detailed revision of group accounting, spending 90 minutes. The detailed revision of group accounting I already uploaded because it was in my plan to conduct these sessions and I knew that conducting group accounting as well will take me around 10 to 12 hours, which is not practically possible for me to take for at a stretch, right? So I have already uploaded the group accounting revision. I have already uploaded the group accounting revision. Okay. And trust me, guys, this is the most exam oriented revision of group accounting. You just watch it and then come back to me say, okay, it is most exam oriented revision. If you want to see, I'll show it to you. See how I have discussed the group accounting here. See here, just see. Explaining each and every adjustment exactly in the similar manner how we have to deal with in the class, in the exam. See, explaining each and every adjustment in the most exam oriented manner. Okay, now understand gross method. Now on the date of receipt, recognize as deferred grant liability. Gross method. In the gross method, we account for grant and asset separately. We account for it separately. So asset has to be depreciated over its useful life. Grant has to be okay. Now grant has to be initially on the date when we receive the grant, recognized as deferred grant income, and then recognize this deferred grant income as income over the useful life of the asset. over the useful life of the asset. Okay, now in the net method, we adjust grant, with a cost of asset. Okay, and then we depreciate the asset over useful life, over its useful life. Okay, now further, repayment of grant. When the grant has to be repaid, first of all, we adjust from deferred grant liability. Any excess has to be adjusted from P and L. Now the challenge generally comes up if it's a deferred grant, if it's a grant related to asset, and we have used the net approach. How to deal with this scenario? So for this, I have taken up an example. Let me discuss that example with you guys. Okay, and trust me, this example will give you a lot of confidence in the exam. Just give me a minute. So students are asking, what is the secret of my energy? Boost is the secret of my energy, guys. I drink Boost day in, day out. Chalo, come on, guys. Let's study. Now, so guys, understand, whenever the grant repayment accounting has to be done for an asset, for grant for which we have done the net accounting, please understand, account for it like this. See, what is the accounting done with the grant? What is the accounting that would have been done if there is no grant? Calculate the impact, and this is what you have to account for. Let's see. On 1st January 2006, you received a grant of 30,000 for an asset having a cost of, you received grant of 30,000 for an asset having a cost of 90,000, life of 6 years. So cost of the asset was 90,000. Grant you received 30,000. So net cost on 1st January 2006 is 60,000. Depreciation has to be done over 6 years. So the carrying amount is 60,000 minus 10,000 is 50,000. Now, if there would have been no grant, then how will the accounting work? Simple, make it 0. This is what is accounting. Now, what is the impact? Tell me. You have to increase the depreciation by 5,000. You have to increase the value of the asset by 25,000. So what is the entry? Increase the asset by 25,000. Increase depreciation expense by 5,000 and recognize a grant payable liability of 30,000. Recognize a grant payable liability of 30,000. This is the accounting treatment of grant repayable when the asset is under, when the accounting of grant has been done under net method. Is that clear to all of you? Come on, guys, please tell me. Is that clear to all of you? Come on, guys, please tell me. Is it clear, everyone? Come on, guys. I need a heads up from all of you. I need a heads up from all of you. Sweta Ahuja, don't worry about anything. I have promised full syllabus revision. I will give you that. How is my responsibility? Okay, chalo. So grants also done now. In the grants, there is one topic called as grant government assistance. Government assistance. What is the meaning of government assistance? Any assistance received from the government for which the value cannot be placed. For which the value cannot be placed is called as government assistance. Do we recognize government assistance in the financial statements? No, we just disclose in the notes to accounts. We just disclose in the notes to accounts if it is material. If it is material, we just disclose in the notes to accounts. Is that clear to all of you? Come on, guys. Make some noise. Make some noise. Come on, guys, everyone. We are about to complete that. Okay, now tell me what topic next? Tax. Okay, tax, let us study here. Income taxes. Tax. Income taxes. I believe this marathon session would have been the longest marathon session in the history of ACCA YouTube marathons. I believe. I believe so. What do you think, guys? Come on, tell me. Are Baba, I am there now. I told everything will be covered. Why don't you trust me, guys? Why don't you trust me? You need to place trust on me. What is the meaning of forgivable loans? So forgivable loans basically means the loan given by the government. See, understand, it can be multiple, it can have multiple reason, you can say meaning. Okay, one meaning is loan, government has given me the loan which I am not required to repay it back to the government. Government has given me the loan at nil or concessional rates. At nil or concessional rates. Okay. So whatever is the free part is your government grant. Whatever is the free part is your government grant. Whatever is the benefit that we have received from the government is the government grant. Income taxes. Now in income taxes, we have to study from two perspectives. One is current tax and another is deferred tax. Now, let me have some water. Someone is saying, sir, it's 1 a.m. I told initially, you guys didn't trust me. I told I have come here to help you with the entire syllabus revision and I will be there till whatever time it is, but complete the syllabus. Okay. Give you the complete syllabus. I think in the next 20 minutes, we'll be wrapping up the session. In the next 20 minutes, we'll be wrapping up the session. It is so gives me immense proud, a sense of happiness that still there are around 60 to 65 students still watching it live continuously from the 5 p.m. India time at a stretch from last 8 hours. Wonderful, guys. Hats off to all of you. Hats off to all of you. It deserves an appreciation to all of you guys. Come on. Okay. Now current tax. What do you record in P and L? Tell me, in current tax, what do you record in P and L? First of all, you record tax charge. You record tax charge for current year. You record tax charge for current year plus debit balance of current tax. Tell me, guys, what do you mean by debit balance of current tax? What do you mean by debit balance of current tax? What do you mean by debit balance of current tax? It means under provision in the previous year. It means under provision in previous year. Now minus credit balance of current tax. What do you mean by credit balance? Over provision of previous year. Over provision of previous year. This is what will go to P and L. This is what will go to P and L. Now what will go to SOFP? What will go to SOFP? In your SOFP you will record, current tax liability. Current tax liability. In your SOFP you will record current tax liability for the tax charge for current year If there is a tax charge for the current year, you will record current tax liability, or you will record current tax asset for tax refund for current year. If the question says tax refund for the current year, you will record current tax asset. If the question says tax charge for the current year, or you will say current tax liability. Come on guys, is it clear? So this is all about current tax. Now about deferred tax. How do you calculate deferred tax? Calculate carrying amount, calculate tax base, calculate temporary difference is equals to carrying amount minus tax base, right? Now, for each temporary difference, you have to classify as taxable temporary difference or deductible temporary difference, right? Taxable temporary difference means it will increase future tax payments. If it increases future tax payments, it is a taxable temporary difference. If it decreases future tax payments, it is a deductible temporary difference, right? Now each taxable temporary difference multiply with tax rate will lead to deferred tax liability. Now deductible temporary difference multiply with tax rate will lead to deferred tax asset. Okay, now understand guys, please, how to understand in the exam from an exam perspective. If the for an carrying amount of asset is greater than tax base, it is a taxable temporary difference. Okay, it is a taxable temporary difference. Okay, please understand this part. Please understand this part. Okay, now in P and L, now what you have to record? Understand, for transactions whose base transaction is recorded in P&L, we record the deferred tax impact in P&L. If the transaction is recorded in other comprehensive income, the deferred tax impact will be recorded in other comprehensive income. If the transaction is recorded in equity, the deferred tax impact will be recorded in equity. Okay, now, so let's suppose example, revaluation gain. It is recognized in other comprehensive income. Tell me, where will we record the deferred tax impact of the same other? We will recognize deferred tax impact in OCI. Is it clear, everyone? Now, I think I have taken up an example. I have an example for tax. Yes, I do have an example. This example will clear up all the points. Just give me a minute, guys. Can you see this example? I have discussed everything. See here, please, everything. Just solve this question with me. Just solve this question with me. SBR students, you additionally have application of the deferred tax also, okay, which I will be discussing it tomorrow with you guys. Okay, now please understand, guys. Ewington trial balance shows a debit balance brought forward on current tax. Tell me, it has to be debit balance under provision, add to the P&L, under provision, add to the P&L. How much? 2100. Okay, now, and a credit balance of deferred tax, skip it now. Tax charge for the current year is how much? 16.2, 16,200. So what will go to P&L? Total, Alt H US, 18,300. This will go to P&L. Now, this will go to P&L for current tax. Okay, now, what will go to SOFP? In SOFP, you will record current, since it's a tax charge, so you will record current tax liability. How much? 16,200. Is it clear? Is current tax clear to all of you? Now come to deferred tax. credit balance of 5.4 million on deferred tax. Okay, so it is opening deferred tax liability. Let me write here. Opening deferred tax liability is 5.4 million, means 5,400. 5,400. Now, just now I told, carrying amount of the net assets in excess of their tax base. It's a taxable temporary difference. It's a taxable temporary difference of 13 million. So what is the closing deferred tax liability? What is the closing deferred tax liability? 13,000 multiplied by 30% is equals to 3,900 is your closing deferred tax liability. Closing deferred tax liability 3,900. What is the movement? Can you guys please tell me? 3,900 minus 5,400 is negative 1,500. Negative 1,500 is the movement. Okay, negative 1,500 is the movement. Now the question also goes on to state that 3 million is on account of revaluation surplus. Now tell me, revaluation surplus is recorded where? OCI. So where will the impact of deferred tax go? OCI, right? So 3,000 into 30%. 900 will go to OCI. So what is the amount that will go to P&L? So I will say, understand, the amount that will go to P&L is closing, that is 3,900, minus opening, that is 5,400, minus what is the amount that goes to OCI, 900. So what is the impact? This will go to P&L. So now always remember guys, the deferred tax P&L impact is closing deferred tax liability minus opening deferred tax liability. Okay, now minus OCI impact, minus OCI impact, minus equity impact, minus equity impact. This is what goes to this one, P&L. Deferred tax, sorry. Deferred tax to P&L. Is it clear, everyone? Is it clear, everyone? Okay, so this completes our income taxes as well. Now coming to cash flow statements. Last chapter, guys. What about equity impact? There is no equity impact in this question now. There is no equity impact in this question. Ideally, we don't have any equity impact question. At FR level, we don't have any equity impact question. At SBR level, we have one equity impact question of share-based payments, which I will discuss in the SBR class, not now. Is that okay? Now moving on to cash flow statements. Here is cash flow statement. Shit. Guys, I have forgot to bring the cash flows chapter. Kya? Oh shit. Cash flows chapter ka notes, I forgot to include it here. I'm so sorry. I'm so sorry. Can I cover that up tomorrow and with you guys? I'm so sorry, guys. Cash flow chapter ka notes only I forgot to bring in here. So sorry. Okay. Now, ratios. The plan is to upload the recording of the ratios by Monday. Okay. Ratios, that's what was my plan initially itself. Ratios, I will be uploading ratios on Monday. Okay. Now, let us have a closing note now. Just a minute. A closing note is here. Where is it? Ending note. Yes. Now, group accounting. Video, I will be giving the link in the description box. Single entity financial statements. Okay, it is just made up of financial IFRS standards, right? But there is one master question called as new Craighole company. Okay, from an FR perspective, I have already uploaded the video of it. I request all of you, I urge all of you to please go and watch that video. Please go and watch that video. Again, I will give the link in the description box. FR section C, how to deal with FR section C. I have already uploaded a video. You want to see, I will show it to you. See, new Craighole company. Okay, how to solve section C in less time. Okay, you can't see. Just a minute. Yes, new Craighole company, how to solve section C in less time. Okay, group accounting, all the 3 video are already uploaded on your portal. Okay, I request all of you, I urge all of you FR students particularly, please go and watch these 3 videos tomorrow itself. Don't delay. Tomorrow itself you watch it off. Tomorrow itself you watch it off. Okay, and I will give you the link of these in the description box of this video. Okay, now FR must solve section C questions. Also, I have uploaded. See where? Here in the sorts column. If you come here, see, I have uploaded a sort. Where is it? Where is it? Yes. See, FR F7. Can you see this one? Can you see this one? FR F7 important questions, right? So I have already uploaded this one. So I request you to consider all the important questions of FR section C. Watch that one. Okay. Interpretation video I will be uploading by Monday. Interpretation video I will be uploading by Monday, wherein I will guide you on interpretation. Plus I will discuss one question also of interpretation. Is that clear, everyone? Okay. Now, SBR students, see you tomorrow at 5 p.m. India time. SBR students, see you tomorrow at 5 p.m. India time. Come on, guys, tell me for the one last time, how's the Joes, guys? Come on, tell me, how's the Joes, guys, everyone? For the one last time, come on, guys, tell me, how's the Joes, everyone? So ending this session here, and I request all of you, sustainability standard also uploaded. Sustainability standard theory also uploaded, already uploaded, guys. Sustainability standard theory is also uploaded. I will also give the link of that in the description box. Okay, so come on, guys, for the one last time, and I will request all of you guys, I request few things. Once this session gets over, I request all of you to comment your feedback in the comment section of this video, and share this video as much as you can. Tag me on Instagram stories. Please post a LinkedIn post and give an honest feedback of the session. It will be helpful for me, helpful for all other students who are preparing for FR and SBR. And SBR students, see you tomorrow at 5 p.m. India time. That's all for today, guys. This is Vishal Jain signing off from FR Revisions. Bye-bye.